Welcome back everyone, this is Mayank Kothari. Today we are going to discuss about the advanced capital budgeting chapter. We are going to consider this entire chapter from compiler 5.0 and we are going to take it in an exam oriented manner. So how we are going to discuss is that first we are going to take all the concepts, discuss that. I will give you the workings as well for the class notes, and then we are going to take one by one each question from the compiler. There are around 47 questions. Some of them will be homework if they are repeated ones, and the difficult ones will be taken by us. Let's start with it. The very first thing that we should know about this chapter is that the concepts that are covered. So these are the basic concepts. In the very first page itself, I have written everything that is to be covered as a concept in this entire chapter. So we can see that I have divided the entire chapter in three different topics. The basics is the first one, risk analysis is the second one, and the third one is the other topics that covers rest of the concepts. So the very first concept that we are going to discuss is the net present value. Fortunately, the same has been discussed and learned by us in CA intermediate. Nevertheless, we are going to repeat it again. What do you mean by the net present value? I am giving you the reference of the previous lecture, that is time value of money, and if you have gone through that lecture you might have learned about the present value concept, right? It is the same thing, but the word net means the outflow and inflow gets mixed with each other, and the resulting cash flow is called as the net present value. What we are going to do with this concept is that we are going to decide whether the net present value is positive or negative. If it is positive, that means the cash inflows are more than outflows, and if it is negative, it means outflows are more than inflows. So the basic formula for the NPV concept is very simple: present value of all the cash inflows given to you in the question minus present value of all cash outflows given to you in the question. So this concept will be used most of the time when you have to decide whether to accept a particular investment decision or not. If you have to invest in some kind of a project, obviously you will be looking forward for a positive return. Nobody invests for a loss or a negative return, right? So positive return or desired return will be expressed by the cost of capital or the required rate of return. Let's say, for example, I have 1 lakh rupees with me and I can invest that much of the amount in FD, and I can easily earn around 7.5% there, right? So this is the risk free investment because I am not taking much of the risk by investing in fixed deposit, and I'm earning 7.5% there. But if I put the same amount of money in some kind of a business, first of all, the risk increases. Keeping the money in FD and keeping the money in a business is two different things. The risk point of view, if we talk about the risk point of view, there is no or almost no risk in FD, but there will be significant risk in the business, right? So what will happen if I want you to get convinced from putting your money, like taking your money from FD and putting it in the business, I have to give you more return. Let's say, for example, I'm giving you same level of return, 7.5%, 7.5%. The risk is nothing here, but the risk is too high here. Where are you going to invest? You are obviously going to invest in FD, because without any risk, you are earning 7.5%, and here with some kind of a risk, you are earning 7.5%. Nobody is that fool that they will take the risk for the same level of return. So in order to convince you to invest in the business, I have to increase the required return. I have to increase the return that the business will give to you. Let's say, for example, now the business is giving you around 15% of the return. Now you have 5 years. You can keep that money in your FD. You can keep that money in your business. And you can earn 7.5% without any risk. You can earn 15% with some kind of a risk. Now it's up to you. Both the situations are equally comparable, because the people who most of the time, I will tell you, in real life, the people who are aged around 45 plus or 50 plus, they will choose to put their money in FD earning 7.5% because they are okay to get a lower return, but they don't want to take a risk because their life is now the limited. It's limited. But for person like you who is in the age group of 20 to 25 or 30, you can take the risk. You have a lot of life remaining. So what you can do, you would want to increase your wealth. At that time, this option, the second option, where you can put your money at 15%, will be more attractive to you. Very good. So for this is just about the required rate of return. All depends upon the risk of the project. Now coming over to the concept net present value. Understand that in whichever project you invest, no matter whatever is the risk, you would want to earn the minimum rate of return required by you. So what we have to do is, whatever the cash flows are there for the particular project, we should discount those cash flows with the required rate of return, the rate of return that we want. Now understand that if you invest in a business here, and let's say 5 lakh rupees is required for the investment, and every year the project is going to give you 2 lakh rupees for 5 years. So 2 for 5 years goes to 10 lakh rupees. Now what you are going to do, your required rate of return is, let's say, 12%. What you are going to do is, you are going to discount all the cash flows. Take the present value of all the cash flows. First of all, the 10 lakh rupees of investment is standing at 0 point itself. So you don't have to do much with this figure, because this is today's figure itself. But once the investment is done, you are going to receive 2 lakh rupees every year. What you have to do in order to make them comparable with the outflow, you have to bring all those cash flows at 0 point. Okay, so you are going to discount those cash flows at 12% rate of return and find out what is the present value of total cash inflows. So once we do it, let's say that the present value comes to 7 lakh rupees. The outflow was 5 lakh rupees, and now we can say that we have NPV of 2 lakh rupees. This is called as net present value. This NPV can be positive, can be zero, can be negative. Remember that. The net present value can be positive, can be zero, can be negative. What does that mean? Please understand this thing. A lot of people are mistaken here. If the net present value is zero, that doesn't mean that you are not earning anything. You are earning, but you are earning exactly what you have used for the discount rate. That is why the NPV is coming to zero. So if my cash flow comes to 5 lakh here, these are the discounted cash flows at 12%. That means 5 minus 5 is going to be 0. What does that mean? I am earning exactly 12% on this project. That's why the NPV is coming to 0. And the rate of interest at which the NPV is coming to 0 is called as IRR. So here our rate of return is 12%. The project is giving us 12% return. But if your NPV comes to positive, let's say 2 lakh rupees, as can be seen here, that means we are earning more than 12% in this project, and that is good news to us. We should accept this project. But if the NPV is coming to somewhat like, let's say, minus 3 lakhs or minus 1 lakh or minus anything, that means we are earning less than 12%. It doesn't mean that we are not earning or we are incurring losses. It means that we are earning less than 12%, which is not acceptable to us, because in the beginning itself we said that the minimum rate of return that we need is 12%, and if the NPV is negative, that means we are earning less than 12%. Okay, and because this rate of return is not equal to 12%, not reaching to 12%, we are going to reject the project. All in all, the decision that we have to take is, if the project's NPV is positive, that means we are earning more than what we have asked for, we will accept the project. If the project's NPV is zero, that means we are earning exactly what we have asked for, we should accept the project. And if the NPV is negative, we are not earning which is required to us, that means we should reject the project. The basic formula or the basic presentation for the net present value in your exam should be like this. Have a look. So this is the formula. NPV is equal to present value of cash inflow minus present value of cash outflow. The maximum time what you should do is, you have to take the first column as year, 1, 2, 3, 4, 5, 6, 7, 8. You can take 2 to 5 years as well if all these 3 years, 2, 3, 4, 5 years, 4 years have the same cash flow, you can use the annuity concept as well. In the second column, you have to put the cash flows. In the third column, you have to put the discount rate, the present value factor at the required rate of return. This is called as the required rate of return by the investor, or you can call it as the cost of capital as well. Cost of capital, cost of equity. And then you will calculate the present value. This will be like present value of cash inflows. Understand? Now you are going to deduct it with the present value of cash outflows, and then you will reach out at net present value. So this is the basic format of net present value that we should use. Okay, so all in all, what we were doing is discussing the concept of net present value. The second concept is the probability, and what you should know about the probability is very simple, that for a particular year, if the question says that more than one cash flows are possible, like out of 5 different cash flows, anything can happen. Because before investing in the project, what we have to do is we have to estimate at this point. Acha, one more thing that I was about to suggest you was that, let me just remove this. In capital budgeting questions, one of the important thing that will help you is drawing this timeline. This is the timeline for every kind of capital budgeting question. So this is the time 0, let's say this is time 5, there will be 5 years if the project is of 5 years. So this is how we have to draw the timeline. Drawing the timeline will give you an idea of how to proceed with the answer, and it will make your answer easy. Let's say you are investing 5 lakh rupees here, and then you are receiving around 2 lakh rupees every year. Okay. The very first thing is you cannot compare these cash flows because the timing is different. That is what we learned in the time value of money. In order to make it comparable, we have to bring all the cash flows at one point, and the best thing to do is to bring it at 0 point, because that's where we are standing, the present time. That's why we are going to discount all these cash flows with the required rate of return. Now the required rate of return, the cost of capital, will play our role. Let's say that is 12%. As discussed earlier. And if the present value comes to 7 lakh, what you are going to do, once the cash flows are at the same point or same time, you can do the addition and subtraction with them. So if I go with this, the NPV will come to 2. This is called as NPV, this is called as present value of cash inflow, and this is called as present value of cash outflow. Since this is positive, we are going to accept the project. If it would have been negative, we would have rejected the project. And if it is 0, we can still accept the project because we are earning exactly what we have asked for. And we can reject also if we are not happy with it. Okay, so all in all, this is the thing. Now, what may happen in the question that might be given to you is like they might give you, in the very first year, there are 3 different cash flows, and out of these 3 cash flows, any one will happen or any one will be incurred. So let's say this is first year, second year, third year, fourth year, and fifth year. And they are saying that the first year, the cash flows can be 2 lakh, 3 lakh, 4 lakh, 5 lakh. Second year, 3, 7, 8, 9, like this. Now understand one thing. If more than one cash flow is possible at any given point for any given year, there will be the probability also of those cash flows. So the question has to give you the chances of happening of these cash flows. So now this comes from the statistics and the mathematics that you might have learned at CA foundation level. So this is called as the probability. Probability means the chances of happening of a particular event. In the very first year, the cash flow can be 2 lakh, 3 lakh, 4 lakh or 5 lakh, any one of the 4. That's why in order to evaluate further, we have to take into account the probability of happening of these events. So let's say the probabilities are like 10%, 20%, 50%, and 20%. So these are the probabilities. Remember that the probabilities total will always be 100% or we can say 1. Now, whenever such type of questions are given to you, the best thing that you should do is calculate the expected cash flows. So this is what the cash flows are. But when you multiply it with the probability, it will give you the expected cash flows. So I have multiplied it 2 into 0.10, 0.20, 3 into 0.20, 0.60 in that manner, and we will total it now. 3.80. This 3.80 is called as expected cash flows, bar cash flows. Expected cash flows. So this is the second concept of probability and calculating mean or expected cash flow. You can say average, you can say mean, you can say expected cash flow, weighted average, etc, etc, etc. Okay, so till now we have learned about the two concepts, I think, NPV and the expected cash flow. Now the third thing which is connected to these probability is the risk. Now we have to find out the risk in this first year's cash flow. Okay. So let me tell you. Are we done with the first two concepts? Let me just mark it. First, second. And now we'll keep this for a later part. Now we are going to discuss about the standard deviation. Understand that if I say that in the very first year I can earn 2 lakh rupees, there is no risk in it. Risk arises when more than one event is possible. More than one. If it's sure that I'm going to pass the exam and there is no other possibility, then there is no risk. When I give the exam and if it's sure that I'm going to pass, there is no other result that can ever happen, there is no risk in this entire event. But if there are two events that can happen, first I can pass and I can fail. Successful, unsuccessful. If there are two possibilities, then there is a risk involved. Risk of failing. Right? In the same manner, if there is only one cash flow that is possible, there is no risk here. Risk is possible or risk is involved in a situation where more than two possibilities are there, like 2, 3, 4. Out of these 3 cash flows, any one will happen and there arises risk. In this scenario, the risk is there and we have to calculate the risk. Risk means what? Risk means how far the actual outcome will be from our expected outcome. If I'm expecting to earn 3 lakhs and if I earn 2 lakhs only, the risk is the loss of 1 lakh rupees. Simple. If I'm expecting to earn, let me just complete some cash flow. Let's take the probability. I will just take the probability, let's say again 0.20, 0.50 and 0.30. Okay. So this is cash flow, or let's say we will take it separately here. Let's say I put cash flows here 2, 3, 4 and I put probabilities here 0.20, 0.50 and 0.30. The very first thing that I'm going to do is I'm going to calculate the expected cash flow. That comes to 0.40, 1.5 and 1.20. Okay. So that's 2.7, 3.1. Right? Okay. Now my expected cash flow is 3.1 lakh for the next year. But actual outcome will be either of the 3, 2, 3 or 4. Now calculating the risk in the project means calculating how far understand, calculating how far the actual outcome will be from the expected outcome. This is called as risk. Now what we are going to do, we will mark it as bar cash flow, that means expected cash flow. Okay, now we have two figures. One is the actual outcome. Out of these three, any one will happen. And this is the expected outcome. Again, calculating risk means calculating how far our actual outcome will be from the expected outcome. So we are going to calculate the difference between these two. That is called as deviation. How far the actual outcome is deviating from the expected outcome. This will be calculated by calculating the deviation, cash flow minus bar cash flow. So 2 minus 3.1 comes to 1.1 negative, 3 minus 3.1 comes to 0.1 negative, 4 minus 3.1 comes to 0.9 positive. Okay. The second thing, this is the deviation. This is how far every outcome will be or is from the expected. The second point is risk is never ever risk cannot be negative. It is never expressed in negative terms. Just imagine I'm giving CA final exams and I'm saying that there are negative 10% chances that I might fail. We never say that the chances of failing is negative. Chances of passing is 50%, chances of failing is 50%. Both the 50% that I just said were positive. I never said that negative 50% are the chances. No. So the risk is never expressed in negative terms. What we have to do next is we have to remove the negativity in the deviation, and the very best thing or the very best way out to remove the negativity is squaring the figure. Once you square any negative figure, the answer will be positive. What we are going to do next is cash flow minus bar cash flow square. 1.1 square, that comes to 1.21, 0.1 square comes to 0.01, and 0.9 square comes to 0.81. So even if the figures are negative or positive, after squaring those, the answer will always be positive. Getting it? Now, but these are the three different deviations. What we have to do next is we have to multiply it with the probability, because these are the three different variations. Multiplying it with the probability will give us the result that the deviations are also considered according to their chances of happening. So 1.21 will now be multiplied with the probability. What I'm going to do is the next step, cash flow minus bar cash flow square into probability. So 1.21 multiplied by the probability 0.20 comes to 0.24. 0.01 into 0.50 comes to 0.005. 1.21 into 0.20, 0.242. And then 0.81 into 0.30 comes to 0.243. If you do the total of these three, the answer is 0.49. This is called as variance. Variance is denoted like this. And once you square root the variance, you will get standard deviation. Why we are putting a square root here? Because we had given one additional treatment of doing the square, and you can remove that effect of squaring these figures by putting a square root like this. Let's say if you do the square of -2, it will come to 4, and when you put a square root here, it will again come to 2. So removing the additional effect that we have given earlier is called as the standard deviation. That means putting square root on the variance. This is called as variance, and this is called as standard deviation. This is the concept that we wanted to learn. Both of them are measure of risk. You cannot say that standard deviation is only risk and variance is not a risk. Variance is also a risk. Out of that variance, standard deviation is arrived. or calculated. So once you put a square root here, the standard deviation comes to 0.7. 0.7 lakhs rupees. This is lakhs. What does that mean? That means your expected cash flow is 3.1 lakh for the next year, but the risk in that 3.1 lakh is 0.7 lakh. How to interpret these risk? So this is the expected cash flow 3.1. When you say that the risk is 0.7 lakh, that means your expected cash flow can move either side in reality by 0.7 lakhs up to 0.7 lakhs. So if I remove 0.7 from 3.1, it comes to 2.4 lakhs, and if I add 0.7 in 3.1, it comes to 3.8. It means that my expected cash flow will be somewhere in the range of 2.4 to 3.8. Expected is 3.1, but that expectation can deviate from 0.7 lakh on either of the side. It can increase as well or decrease as well. This is called as standard deviation or risk. This is going to help you in the portfolio management chapter as well. 0.7 lakhs. So this is the third concept called as risk. Let me just take you there. Standard deviation of the project. See, wherever you are investing, there are two important things to calculate: the return and the risk. The return is denoted by the net present value and the risk is denoted by the standard deviation. It's equally important to calculate the standard deviation in any given project. So with these, we complete around three basic concepts of the capital budgeting chapter. And before moving ahead, we should consider taking some questions. Let's have a look on the very first question of capital budgeting. So have a look on this. This is our advanced capital budgeting chapter. 47 questions are there that we are going to discuss. Let's come over to the first question. It's going to be an easiest one. It's from the study material itself. Have a look. We're going to finish it off soon. Jumble Consultancy Group has determined the relative utilities of cash flows. Now in this case, utility means the NPV or the benefit, we can say, of the two forthcoming projects of its client, coming as follows. So these are the cash flows range and the benefit because of that cash flow. If your cash flow is negative 15,000, the benefit is negative 100. And in the similar manner, the rest of the cash flows and benefits are given to you. If there is no cash flow, no benefit. So on the left hand side from 0, there are negative cash flows, negative benefit. On the right hand side, it is positive cash flow, positive benefit. There are two projects, project A and project B. Cash flows, here you can see that there is a range of a cash flows and the probability is given. Project B, the range of a cash flows and the probability is given. Which project should be selected and why? It's very simple. The project with the maximum benefit will be selected. How we are going to solve it? It's very easy. Take the cash flow, each cash flow, and in the second column, adjacent to this cash flow, put the utility. So if the cash flow is negative 15,000, that means the utility is negative 100. If the cash flow is negative 10,000, that means the utility is negative 60. In that manner, put the utility column also. Once you put the utility column, you then take the third column as probability. If there are 10% chances of this negative cash flow 15,000, that means there are 10% chances of the negative utility of 100. Now you multiply the utility column with the probability column and you will get the expected utility, that means expected benefit, we can say expected NPV. That's it. Do the total of that for both the project and see which project is giving you the highest utility, highest benefit or highest NPV. Have a look on this. So this is the first column, cash flow, second column probability, third column is utility. What you are going to do, you are going to multiply the probabilities with the utility and you will have your answer. When you do the total of it, the utility value is 2 for project A, the utility value is 17.55 for project B. That's it. Which project will be accepted? Project 2 will be accepted because it is having the highest utility. Moving over to the next question, because this is just the probability type of question that was there. One of the easiest one to start with. Question number 2 is going to give you some brainstorming session. Cyber company is considering two mutually exclusive project. Whenever two mutually exclusive is written, that means you can accept either of the two. Even if both the projects will give you positive NPV, you cannot accept both the projects because of this sentence. Mutually exclusive project means you can accept only one of the two project. That means the NPV or the cash flows which the project which will have the highest NPV or highest cash flow will be selected. Investment for both the project is 5 lakh rupees, you can easily see here, and each is expected to have a life of 5 years. Under the three possible situation, their annual cash flows and probabilities are given. See, cash flow for project A and B is given to us three different scenarios and the probability of these three scenarios. The scenarios are good, normal and worse economic situation. Good, normal and worse. The chances of the happening of that is given in the second column. The third and fourth column is for the cash flows. What we are going to do? It's very simple. Understand. The cost of capital is 7%. That means this is our required rate of return. With this, we can discount the cash flows. Which project should be accepted? The project which will have positive NPV. How to calculate NPV? NPV is nothing but present value of cash inflow minus present value of cash outflow. Outflow of 5 lakh is fixed for every project. And what is the cash inflow? For the next 5 years, the cash flow is same. But we have to first calculate the expected cash flow. So the very first step is to multiply the cash flows with the probability and do the total of it. That total will happen, it will be incurred every year. That will be there every year for the next 5 years. So I can understand from this logic that the annual cash flow is same for the next 5 years, and that's why I'm going to use the factor annuity concept. Annuity multiplied by present value annuity factor at 7% for next 5 years is what I'm going to use. And this is how I'm going to calculate the net present value. Now the next step is to calculate the annuity. Annuity is calculated by multiplying the probability with the cash flows. So 6 multiplied by 0.3, 1.8 lakh, this is going to be 1.2 lakhs, total is 1.6 lakhs, total is 3.2, and this is going to be somewhere around 0.6. So 1.8, 1.6, 0.6, so 3.4 and 4 lakh is the total. For project A, every year for the next 5 years, 4 lakh is what you are going to earn. For the next 5 years. Since the cash flows for the next 5 years are same, instead of putting it every time and multiplying it with the present value factor, what you can do is you can use the concept of annuity that we have learned in the last lecture. 4 multiplied by the annuity factor. How do you calculate the annuity factor? You are going to put 1 divided by 1.07 and then equals 5 times and then press GT. You will get the annuity factor. Those who don't have the GT in their calculator, they can just do M plus after every equals and then put MRC, means memory recall. So 4.10 is the annuity factor. So this is how we are going to arrive at the (16.4 minus 5). This is going to be an NPV 11.4 in the first project. But understand one thing. This is a normal case. Have you calculated the expected cash flow for project B? Let's do it. 5 lakh into 0.3. The probabilities are same. So it will be 1.5. This will be 1.6 and this will be 0.9. And if you do the total of it, it again comes to 4 lakhs. What does that mean? Project A and B are having same cash outflow, same cash inflow, though that means they will have same NPV of 11.4. Now we are unable to decide which project we should accept because both of them are having the same cash outflow, same cash inflow, and the NPV is resulting into same. Now what is the solution? Just think about it. Whenever you are not able to decide on the basis of risk, on the basis of return, you should calculate the risk. Now let's move on to calculate the standard deviation in each project. And you will see that we will have something to decide. Because even though the NPV or the return is same in both the projects, the risk might be different. And how to calculate the risk? You have to first find out, understand, you have to first find out how much your expected cash flow is deviating from the actual cash flow, first thing. Second thing, remove the negativity by squaring all the figures. Third thing, multiply it with the probabilities to arrive at one common figure. Fourth thing, total all those figures. Fifth is called, that total will be called as variance. Fifth is putting square root on that variance to arrive at the standard deviation. That means it is called as risk. Now, see. First, what we do is cash flow minus bar cash flow. Then we square it because we have to remove the negativity. Then we multiply it with the probability. Then we do the total of it, that means summation. This is called as variance. When you put a square root on the variance, you get the standard deviation. So this has become our formula to calculate standard deviation of the cash flows. If you have to calculate the standard deviation of net present value, you have to put the net present value in the bracket. That's it. If you have to calculate the standard deviation or risk of the returns in percentage, then you have to put it like this in portfolio chapter. That's it. The variables will change inside the square root. The concept will remain same. First calculating deviation, then removing the negativity, then multiplying it with the probability, totaling it, and then putting a square root. If there is no probability, what you can do is you can just, after the summation, divide it by n. That means you are giving average or equal probability to each of the situation. This is number of observation. Okay, for now I'm just removing it. So this is what we have to do in this question. Let's have a look. See, NPV in both the projects are same. The project should be decided on the basis of standard deviation. And now we are going to calculate the standard deviation. In this particular question, they have calculated the standard deviation in equation format. We can do it in the table format as well. Have a look. For project A, what we are going to do? Cash flows, probability, bar cash flows. Then we are going to go with the cash flow minus bar cash flow. Then we are going to remove the negativity. We are going to put square and then multiply it with the probability. So it's like this: 6, 4 and 2 lakhs. The probability is 0.343. See, 1,80,000, 1,60,000 and 60,000. So this is 4 lakhs. Let's calculate the deviation. 6 minus 4 is 2 lakhs. This is 0, 4 minus 4, and this is minus 2 lakhs. Okay. Let's square this figure and multiply at the same time with the probability. 2 lakh into equal to into 0.3. That gives us 1200 crore. Right. Then this is going to be 0. And then this is again 1200 crore in positive because we are removing the negativity. So that means the total is 2400 crore. This is called as variance. And when you put a square root on this variance, just a second, 2400, it will give you the standard deviation of 154919. That means there are two results for the project A. Is that expected cash flow is 4 lakh, but these expected cash flow 4 lakhs can go up by 154 lakhs, 1,54,000, or down also by 1,54,000. The same thing you are going to do in project B. Exactly the same thing. See, 154,919. Can you see that? When you do the same thing in project B, you will see that the standard deviation of project B is comparatively lower than standard deviation of project A. Why? Why? Because it's very simple. How far the cash flows were deviating from the expected cash flow of 4 lakh rupees. In both the project, 4 lakh was the answer. And you can clearly see from the given details itself, this 6 lakh was far away from 4 lakh, but this 5 lakh was only 1 lakh away from 4 lakh. So the deviation is less here. That's why the final deviation is less in project B. Now we can say that if we are having NPV of 11,40,000 in both the projects, so the returns are same. Why to take extra risk? That's why we are going to make sure that these NPVs are confirmed to the maximum possible by selecting the project with lowest possible risk. So this 77,000 is the lowest risk out of the two. We will go with project B. We will have the same NPV and the lowest risk. Why do you want to deviate your cash flows by this much of the amount? If it goes up, then it's okay, but it can go down as well. And you don't want to take the risk. So project B is our final answer. See, I can just say project B should be accepted. Understood? This is question number 2. Now question number 3 is going to be another question where we are going to learn one more concept. Have a look. A company is considering projects X and Y with the following information. The information is given to you. See, project X and Y having expected NPV of 120 to 225 lakhs and standard deviation is also given. So we have the returns as well as the risk of both the project. Now, which project will you recommend based on the above data? See, if we look at project X, we can see that the NPV is lower, but project Y is having more NPV. So on the basis of net present value, we should select project Y. But on the basis of risk, we should select project X. Isn't it? Right? So we are going to write in the very first part, we will write it like this, that we will select project Y on the basis of NPV and project X on the basis of standard deviation. Now both these two concepts are giving us two different results. Once we are selecting project X, once we are saying yes to project Y also. Now explain whether your opinion will change if you use coefficient of variation as a measure of risk. Since there is a conflict of result using both the two concepts, we are going to learn and use one more concept called as coefficient of variation. So we will call it as CV, coefficient of variation. The meaning of it is risk per unit of return. In this case, return is NPV and risk is standard deviation. So basically the formula will be standard deviation by NPV. It can be standard deviation by cash flows as well, because cash inflow is also returned to you. Now, so standard deviation by NPV is what you should do. If we do it, 90,000 divided by 1,22,000. 90 divided by 122. Just have a look. 90 by 122. And in project Y, we are going to do 120 ka risk divided by 225 return. So we will have 0.737 as CV here and 0.533 as CV here. What does that mean? Just understand one thing. It means that risk per unit of return or NPV is lesser in project Y. For every 1 rupee of return, project Y is asking for only 0.5 rupee of risk. But the same level of return here is giving you more risk, is asking you more risk, is having a little more risk. In this case, we will select project Y. CV lower the better, that because it is nothing but another measure of risk. CV explains you how much you are taking, how much risk you are taking for generating 1 rupee of net present value. Now what we have done in both the cases, we have equalized the return and now comparing the risk, like the previous example where we had equal NPV but the risk was different. In this case also, now the NPV is equal, that is 1 rupee, and we can see that the risk is lesser in case of project Y. So this is how we are going to select project Y, coefficient of variation. Okay. Hence project Y should be accepted. Now, which measure is more appropriate in this situation and why? In this conflicting situation, which measure is more appropriate? I have three measures for you in this question. First is NPV, selecting the project on the basis of NPV, selecting the project on the basis of risk, and selecting the project on the basis of CV. Now, out of these three, which one will you select? No matter what, NPV will rule over all. Why? I will just give you an example. Let's say there are two projects, A and B. A is having an NPV and standard deviation. So A is having an NPV of 1,50,000 and standard deviation of 75,000. Whereas B is having an NPV of 10 rupees and the standard deviation of 2 only. Now if you calculate the coefficient of variation, you will say that 75 divided by 1,50,000, that means 0.5 is the coefficient of variation in project A and 0.20 is the coefficient of variation in project B, and since coefficient of variation is less in project B, we should go with that. This might be the result because of the coefficient of variation, also because of the standard deviation. Have a look. According to coefficient of variation, this project should be selected B because it is less. It is giving you lesser risk per unit of return. Because of the standard deviation, also project B is the result because the risk of project is 75,000 and it is only 2. But let me tell you one thing. Both the projects are going to run for 1 year and you are going to put efforts for 1 year. Will you be satisfied earning only 10 rupees just because the later two concepts are giving you, suggesting you to accept project B? No. What matters at the end of the day is how much we are putting in our own pocket. I am okay to have 75,000 of the risk for 1,50,000 rupees of the return. I am not okay to go home taking only 10 rupees just because it has less risk. That means I should not do anything. No. We will take the risk and we will go home with a larger sum in our pocket. And that's why with NPV we should go. So all in all, when there is a conflict or in this such scenario, we should always select the NPV as the basis because in absolute term, it is helping us to maximize our wealth. That was something we might have learned in financial management's first chapter. Wealth maximization is the objective of financial management. And that is why 1,50,000. So just imagine two people are going home, one with 10 rupees in his pocket and the another one with 1,50,000 in his pocket after working very hard for entire year. Right? So, however, NPV method in such conflicting situation is best because NPV method serves the purpose of objective of wealth maximization in terms of time value. Understood? So we have learned one more concept here called as coefficient of variation. Let me just take that. Good enough? Okay, we are going to solve another question. Let me just see if this question is worth undertaking. See, in this question they have asked about the three concepts that we have learned till now: NPV, standard deviation, and coefficient of variation. What they are doing is expected cash flow. They are calculating expected cash flow, then standard deviation. They are calculating the expected cash flow, then standard deviation, and at the end they are calculating the coefficient of variation. That's it. So I am putting this question for you. Okay. So this is going to be your homework. You can just go through it. Question number 4. Question number 5 is also same, but there is one more thing that we have to learn in that. So let's take question number 5. So let's have a look on this question. Question number 5, it is Shivam Limited is considering two mutually exclusive projects. Again, mutually exclusive means only one of the two can be accepted. Project A costs 36,000 and the B costs 30,000. That is cash outflow of the project. You have been given below the NPV or probability distribution for each project. Project A is there and project B is there. You can see the NPV is given and the probability of NPV is given. So please understand that the question itself has already calculated present value of cash inflow minus outflow, and then NPV is given to you in the first column. But there are multiple NPVs possible. That's why the probability is given to you. Next, compute the expected net present value of projects A and B. How do you calculate it? It's very simple. Multiply the NPV with the probability and do the total. That's the first thing. Let's have a look. What we are going to do, multiply the probability with the NPV and you will have this expected NPV. Fortunately, unfortunately, the expected NPV of both the projects are same. So the decision cannot be entirely taken on the basis of NPV only. Now, compute the risk attached to each project. That is the standard deviation of the each probability distribution, means cash flows. So we have to calculate now the standard deviation of each. How we are going to do it? We are going to calculate the risk of the standard deviation. So our formula will be NPV minus bar NPV will give you the deviation, because some figures will be negative in this. We are going to calculate, we are going to square it up and then multiply it with the probability, and then we are going to total it up. So once totaled, it will be called as variance, and after putting square root, we can calculate the standard deviation. So here it is, have a look. This is the probability. The second column is for the NPV, and once we deduct 9,000 from 15, we will get 6. 12 minus 9 is 3, 6 minus 9 is minus 3, 3 minus 9 is minus 6,000. So this is the deviation. We will call it as NPV minus bar NPV, because there are some figures which may be negative. So that's why for the entire column we are going to square it and multiply it with the probability, and then we are going to total it. So variance will be 198 lakhs. After squaring it up, 4450 will be the standard deviation. Okay, so in the similar manner, we are going to calculate the standard deviation of project B as well. Now you can clearly see that both the projects have same NPV but different standard deviation, and accordingly we should select project B because it is having less risk. The expected NPV is less likely to deviate than project A. The NPV of project B is less likely to deviate than project A. That's why we are going to go with project B. Okay, coming over to the profitability index. This is a kind of a concept which has already been covered, which was already covered in CA Inter Financial Management. Nevertheless, we are going to study it again. Profitability index shows you how much you are how much is your cash inflow for every rupee of outflow. You would want profitability index to be higher because it shows that you are having more cash inflow for single rupee of outflow. So what is the formula for it? It's very simple. Profitability index is nothing but present value of cash inflows divided by present value of cash outflows. And what was the formula of NPV? It is nothing but present value of cash inflow minus present value of cash outflow. Now understand, if we have to calculate profitability index, if the inflows total is 10 and the outflows total is 5, the answer will be 2. What does that 2 means? 2 means our inflow is twice the outflow and we would want inflow to be more. That's why profitability index of higher number is preferred. Now in this particular question, we have to calculate project A and B's profitability index. For this purpose, we need two figures, cash inflow and outflow. We have outflow of both the project, 36,000 and 30,000, but we do not have present value of cash inflow. But there is a way to calculate the present value of cash inflow. Have a look. You have NPV of the project given in the question. You have outflow of the project given in the question. Can you calculate the present value of cash inflow? Yes, sir. You can send this present value of cash outflow on the left hand side and it will become NPV plus present value of cash outflow. So NPV of both the project is 9,000. What you have to do is you have to add outflow in it to reach at the inflow. 9,000 plus 36,000. 9,000 is NPV, 36,000 is outflow. 9,000 is NPV, 30,000 is outflow. See, 36,000 and 30,000. This way you will get the present value of cash inflow and you can solve the entire question. So present value of cash inflow in the numerator is nothing but NPV plus present value of cash outflow, and in the denominator outflow only. So our present value of cash inflow is 45,000 and outflow is 36,000. In the second part it is 39 and 30,000. You can clearly see now that for every rupee of outflow, if 1 rupee is going out, you are earning 1.25, and if 1 rupee is going out in this project, you are earning 1.30. And this way project B is preferable because it is giving you more cash inflow than project A for every rupee spent or every rupee of outflow, right? So this was the next concept for which we took this entire question. Otherwise the previous two part, the NPV and the risk, was already done by us. Now, which project do you recommend? State with reason. See, which project has to be recommended, it depends upon the risk. We can see that project B is preferable. On the basis of profitability index also, project B is preferable. So measurement of risk is made by the possible variation of outcomes around the expected value, and the decision will be taken in view of the variation in the expected value. This is all the standard language, but it's very simple. The risk should be less. Project B is preferable because of the possible profit which may occur is subject to less variation, means standard deviation is less. Simple. This is what you should do. Okay, now coming over to question number 6, let's learn something new. Acha, question number 6 and 7 are almost same. 6 is little bit smaller than 7th one. So what we are going to do, we will take 6th as a homework and 7th as a part of the class. Let's do it. Let's take the 7th question now. 7th, right? We are going to learn a couple of things in the 7th question as well. Have a look. See, following are the estimates of the net cash flows and probability of a new project of Messrs X Limited. You can clearly see that there are 3 different scenarios, and in those 3 different, just a second, let me check.
होलसेल प्राइस कितना है वो बता दीजिए।
होलसेल में भैया 30% डिस्काउंट हो जाएगा जो भी रिटेल प्राइस रहती है हमारी, और मिनिमम 5 क्वांटिटी उठाना पड़ता है। Okay, it's working now. So what I was talking about is there are 3 different scenarios, the probability of which is given to us in a horizontal first row itself, 0.3, 0.5 and 0.2. And the investment is same obviously, because investment is pretty sure that how much we have to invest today. But what is unsure or what is not sure is the every year's cash flow, which is given to us for 1 to 5. It can be 1 lakh, it can be 110,000 or 120,000. That means 1 lakh, 1 lakh 10,000, 1 lakh 20,000. Out of the three, any one can happen. Estimated salvage value after 5th year is also given to you. Okay, required rate of return of the project is 10%. This is what the discounting rate will be. The very first thing that has been asked to you is the expected net present value of the project. And let's calculate it. Question number 7. I will just show you a different format for calculating the NPV. That's why I'm writing it here right now. See, question number 7. What we can do is very simple. We can divide all the cash flows in three different parts. One is the initial cash flow. Second, just a second. I don't know why this is happening again and again. Okay, see. So what I was saying, let me just draw it again. We can divide all the cash flows in three different parts. This is called as initial cash flow. This is called as operating cash flow. This will be called as terminal cash flows. We will invest 4 lakh rupees a year. That is our investment. And we can have 1 lakh or 1.1 or 1.2 lakhs every year for the next 5 years. And then we can sell this entire project at 20, 50 or 60,000. So this will be 0.2, 0.5 or 0.6. So you can clearly see that the investment is same, but the cash flows after that are different. What we have to do is to calculate the NPV. What we are going to do is calculate the NPV of each of the scenario by taking these three scenarios and calculating three different NPVs, and then at the end we will multiply the resulting NPV with the probability to arrive at one NPV. Have a look. See, so we will take year 0. Let's take it like this. Scenario probability will take later on, first, second and third scenario. So initial cash in initial outflow, I am not writing in full so that we can save up on time. It will be 4 lakh. It is already on present value. We don't have to calculate the present value of this again. Then we will take annual cash inflow of 1 lakh, 1,10,000 and 1,20,000. We will take present value annuity factor at 10% for 5 years. So that's 3.791. And then we can multiply so that all the futures cash inflows are discounted. So 379, it will look like this. 00 417010 and 454920. Okay, then we will take the salvage value and the present value factor at 10% for 5th year and then present value. So salvage value is 20, 50 and 60,000. So 20,000, 50,000, 60,000. And the factor for the 5th year for 10% is 0.621. You can take it at 10%. Because 10% is a common factor, that's why I remember it. For 12,420, then 31,050 and then 37,260. Now you can see there are three cash flows: initial cash flows, operating cash flows and terminal cash flows. These are the present values. What you can do is do the total of all these three cash flows in each of the scenario. So 379 100 plus 12420 minus 4 lakh, we have negative NPV of 8480, then 417010 plus 31050 minus 4 lakh is 48060, then 454920 plus 37260 minus 4 lakh is 92180. So this is your answer. Okay, but these are three different NPVs. What we have to do is take the probability here. Probability given to us in the question is 0.3, 0.5, 0.2. Okay, now 8480 into 0.3 goes to minus 2544. 48060 into 0.5 goes to 24030. 92180 into 0.2 goes to 18436. So total NPV is the total of all these things. We have 39,922. So we have this answer with us. Now you might find the institute's answer or the format in fact is easy and faster as compared to this. Let me just go through that answer. See, one table itself and everything is done 39,922. Look at that table and look at this table. You will find that the table given in the compiler's answer is pretty small and it can be calculated faster than what this is. But let me tell you one thing. This particular format, although it's a little lengthy in the very first instance, but second and third question becomes very easy and you don't have to do any calculation for solving the second and third part, whereas institute has recalculated the second and third part. See, second part. You can clearly see that institute has made some calculations here, but you don't have to do it. Let me just read the second and third part. The best case and the worst case NPV. Out of all these three NPVs, what was the best NPV? This is the best NPV and this is the worst NPV. That's it. You just have to write it down now. You don't have to do the calculation. But that was not possible in the institute's format here. That's why they calculated it again. So this is 8580 negative and 92060. You can clearly see 8480 3.791. Rounding of difference will be there, I think 100 rupees or something, whereas it should not be like that, but let's see if there is any difference. 3.791 into 1 lakh plus 12420 minus 4 lakh. So 8480 is the only answer. So ours is correct. You go with this. So the second and third answer is easy. 8580 92060, pretty much same. Now coming over to the third part. Understand the probability of occurrence of the worst case. See, this is the worst case because we have NPV of 8480 here. And they're asking what is the probability of that, and we can easily say that it's 30%. Yes, but the probability of occurrence of the worst case if the cash flows are perfectly dependent and independent over time. So if the cash flows are perfectly dependent and independent, what does that mean? Let me just solve it. The third part of this question. See, these are the 5 years. And I will take an example of, let's say, a chartered accountant charging fees for statutory audit or something like that, or tax audit for any work. So if a client is agreed with a particular chartered accountant and there were three possibilities at the beginning. The first chartered accountant quoted them 1 lakh rupees a year. The second chartered accountant quoted them 1,10,000 rupees a year. And the third chartered accountant quoted them 1,20,000 rupees a year. So in the very first year, there were three different possibilities: 30%, 50%, 20%. Okay. So the chances of this was 30%. I will just write it down. chances of this was 50% and chances of this was 20%, and we need the probability of only the worst case, which was the first one, 1 lakh rupees. Now what is the probability of the first case? 30%. And if a chartered accountant is fixed, it is more likely that the fees will be similar. Ignore the inflation, ignore the increment. The fees will be similar throughout the 5 years, because the second year's fees depends upon the first year fees. The third year fees depends upon the second year fees. Now in this case, when the chartered accountant is charging fees, the cash flows are dependent, right? The company knows that what is going to be their expense for the next 4 to 5 years. It is going to be pretty much same, like 1 lakh, right? So in the second year there is no probability, there is no risk, because the cash flows are dependent on the first year. So in the second year we are pretty much sure that the probability will be the cash flow will be 1 lakh. Pretty much sure that 1 means 100% probability. Now there are no, from the second year onwards, there are no possibility that the cash flow can go to 1,10,000 or 1,20,000, because we are not selecting the other two chartered accountants. We are selecting the first one only, and the cash flows are dependent on that. That's it. So in this case, for all the 5 years, what is the probability that the cash flow will be 1 lakh? It is 0.3 multiplied by 1 multiplied by 1 multiplied by 1 multiplied by 1. So when the cash flows are dependent, probability will be 0.3 into 1 into 1 into 1 into 1, that is 0.3, means 30% itself. Now what is the difference in having a dependent cash flow or independent cash flow? I will tell you. Let's take the same example. Okay, let's take the same example. I will just write it down here. And let's say you are a freelancer. The first year income can be 1 lakh rupees. Second year income can be 1,10,000 rupees. Remember that you are a freelancer. And the third year, let me just repeat. The first year you can earn either 1 lakh, 1,10,000 or 1,20,000. The probability of happening of the first or the worst cash flow is 30%. Now second year's cash flows are not dependent on the first year cash flows, because you are a freelancer. You may get the project, you may earn something, but it is not necessary that in the second year itself you will earn only 1 lakh. You can earn 1,10,000 or 20,000 also. So there is still the possibility that we will earn 1,10,000 or 20,000 in the second year. In the second year, all the three can happen. Like out of all the three, any one can happen, because the cash flows are independent of anything, because you are a freelancer. So in the second year also, you can either earn 1 lakh, 1 lakh 10, 1 lakh or 1,10,000 or 1,20,000. So all the three can be, the possibility is there for all the three. So out of that, only worst case scenario is 30%. The same will happen for rest of the 3 years. All the three possibilities are there for all the years, and out of that, if we want to just take the worst case probability, then the probability of 1 lakh every year is 0.3 only. Now we are not sure from the second year onwards that we are going to have cash flow of 1 lakh. Now in this case, the probability will be 0.3 into 0.3 into 0.3 into 0.3 into 0.3, that is 0.3 to the power 5, and that comes to 0.00243. If we multiply it, that is hardly any percentage, 0.243%. Whereas when the cash flows are dependent, the probability of happening of the worst case is 30%. If the cash flows are independent, it is only 0.243%. Because next year, see, first year you might get this result, next year you might get this result, and then this, then this, then this. There are n number of possibilities here, and in that case, we want to calculate that all the 5 years the probability the cash flow should be 1 lakh, and the probability of that comes to this 0.243%. So that's what the logic of dependent and independent cash flows. In institute's answer, it's very simple. If it is dependent, keep it 0.3. If it is independent, to the power life of the year, life of the project, that means 5. But the logic behind this doing to the power 5 and not doing is this dependent and independent. So I would request you in your compiler itself, you should write it like this, so that when you revise, you will get the logic of not doing to the power here and doing it here. I hope you are comfortable now. Okay, good. Let's move on to the fourth concept. Fourth question. Standard deviation and coefficient of variation you have to calculate, assuming that there are only three streams of cash flows which are represented by each column of the table with the given probabilities. Now you have to calculate the standard deviation. Standard deviation of what? Cash flows or NPV? It's surely gonna NPV. Why not cash flow, sir? 1 lakh, 110 and 120, because the salvage value is also there. We have to consider all the cash flows, and that is included in NPV. So take NPV, take probability, calculate the standard deviation or risk of the NPV. How to do that? It's very simple. We have been doing it since last two to three questions. What you are going to do is you are going to take NPV here, then take the probability, multiply the NPV with the probability to reach at bar NPV. This is the expected NPV that you are going to earn. Now deduct this NPV minus expected NPV to arrive at the deviation, because that is what we want to calculate, that how far our expected NPV will be from the actual NPV. But this will give you some negative answers. So what you should do, you should square it, then multiply it with the probability, and then do the total to reach at variance. Once you put a square root on the variance, you will get standard deviation, which the question is asking. Now I'm not doing the calculations again. Here they have done it in the equation format. You can clearly see that, yeah, here, see, I don't know why they have calculated the expected NPV again when it is 39,922 here, 39,813 here. So you can take any one. So take this and you can calculate this expected NPV. See, actual NPV minus, it should be minus. Okay, I will do the correction. To change the sign, you should do it here, 39,813. You can take 39,813, or else there is no need to calculate the expected NPV again, because you have already done it there. So you can take 39,922 as well. Don't change the answer again and again. And then you will calculate the standard deviation. It comes to 35,800. You have the NPV, you have the standard deviation. You can calculate the coefficient of variation by doing standard deviation divided by NPV. So that is nothing but risk per unit of return. That comes to 0.90. What does 0.90 means? For every 1 rupee of NPV, the risk is 0.90. Okay. Now the last question. Coefficient of variation. They have asked you to calculate the coefficient of variation. No, they are not asking you to calculate the coefficient of variation, but they are saying something. The company is X Limited, okay, and company's average coefficient of variation ranges from 0.95 to 1. For all the other projects that the company is considering or has been considering, their coefficient of variation, average coefficient of variation was 0.95 to 1. Whereas this project has a coefficient of variation of 0.90, which is good, because we want coefficient of variation to be less, because it represents risk. So average risk of the company is 0.95 to 1, but ours is 0.90 only. Okay. Now what the question says, that if the coefficient of variation of this project is found to be less risky, yes, it is less risky because we have 0.90 only. From the average coefficient of variation, ours is less. Then we should deduct 100 basis points from the company's cost of capital. What does exactly this means? If the risk of the existing project in this question is less than the average project of the company, average risk of the project of the company, then we don't have to consider higher rate of return for calculating NPV. What we did is we discounted 10% with this project to this project, but this 10% is nothing but the cost of capital of the company, where the projects of the companies are having a coefficient of variation of 0.95 to 1. But we can clearly see that this project is not that risky. That means this project should have a lesser required rate of return, and that's what the question is saying, that you should deduct 100 basis point. Remember that 100 basis point is equal to 1%. 50 basis point is equal to 0.5%. So we have to deduct 1% out of 10. That means the new required rate of return or cost of capital is 9%, and we have to calculate we have to show that we should accept the project or not. First of all, let me just tell you, if we are increasing the rate of return, the NPV will go down. In this case, the rate of return was 10% and the NPV was positive. If you reduce the required rate of return, the NPV will again increase. So it will be positive only, and the answer will be project should be accepted. Now it's just a matter of a calculation. So if we do the calculation again with 9% NPV, we will get a little more NPV, 9% discount rate, little more NPV than the previous one, and we should accept the project. See, the decision of accepting the project could be clearly taken from here only. When you are accepting the project at 10%, you are surely going to accept the project at any rate below 10%. Because the NPV is going to increase if the rate of return is going to decrease. So this was all the question. What we learned actually in this question, we learned how to calculate the probability of dependent and independent cash flows. We learned something about dependent and independent cash flows. However, standard deviation, probability, NPV, coefficient of variation, all the other concepts were discussed earlier as well, and we have revised those concepts in this question as well. So till now, 7 questions has been completed. If you skip all the other question and do only 7th one, then these 5 concepts will be covered in that. You don't have to worry about these 5 concepts, and you can skip all the previous 6 questions. You getting it? Now is the time to shift to the Hilliard's model. Now, slowly we are going to move over to the risk analysis and more difficult parts of this chapter. I hope you have understood. If you have any kind of a doubt, you can feel free to ask me. Let's discuss about the Hilliard's model now. Now understand that Hilliard's model is something weird, and it's not even practical, but it's a part of the syllabus, and that's the only reason we are going to discuss on this and have some question. So what is Hilliard's model? You can clearly see in the bracket I have written double discounting. Double discounting means Hilliard's main concern is we should consider higher risk and discount the cash flows with more we can say aggression, or we can say that if the cash flows is of first year, you should take the present value factor of the second year, not first. If the cash flow is of second year, you take the present value factor of the fourth year, 2 into 2. Third year cash flow into 2, sixth year factor. Fourth year cash flow into 2, eighth year factor, like that. And this is only applicable when you calculate the standard deviation, when you discount the risk of the project. So let me take an example. One project is there and 3 different years are given to you. You can invest in the project today and have some cash flows in the next 3 years. But every year different cash flows are possible. So what you are going to do, you are going to calculate the variance of each year's cash flow. Every year's cash flow will have a different variance. But what we need is the standard deviation of the project, not a particular year. So Hilliard's model says that first you calculate the variance of every year's cash flow. If there are 3 years, 3 variances will be there. And then you discount those variances by using the Hilliard's model, means by double discounting. If the variance is of first year, take the second year's factor. If the variance is of second year, take the fourth year's factor, and so on. And then do the total. Make the total of all those variances, because 3 years cash flow will anyhow going to sum it up. Then the variances should also get sum. Then you put a square root on the final figure to arrive at the standard deviation. So it's a normal method, nothing new in that, except for the fact that we are going to double discount the variances. Have a look on one of the question. The second one will be your homework. So this is question number 8 in front of you. Skylark Airways is planning to acquire a light commercial aircraft for flying class clients at an investment of 50 lakhs. This is today's outflow. The expected cash flow after tax for the next 3 years are given to you. You can clearly see that year 1, 2, 3 are given to you. Cash flows after tax for year 1, 4 different possibilities in year 1, 4 in year 2, 4 in year 3. Okay. Company wishes to take into consideration all the possible risk factors relating to the airline operations. First question, expected NPV is what you have to calculate of this venture assuming independent probability distribution. Now underline this word, independent probability distribution with 6% risk-free rate of interest. Since you are already double discounting the variances on the other side, they have taken the risk-free rate of interest here and not the cost of capital of the company. The possible deviation in the expected value and how would standard deviation of the present value distribution help in capital budgeting decision. This is going to be the theoretical part. The first thing is we have to calculate the project's NPV. We have to calculate the project standard deviation in the second part. Nowhere in this question they are asking you to use the Hilliard's model. So how are we going to get to know in exam that we have to use it in the answer? It's nothing, means there has to be some way that that should have been given in the question. But what you can do is understand or keep in mind those underlined words: independent probability distribution or present value distribution. Whenever such things are given to you, whenever such situation is given to you and the standard deviation has been asked, go for double discounting. That's it. There is no other way. That's unfortunate, but there is no other way. Okay, so let's first calculate the expected NPV. NPV is nothing but present value of cash inflow minus outflow. Outflow is given to you. You have to calculate inflow. First of all, take every year's cash flow after tax, multiplied with the probability, reach at one cash flow for every year. So at the end, you will have cash flow for first year, cash flow for second year, cash flow for third year. Getting it? Now discount these three cash flows with 6% rate of interest and do the total of it and deduct 50 lakhs out of it to reach at the NPV. See, so in this manner we will calculate the net present value. Okay, now is the time. Let's first go through it then. See, this is expected cash flows for 3 different years. We have taken those 3 different cash flows here. Okay, this is cash flow and then present value factor, present value, total of all those minus outflow. This is NPV. It's very easy. But then now is the time to calculate the standard deviation and we have to do it till the variance point as usual. Take every year and till this point it's same. You have to write it again. Instead of doing this, what we could have done is year 1, then year 2, then year 3. We could have left the space for the standard deviation calculation instead of putting all these figures again. Now see here, you can see that now this is the deviation. Just a second. First of all, how are we going to calculate the variance? It's cash flow minus bar cash flow. The negativity is there, that's why we are going to do the square of it, then multiplied with the probability. So this is going to be the variance. So this is the deviation, this is the square multiplied with the probability, this is going to be the total. So this is the variance, and this in this manner we are going to calculate the variance of all the 3 years and we are going to use these variances here, the above 3 calculations. And now is the time to apply the Hilliard's model. The standard deviation of these expected value, you can clearly see this is the first year's variance, but the discounting rate is of second year. This is the second year variance, discounting rate is of fourth year. This is the third year variance, the discounting rate is of sixth year. So it's always in the denominator 1 plus r to the power 2t in order to calculate the discounting factor, twice the time which is applicable. So in this manner, if we total, if we'll do the total of this will be the variance, the present value of the variance, and then in the end we are going to put the standard deviation, the square root button, and we will have the NPV. NPV means the standard deviation of the entire project. So I can clearly say that my project's NPV is expected to be 24.97, but that entire project NPV can move up or down by 14.37 lakhs. So this is what the Helios model. Helios model's impact comes to the last point only, where we have to discount the variances, but it should be double discounting, then do the total of all the variances. If there are 3 years, then the total of the present value of the 3 years variances, and in the end put a square root. So little silly thing, but it's okay. The second question, question number 9, is exactly like that. 3 years are given to you. There is some kind of investment like 50 lakh rupees here. You have to do the same thing, expected NPV and the possible deviation. How are you going to understand that? We have to use the Helios model here, independent probability distribution. Most of the time you will see that they have used the risk-free rate of interest, because already you are doing the double discounting. That's why the rate of interest has been reduced. Somewhere we have to compensate like that. Question number 9 was like that, and the 10 is also similar. Question number 10, the only different part in question number 10 and the previous two questions is that in the previous two questions there were single project, and in this question there are two projects, project X and project Y. Investment 70-80 lakhs. So you have to do the calculation for 2 times. That's it. So which project is better based on the NPV? We can calculate it easily. Criteria, the discount rate is 10%. Compute the standard deviation of the present value distribution. Again, this particular sentence. In all the 3 questions, you can clearly see that independent probability distribution or present value distribution, if it is given and you have been asked to calculate the standard deviation of not a particular year or not a particular NPV, the standard deviation of the entire project. And in that case, you have to do the present value of the variances and then put a square root. But the variances present value will be calculated based on double discounting concept, that is Helios model. That's it. One more thing that you will find. Okay, so the only difference that you will feel here is that in the second project, the cash flows, there are no 3 different cash flows, but the same cash flow is applicable for, I think, 3 years. Let me just confirm the number of years. Annual cash flow life of the project, yeah, 3 years. So annual cash flow throughout the life is 40, 45, 50, and the probability is this. So you multiply each of the cash flows with the probability and come to one cash flow. That one cash flow is applicable for all the 3 years. The same cash flow. You have to do the calculation thrice because of the double discounting factor. I will just show you. This will be so easy for you because there are 3 different cash flows for 3 different years. You can clearly see. Now, see, if we go with the expected cash flow of project Y, we can see that we have we can see that we have an expected cash flow of 45.5 lakhs every year. Now, in order to calculate the deviation, what we are going to do, see here, project Y for 1 to 3 years, what we are doing, 40 minus 45.5, 45 minus 45.5, 50 minus 45.5. Every year we have the same variance, that is 12.25 before putting a square root. So we can clearly see we have a same variance of 12.25 every year, and we are using the double discounting factor here. That's it. And this way we are calculating the standard deviation of the entire project. In the previous project, there were 3 different variances with the double discounting. That's it. This was similar to the previous 2 questions. This was only different because same cash flow, same variance was there for all the 3 years, but the double discounting is there. Now we have to decide which project we should accept based on the standard deviation. Project Y should be accepted because of the lesser risk. Clear? Comfortable here? We have completed another concept of double discounting. Now, before moving over to the next concept of inflation, I think are going to take a couple of questions on risk analysis, that is RADR and CEA. Now, before beginning this, let me just clear to you that what exactly is this thing. This is nothing but incorporating different methods of risk in the capital budgeting question. Capital budgeting question is mostly about calculating net present value. So in all these questions, we will be calculating ultimately the net present value anyhow. But NPV will be, the calculation method will be tweaked a little bit. You can clearly see that first concept is risk adjusted discount rate. So while calculating the NPV, the discount rate that we use is going to now adjusted with risk, is now going to change according to the risk of the project. The second concept is certainty equivalent coefficient. Then sensitivity, simulation, scenario. Scenario analysis, we have already seen that. Scenario analysis is nothing but the worst situation, best situation, normal situation question where we had an annual cash inflow of 1 lakh, 1 lakh 10,000 and 1 lakh 20,000. The same question, I think question number 7 was that. It was based on the scenario analysis itself. When different scenarios are given to you, you use the probability in order to analyze the project. That's the scenario analysis. Okay. And joint probability decision tree we are going to take. So let's start. Let me take a break and then we will start with question number, not question number 8, but the concept of risk adjusted discount rate and certainty equivalent coefficient. It is going to end in a couple of questions itself. Okay, so welcome back after this short break, and now we are going to discuss about the risk adjusted discount rate. See, how to calculate the net present value. This is going to be the same formula, same format. Year, cash flows in the second column, third column there will be present value factor, and the fourth column will be present value. All in all, what is going to change in this entire scenario is your discount rate, and it's very simple. Let's say for example, a company is there and its cost of capital is 10%, but that company is now considering investment in a new project, and that project is little riskier than the average risk of the company. So 10% is for the average risk of the company, and if that new project is riskier than this project, the concept says that higher the risk, higher should be the return. So applying 10% to that project will not do justice to the company or the funds or the investment decision. So all in all, one thing should be remembered, that higher the risk, higher should be the discount rate. That's it. Now the question is how to calculate the new discount rate that has to be used according to the risk of the project. It's very simple. Let me just give you some knowledge over it. Understand that this is RADR, and couple of things that we are going to take is, this is going to be return, this is going to be risk index. So in portfolio, this risk index is called as beta. This basically signifies the risk in terms of index. I will show you. Let's say this is FD, type of investment, fixed deposit. This is company, and this is project of the company that they are going to undertake, thinking of. Now, if you invest in FD, you will get 4% return without any risk. We will consider FD as a risk-free investment. And if you invest in a company, you get 15% return, and we have kept 1 as the basis of, as the base risk of the company, so that with that base risk we can compare all the other investments. Let's say the project 1.2 is the risk. What does that mean? It means that the project is little riskier, little more riskier than the company. How we were able to compare this? It was only because we kept 1 as the basis of risk index for the company, so that we can compare this 1.2 with 1, and we can clearly say that 1.2 is higher than 1. That means the risk is higher than the company. Okay. Now the question is, what should be the rate of return or the discount rate we should use for the project? And it's very simple. We cannot use 15% because 15% is the discount rate when the risk is 1. But what should be the discount rate when the risk is 1.2? Some will say that we can clearly cross multiply, like 15 is for 1, then how much is for 1.2, and then we can cross multiply, and then we can come to around 18%, and that will be the totally wrong answer. I will give you some insight into this. It's not going to be simply cross multiplication, because 15% is not the return that you are earning for taking the risk of one unit of index. It's only 11% that you are earning for taking any kind of risk, because 4% is the return you can easily earn without any risk. So if you compare these two, the increase in risk is 1 minus 0, which is 1. The additional risk that you took by shifting your investment from FD to companies, 1 minus 0. And the additional return that you received for taking that risk is 11%, 15 minus 4. Now you can clearly understand what I'm saying. Without any risk, the return is 4%. This is risk-free return. And with risk, the return is 11%. This is called as the premium over the risk-free return that you should receive for taking any kind of a risk. So actually, in a sense, we are earning 11% for taking that risk of 1. So how much premium we should receive for taking a risk of 1.2? Now you can cross multiply these two, 11 and 1.2. And then add that in this 4%, because this is the base risk-free return. So we are going to divide the total return in two parts. First is going to be the risk-free return, and the second will be risk premium. Okay. Now do understand how do we calculate this. Risk-free return will be denoted as RF. Simple. And what is the risk premium? The risk premium is that 11% multiplied by the extra risk that you are taking in this project. So first of all, we will calculate the 11%. The company's cost of capital, which is 15%, we will name it as KO, and then risk-free return. So this 15 minus 4 will give you 11%, and that 11% is for the company's risk. And as compared to the company's risk, how much is now your project's risk? Put it there. We will call it as risk index. In this way, we will solve it like this. Now you can clearly see there are two parts of this entire calculation. One is the return without any risk, and the next one is the additional premium that we should expect for undertaking the risk. See, 11% multiplied by 1.2 means 11 multiplied by 1 is 11 only. So how much extra or less risk you are undertaking in this project should be multiplied by the premium that the company is taking for that level of risk. So it will be 11 into 1.2. So that comes to 13.2. So understand that what is 13.2? 4 is the risk-free return and 13.2 is the premium that you should expect for the kind of a risk of the project, that is 1.2. So all in all, your discounted rate of return should be risk-adjusted rate of return should be 17.2%. This entire formula is called as risk-adjusted discount rate. This is how you are going to calculate RADR of the project. And the same concept is called as capital asset pricing model in portfolio management chapter. Okay. So this is going to be your new discounted rate. Let's take some question on the RADR concept. Now what you are going to do, you are going to use this discounted rate, this new discount rate, to calculate the present value factor and then calculate the NPV. Have a look on this question. Question number 8, I think. No, sorry, 11. Determine the risk-adjusted net present value of the following projects. You have been given with the 3 projects. You can clearly see net cash flows for project X, Y, and Z are given to you. That is cash outflow. Project's life is 5 years for all the projects. Annual cash inflow is also given to you, and the coefficient of variation is given to you. If you remember, the coefficient of variation is nothing but the risk per unit of return. Higher the risk, higher should be the return. Now in this part, this is going to be our risk index. Okay, and now we can clearly see that project X is bearing the maximum risk out of 3, and project Z is having the minimum risk. And you will also understand this, that applying the same discount rate to all the 3 projects will not do justice with the project itself, because if a particular project is less risky, expect less return from this project, because less return is justified because you are we can say that you are removing the risk part out of it, so that is where you are compensated for the lesser return. Now question has given you a little more data. Company selects the RADR on the basis of the coefficient of variation. Now for 1.2 you can see that the risk adjusted discount rate is 16% and the present value annuity factor is 3.274. For 0.8 you can see we have to take 14% and for 0.4 we have to take 12%. So our discount rate will be 16%, 14% and 12% for these 3 projects. The present value annuity factor is also given to you. Why? Because these are the annual cash inflows. Every year for the next 5 years the cash flows will be same, and we can apply the concept of present value of annuity. We just have to multiply these annual cash flow with the annuity factor of the respective discount rate, and then this will give us present value of cash inflow. We will deduct the outflow out of it and we can reach at NPV. See, 16, 14, 12, present value of cash inflow, annual inflow, annuity factor, and this is going to give you the discounted cash inflow. Deduct the outflow out of it and you will get the NPV. That's it. Simple. In this question, the question itself gave you the discounted rate. In the next question, we are going to calculate these discounted rate, risk adjusted discount rate. Have a look on this question, 15. Now new projects limited is evaluating 3 different types of project 1, 2, 3. You can clearly see the cost are given to you and the inflows are there for year 1, 2, 3, 4. And you can see that for project 1 the inflows are same for all the 4 years. So we can apply the present value of annuity concept here, but not in the other 2 questions. Just give me a second. I had to I have to make some corrections. There is an extra space after 4, 5 and 2 in project 2's cash flow. I would want to make the correction because otherwise it will I will forget. And one more correction was there, I'm not able to recollect it. Just give me a second. It was when we were about to calculate the expected cash flows, I think. Not in project, it was in question number 7. Yes, just a second. So there was one correction there, just a change of sign. Okay, let's move it. Now, so risk index is also given to us, minimum required rate of return of the firm. When it says firm 15%, this is going to be cost of capital for us, and the tax rate is 40%. It is irrelevant for the purpose of our calculation. Why? Because tax is applicable on profit. Question itself has given you the inflows. You do not apply the taxes on cash flows, you apply the taxes on the profit, so that rate is not applicable to us right now. Risk free rate is 10%. Find out the RADR and then which project is best. How to find out the RADR? It's very simple. You have to use the formula of risk free rate plus risk index in bracket cost of capital minus risk free rate. See, cost of capital is 15%, risk free rate is 10%, so the premium of the company is 5%. 15 minus 10. Now you have to multiply this premium with the risk index and add 10% in that. See, this is the premium. Multiply this premium with the risk index and then add risk-free rate, you will get 3 different risk adjusted discount rate. Higher the risk of project 1, the first project, higher is the discount rate. Lowest is the risk of the third project, lowest is the discounting rate. Now nothing is there, you just apply this rate, calculate the present value annuity factor or present value factor and do the calculation. It's very simple. For the first project, since it is annuity, you can apply the annuity factor, you will get the inflows, deduct the cost of investment, you will get the NPV. For the next two, you will have to prepare a table. See, 15% and then 13%. You are using different discount rate according to the risk of the project, and you are getting the NPV. Now in this case, project 3 has highest NPV because you have used lowest rate in that. You discounted the first project with 19% and the last project with 13%. So the gap of 6% itself is enough to bring NPV up. So we should accept this project. That's it. Rest of the item is same. Now we are done with the RADR concept. There is one more question on RADR that is put forward for you to do as a homework. I will tell you which one. See, till now we have reached till here. Okay, RADR. What happened while after preparing this compiler, I forgot to include some questions of capital budgeting from the study material. So later on we included it, but we did not change the number because that would have affected the ongoing batch. That's why we included all those questions after question number 34 from here. Earlier, it was like first 100 copies of the compiler in 2024 was having 34 questions of 34 questions only for capital budgeting. Rest of the questions were from study material inside, and we forgot to add that. Later on we added it, but we added it from question number 35. And then we realized as well that a lot of questions, question number 35, 36, 37, 38, 39, all those are so basic questions. This is only good for conceptual clarity and not even for exams. So even if you skip it, it won't matter. I will tell you which question to do out of these after the 34 question and which question to skip. You can skip all these questions from, I will just mark it because they are very easy. But if you have time, you should do it. See, this is RADR question number 39. You can skip it or you can do it as a homework. Okay. And 40th also, certainty equivalent approach, the concept that we are going to study now. And it's very good concept. Okay, let's move on to the next concept. Now, the next concept is certainty equivalent approach. Let me tell you one thing, just revise the RADR. How we used to calculate the NPV under RADR, we used to take year here, then cash flows, then present value factor at risk adjusted discount rate and present value, and then we used to come up with the NPV after deducting the outflow and all that. But in certainty equivalent approach, instead of adjusting the discount rate, we will adjust the cash flows. So there were two things that we have to consider. If the cash flows are riskier, cash flows include more risk, you have included more risk in the discount rate in the previous concept. Let me tell you something about the RADR. What we did in RADR is we found that the cash flows are riskier than average. That's why we increased or we changed the discount rate according to the risk of the cash flows. Certainty equivalent approach says that instead of adjusting this thing, why don't you adjust the cash flows itself? Now the question is how? See, these cash flows which are given for a project are riskier cash flows. We will call it as uncertain cash flows. The cash flows which are not certain, which are not 100% sure to happen. So let's say what we are going to do year, we will keep it as uncertain cash flows. So for the first year, let's say uncertain cash flow is 100. We know that this cash flow is not exactly correct. Actual cash flow will be somewhere near 100. It can be more than, it can be less than. But out of 100, depending upon the project, we are pretty much sure that the 40 rupees of cash flows is to certain. There is no uncertainty in that 40 rupees. Only 60, the balance 60 is uncertain. So what we are going to do, understand the name of the concept, certainty equivalent approach. Means we are going to convert these uncertain cash flows to a certain cash flows with the help of the CE coefficient. Let's say the CE coefficient is 0.4. It says that how much out of these uncertain cash flow is certain, like how much sure that you are how much sure that the cash flows will occur. So if you are 40% confident, that means only 40 rupees of the cash flows can be considered as guaranteed and certain. In another way, how much out of this 100 rupees is a guaranteed cash flow? That is 40. So 40 by 100 comes the CE coefficient, which is 0.4, and we will call it as certain cash flows. Now tell me one thing. This is what we are going to do for all the years. We are going to convert these uncertain cash flows with the help of certainty equivalent coefficient to certain cash flows. Now come over to the last column and tell me one thing. Do you think in the last column any kind of a risk is included in the cash flow? No. What you have done is you have converted the risky cash flows to risk-free cash flows, because you have removed all the uncertainty out of it. Okay. Then comes the present value factor, and here is the catch. You should discount the present value these cash flows with the risk-free rate of return and not the cost of capital. Why? Because you have already converted the risky cash flow to risk-free cash flows, and if there is no risk in the cash flows, how come there will be any kind of a risk in the discount rate? There should not be any kind of a risk in the discount rate. That's why you have to use the risk-free rate for discounting, because the cash flows are risk-free. The discount rate should also be risk-free to keep the base same. In the previous approach, this was risky, we made it risky. And if now this is risk-free, it should also be risk-free. That's what the concept is. So there are two things to remember in the certainty equivalent approach. The first thing is you have to convert the uncertain cash flows to a certain cash flows. That means you have to remove the risk out of it and make the cash flows risk-free. And then you discount those cash flows with the risk-free rate. Rest of the part is same. Get the present value calculated and then NPV. That's it. This is what you have to do. Now come over to the question 13. So there are two projects, project M, project N, and the outflow of both the project is given to you 8,50,000 and 8,25,000. Now these projects are having 3 years, and you can see that project M has these cash flows, but certainty equivalent coefficient is 0.87 and 5. That means only that much of the cash flow out of this is certain, rest is uncertain. And the same is there in project N. What you have to do, see, present value factor of rupees 1 discounted at 6% is given to you. Which project should be accepted? When you see that the certainty equivalent coefficient is given to you in the question, close your eyes and apply the certainty equivalent approach. First thing, convert those cash flows called as uncertain cash flows to certain cash flows and then discount it by 6%. That's it. So this is what you have done in the next question. In the next page, these are the uncertain cash flows multiplied with the CE coefficient. These are called as the certain cash flows. Write it down. Uncertain cash flows, CE coefficient, then certain cash flows, then multiplied with the risk-free rate of 6%, and then present value. Question will give you the cost of capital also. If the institute wants to trick you, they will give you the cost of capital and the risk-free rate both. But please remember, while using certainty equivalent approach, you don't have to take the cost of capital. You should take the risk-free rate. And then you can calculate the NPV. In the similar manner, project N is done. Okay. Now you can see that you are having more cash flow in more NPV in project N. That's why project N should be selected because of the higher NPV. That's the normal for every question. Now, the second part of this question says that if you would have used RADR instead of certainty equivalent approach. Let's say, for example, this is not a question of certainty equivalent approach and we have to use RADR in this question. The question is saying that which project would be appraised with a higher rate and why. It's very simple. Write down in your compiler itself. Higher rate is used for higher risk. So you have to find out which project is having higher risk. Only that project will be discounted with a higher rate. Now, when do you say that project is having higher risk? When the C coefficient, certainty coefficient is low. Certainty means no risk. And if that coefficient is low means there is a lot of risk. You can clearly see that. Analyze the C coefficient of both the project. It is having 8, 7 and 5. Whereas project N is having little more than what project M has. The certainty. When it has 8, it has 9. These cash flows are 80% certain. These are 90%. These are 70%. That one is 80%. This is 50%. That is 70%. So in all the years, the certainty of project N's cash flow was higher. So this will be called as carrying less risk. This will be called as carrying high risk because of low CE coefficient. If this is carrying high risk, this project should be discounted with the higher rate of return. That's it. That is written here. See, understand. Certainty equivalent coefficient of project M, the total of all the three is 2 and the total of all the three in project N is 2.4. And you can say that C coefficient ensures the certainty and certainty is more in project N. So there is less risk in project N. This means project M is riskier than project N. Higher the riskiness of a cash flow, the lower will be the CE factor. That's why. And if RADR method would have been used, project M would have been discounted with a higher rate. That's it. You can read the rest of the part. So this is what the question is. Question number 13 it was. So question number 13 is over. It was a small concept. That's why there is only one question, and the next question on C coefficient is question number 40. That is up to you. You just make it. I will take a break and I will come back with a new concept, that is inflation, and that is one of the important concept in your capital budgeting. See, I will just go through this. Now, till now we have completed the Helios model as well and these two concepts, the small concepts. Now we are going to move over to the inflation and after that sensitivity. These two concepts are most important one. I will just tell you what are the important concepts. This is important, this is important, and decision tree is also important. Simulation, scenario, joint probability is not that important, but these three topics, and apart from that all the topics in this are important, like these three are important. Okay, the rest of the two are not. Let me take a break and I will be back with the new concept. Okay, so welcome back after this break, and we will start with the inflation concept, one of the important concept in our syllabus. Let's read something about let's understand the concept first before taking on the questions. Have a look. It becomes easy to understand the concept with the help of this timeline. Okay, first of all, this is 1 year gap, and I can say that this is 0th time, this is 1 year, and if we invest 100 rupees here, I can clearly say that at least 10% of the return is what required to me. And if I earn that 10%, the cash flow that I am going to receive at the end of first year will be 110 rupees. But now there is a catch. Since 1 year has passed and you can see the history, there is a concept called as inflation. This inflation is going to eat up your purchasing power. What does that mean? It means that the item that you could purchase at 100 rupees today, you cannot purchase the same item at the same price after 1 year because the power or the value of your money has depreciated. So this is a concept of inflation which will eat up some part of your cash flows. So let's take an example that the inflation rate is 2%. That means if we remove 2% out of this 110 rupees, inflation will occur over a period of 1 year. So it is applied only on 110 rupees. It cannot be applied on 100 rupees because inflation today is zero. We will take into account the inflation for a period of 1 year. Okay. Now, as I said, if we remove 2% of the inflation from that cash flow that we have received after 1 year, the result will be 110 minus 2%, 107.80. So, in real sense, I have invested 100 rupees and I have 107.80 rupees in real sense. So practically speaking, what I have earned in real sense is 7.80% only, because whatever I have earned, that 10%, inflation was there in that 10%, and that inflation is going to eat up the cash flow. It does not matter if the cash flow is your interest or income or the principal amount. Inflation is applied on all the cash flows, so it is going to eat up all the part of your cash flows, that is 110 rupees. So 7.80% is the real income that you have earned over a period of 1 year. So in order to achieve the purpose of 10% of the income, we wanted to earn 10% of real income, not just the nominal part. So what we can do is we can add up that 2% in our required rate of return and invest accordingly, where we are getting 12% of the return, so that we can cover up the inflation as well. At the time, after 1 year, we will receive 112 rupees, and we can say that we have covered the inflation as well, so that inflation can be kept aside and we will receive 10% of the return. Let's check out. If we remove 2% out of 112 rupees, the resulting answer is 109.76. Still, you are not earning 10% because of one factor or one mistake that you have done here. What is that mistake? You have considered the inflation impact only on the principal amount and not on the interest amount. According to the concept of inflation do not look for the principal amount only. It look for all type of cash flows. So the interest income of 10% is also a cash flow. You should consider the inflation on that as well. What you just did is you just applied the 10% on 100 and 2% on 100 only. So you can clearly see 10 plus 2, 12% is applied only on 100. In no manner you can say that this 2% has been applied on this 10% as well. So this part is missing. This part is missing. That we have to consider the inflation impact on the interest also. And in that way, we have to add the inflation impact on interest income. How to do that? The procedure will be like this now. If you take 100 rupees here, what you have to do exactly is you have to multiply 1.1 with 1.02. So that 2% is applied now on this factor. Understand, out of this factor, 1 is called as the principal amount and 0.10 is called as the interest amount. Now we can say that the 2% is applied on the interest as well as the principal amount. Now the required rate of return will turn out to be 12.2%. It goes to 1. Understand, it goes to 1.122. I will remove the 1 out of it because we want only the return part to be written. So 100, when you apply 12.20% on 100, it goes to 112.20. So this is exactly how much you need on your investment, so that after considering or after removing the inflation part, you will still be able to earn 10% in real sense. So if you remove 2% out of it, the cash flows will be 110 rounded off, and the real rate of return will come out to 10%. How? 100 has been changed to 110, and that's why you have earned 10%. Now understand that this return is called as real rate. Real rate means after removing the inflation part. And throughout this entire process, we could see that inflation is included, was automatically included in this part. This part of the return is called, whereas where the inflation is included, is called as nominal return. So what you did in the nominal return is you added real rate plus inflation rate in this manner. That 10% of the real rate was taken over here. You added inflation with it to calculate the nominal return. Now we will come up with a formula for the nominal return in terms of inflation, and the formula will look like this. 1 plus nominal rate of return is equal to 1 plus real rate of return in bracket 1 plus inflation rate. And you might know, I think you have learned the logic of this formula now. What we are going to do, 1.10 into 1.02 is equal to 1 plus nominal rate. And this will look like 1 plus nominal rate is equal to 1.122. If you remove 1 from both the sides, your nominal rate will be 0.122, that will be 12.20%. Understood? This is how you calculate the nominal rate. This is the first understanding under this concept of inflation. Now, not just calculating the future value, we can calculate the present value also if we have been given with the cash flows. We can easily say that this 112.20 is the nominal cash flow because it has been arrived after considering the nominal rate on this 100 rupees, right? So if the rate is nominal, the cash flows will also be nominal. If you remove the inflation part, you can clearly see, if you remove the inflation part out of this nominal cash flows, this cash flow will be called as real cash flows, out of which you had calculated the real rate of return. So one thing is very clear, understand this logic. If you discount the nominal cash flows with the nominal rate, you will get the today's investment. So it's very important to understand another rule. Nominal cash flow should be discounted with nominal rate only to arrive at the present value, or you can discount the real cash flows with the real rate as well to arrive at the same figure of present value. If you discount 110 with 10%, you will get 100 rupees. If you discount 112.20 with 12.20%, you will get the same figure. So this is another rule that you have to understand. This was the first one, the formula. Second rule is nominal cash flows should be discounted with nominal rate and real cash flows should be discounted with real rate. It's very simple and easy to understand. The third rule is inflation is applied only on the cash item. Okay, so that means any expense or any income which is of non-cash nature, inflation is not going to affect that item. So depreciation is one of the item, or amortization you can say, or any sort of a non-cash item or any non-cash transaction is not affected by inflation. Okay, coming over to the next concept, the important one. Now understand, these are 3 years. Okay, 1 2 3, and I'm giving you the cash flows for all the 3 years. For the first year it is 100 rupees, for the second year also let's say it is 100 rupees, for the third year also let's say it is 100 rupees, or let's change the figure. For the second year the cash flow is 120, for the third year the cash flow is 150. Okay, but these cash flows are real cash flows. What do you mean by the real cash flows? That means inflation is not included in these cash flows. These cash flows are in today's terms. I'm not saying it is present value, but I'm saying only inflation is not covered in this. Apart from that, these cash flows can be put at the end of each year. But you cannot put it because inflation is not included in that. Let's take the inflation first. If we are supposed to take the inflation of 10% per annum, then how we are going to convert these real cash flows in nominal cash flows? So this is the first year's cash flow, second year's and third year cash flow. In order to bring this 100 at the end of 1 year, we have to add the inflation in that. Very simple to understand. Multiply it with 1.1 so that we can keep the principal along with the inflation. If 10% is the inflation, understand, 100 will become 110 rupees at the end of 1 year, and then you can put it there at the end of 1 year. Okay, this is so very simple to understand. But let's take the cash flow of second year. If no inflation is included in 120 rupees, that means not even for the first year, not just for the second year, but not even for the first year, the inflation of both the years are not included. And if the cash flow has to reach out till the end of second year, it has to go through the inflation of the first year, and in that manner you have to take it from the first year's inflation to the second year's inflation. You are going to multiply 1.1 two times. You cannot put 120 at the end of second year just like that by adding 1.1. You have to take it through the first year's inflation. But if we consider that the for second year's inflation is only 9%, then how the calculation are going to be? It's going to be 1.1 for the first year and 1.09 for the second year. So you are going to multiply 120 with 1.1 to bring it to the level of first year ending, and then again 1.09 to take it to the second year end. So it will be 120 into 1.1 into 1.09. It will become 143.88. 143.88. This is how you put a treatment for the inflation in the capital budgeting question. If they say that the no inflation is included, that means no, not for any year. Okay, let's take for the third year. If the inflation for the third year is 8% only, how you are going to take this 150 till the end of the third year? You have to take it through all the previous year, and that means it has to go through the inflation of all the previous year. So it will be multiplied by 1.1 multiplied by 1.09 multiplied by 1.08. Okay, that will look like 194.24. So this is how you are going to give treatments to the cash flows in inflation. If they say that inflation is not included, and if they say that these are the cash flows for first, second, third, fourth year, you should know how to put the treatments. All the cash flow has to go through the previous year. I will just take an example to explain this concept to you. If you are your age is 22 years, understand the concept. If your age is 22 years, you cannot directly jump to 24 year. If you have to go through the 24th year of your age, you might have already passed through 23rd year. So you cannot skip that 23rd year. Today it's 2025. We have to go through 2026 in order to reach out at 2027. We cannot directly jump, right? So we have to suffer all what is going to happen in 2026. So all the inflation also has to be included for the previous year. That's the major concept. Now you calculate, whenever the question is going to come for calculating the net present value, you have to understand that if the cash flows are nominal, the discount rate should also be nominal. What does that mean? It means that if the cash flows includes inflation, the rate should also include inflation. If the cash flows does not include the inflation, the rate should also not include the inflation. Nominal cash flow should be discounted with nominal rate, real cash flow should be discounted with real rate. Apart from this, no impact of inflation has to be taken over the depreciation amount. If you are now taking the depreciation inflation impact on the depreciation, no inflation impact on the tax saving or depreciation will also be there. Means tax saving on depreciation will also not be accounted for depreciation inflation. So these are couple of things that you need to you had to understand before we take the question. And now it's time to consider the first question of our concept inflation under capital budgeting. Have a look. It's I think question number 40. It's very easy. I will just I will do one thing. Since you are doing the exam oriented batch, I would request you to skip this question number 14. This is very easy and little complicated because of the insufficient data of the question. That's why they had to give alternative solution as well. So don't get confused and directly jump over to, you just remove this one also. These are the institute's material question and very easy, not going to be asked in exam. We will directly take question number 16. Acha, let's do one thing as well. Question number 16 and one more question at the end of the chapter are same. Almost same. But question number 16 has only 3 years in it. 1, 2, 3. But that question had, I think, let me just find out the question number. There is one more question, which is question number 42. So we will take question number 42, which has 4 different years. So difficult of all these questions. And we will skip question number 14, 15 and 16. Okay. 14, 15 so you should skip altogether. 16 is similar to 42, but 16 is the smaller one. That's why we will take the 42nd question. 42nd or 41, I will just see. We are going to take both the questions, I think, 41 and 42. Let's have a look. 41 and 42. So 14, 15 and 16 is what you are going to skip and jump over to 41. So we'll take first the easiest one. See, the 42 is also similar to the 16 number, but it has 4 different years in it. So we'll take this one. This is pretty easy. Before that, let's take question number 41. Okay, let's have a look. So there is one change in this question. The answer of the question, I'm not satisfied with the answer of the institute's material. We will change that in the compiler as well. So I'm going to solve these 2 questions calmly so that you can go through it, because these are the only 2 questions in our concept, and then we are going to move over to the next one. Have a look. Determine the NPV of the project with the following information. You can see that the initial outlay of the project is 40,000 and annual revenues in bracket they have given without inflation. That means these are real cash flows. And annual cost excluding depreciation, these are also real cash flows. Inflation is not included in that. Useful life is 4 years, salvage value is nil, tax rate is 50%, cost of capital including inflation premium, that means this is nominal rate. These are excluding, these are including. So the very first rule is that, first of all, understand real cash flows cannot be discounted with the nominal rate. Either you include inflation in that and convert the real cash flows to nominal and then use this 12% to discount it, or you remove the discount, you remove the inflation out of 12% and convert this nominal rate to real rate. I would suggest you to add the inflation in the cash flows, because that's how all the questions are done. In fact, this concept of inflation will again come in International Financial Management chapter. So understand this. Let's have a look. Question number 41. We will divide all the cash flows in 3 different parts. Okay. This is initial cash outflow. This is operating cash flows, and this is terminal cash flows. Terminal cash flow is 0. Salvage value is 0 in our case. So we just have to consider the operating cash flows. Initial cash outflows already in present value terms. Okay. Now, operating cash flows. Revenue. Cost. and tax rate is 50%, right? For 30 minus 10. So annual revenue is 30,000, cost is 10,000. We can say that the profit is 20,000 and the tax rate is 50%. So the tax is 10,000 and then profit after tax comes to 10,000. One thing that has not been added yet in this is the depreciation part. We are going to cover up the tax saving on depreciation separately because inflation cannot be applied on that amount. So this is 10,000 of the profit after tax. This will become the cash flow after tax before depreciation, tax saving on depreciation for each of the year. Now understand how we are going to solve it. The life of the project is 4 years. So we will take year on this side 1, 2, 3, 4, or what we can do is we can directly calculate the net present value here. Year 1, 2, 3, 4. Okay. So we will take the real cash flows and then inflation index at 10%. Understand how I'm going to convert this. This will be nominal cash flows. Then we are going to add back tax saving on depreciation. So we will say gross cash flows or net cash flows. And then we will take present value factor at 12% and then present value. So this is how we are going to solve. Let me first take 10,000 as the real cash flow for all the 4 years. Means no inflation has been included, and I have just told you that if this is how the cash flows are given and you have to put all the cash flows to the respective years, you have to go through the inflation of each year. Fortunately in this question the inflation is 10% for all the years, so the inflation index will be 1.1 for the first year into equal to 1.21 for the second year. That means 2 years 10%, then 1.331 and then 1.4641. This is how you are going to add the inflation in order to reach at the nominal cash flow. So 10,000 into 1.1 goes to 11,000, then 12,100, then 13,310 and then 14641. Right? This is the nominal cash flows after considering inflation for each of the year. Now, what is the tax saving on depreciation? You can clearly see that the investment is 40,000 initial outlay of the project. There is no salvage value. How do you calculate the depreciation? If you put the depreciation on a straight line method, so you do the cost minus salvage value divided by life. So 40,000 minus 0 divided by 4 means 10,000 rupees of the depreciation. Now tax saving on depreciation is 50%. So 5,000 is going to be the tax saving on depreciation for each of the years. The total will be 16,000 here, then 17,100 here and 18,310 here and 19,641 here. Now you can take present value factor 0.893, 0.797, 0.712, 0.636. Okay. So that is 14,288, 13,629, 13,037, 12,492. We can do the total of this to reach at present value of cash inflows. $12,492, 53,446. Okay. What was the outflow? Present value of cash outflow 40,000 and then NPV is 13,446. Pardon me if I have made some calculation mistake because I'm more focused on how to make the treatment in inflation question. So this is how you have to do. You can clearly see that we have not applied any type of inflation impact on depreciation and the tax saving on depreciation, because if the depreciation amount has to be same all the years, then the tax amount will also be same. The inflation will not change that amount as well. So this is how the answer should have been, but the institute has taken a different path. Whereas what has happened, I will tell you. See, they have taken the cash flows as 15,000. How did they arrive at the cash flow of 50,000? 15,000, I will tell you. 40,000 is the revenue, 10,000 is your, 30,000 is revenue, and 20,000 is the cost, right? So 30,000 is the revenue, 20,000 is the cost, and 10,000 is your depreciation. So with that fact, 10,000 remains your profit before tax. You will remove the tax of 5,000 on that. 5,000 is the profit after tax, and you will add back depreciation of 10,000, and then 15,000 is the cash flow after tax. But this is real cash flow, and then you are adding inflation of this. What has happened in this entire factor, if you apply inflation on this 15,000, that means you are applying the inflation on the tax saving on the depreciation as well, which is wrong, right? So you should understand that this is not how you should do it. So I can clearly say that the answer given in the compiler is wrong, but this compiler answer I cannot change it, because this is the answer by the institute's material. Unless and until institute changes it, we should not. Okay, so let's move on to the next question now. I hope you have understood how to solve the questions of inflation. Now this is going to be another question where we will have similar type of question, but different, we can say that inflation for all the years. XYZ Limited requires 8 lakh rupees for a unit. Useful life, you can see the life of the project is 4 years, salvage value is nil, depreciation is 2 lakh rupees per annum, expected revenue and cost excluding depreciation, ignoring inflation. See, here as well they have ignored inflation. That means all these cash flows are real cash flows. In the previous question, annually the cash flows were same, but here the cash flows are different. Tax rate is 60%, cost of capital is 10%, including inflation premium. That means this is nominal rate. If the question would have not included inflation in this cost of capital, we would have added it separately. Calculate NPV of the project if the inflation for all the years for revenue and cost are different. 10, 9, 8, 7, 12, 10, 9, 8, etc. Now, how we are going to solve this question? It's very simple. Take the revenues in vertical manner, add inflation of the respective year in those revenues to convert the real cash flows to nominal revenue. Then do the same with the cost, convert the real cost to the nominal cost. Now deduct this nominal cost from the nominal revenue. You will get the profit before tax. Remove the profit as well, remove the tax as well, convert it to profit after tax, and then take the tax saving on depreciation. Depreciation charge 2 lakh per annum. Now we are going to solve this question as well, because this is going to be the last question of inflation. I won't mind solving it again. Question number 42. Understand the format. It's very simple. You can take year here. 1, 2, 3, 4. See, I'm going to put real cash flows, inflation index. This is revenue. And then nominal cash flows. I will do the same with the cost. Real cash flows, inflation index, and nominal cash flow. You can do it in any other manner as well. You don't have to just always follow this format. You can take the horizontal format also. Okay, so the real cash flows are 6, 7, 8, 8. See, 6 lakhs, 7 lakh, 8 lakh, 8 lakh. Now the inflation index are 10, 9, 8, 7 for revenue. See what I am going to do. Acha, it will be better if we ठीक है. Now what we are going to do, we are going to just put 1.1 for the first year, but for the second year it is going to be 1.1 into 1.09, then 1.1 into 1.09 into 1.08, I think 10987, right? And for the fourth year it is going to be 1.1 into 1.09 into 1.08 into 1.07. Why we are doing it? Because the fourth year's 8 lakh rupees does not include any of the inflation for the first 3 years as well. It is at 0 point. So if we have to bring that 8 lakh to the end of the fourth year, we have to take it through the inflation of the first 3 year as well. 1.199, 1.295, 1.386. So this is how you are going to solve it. 6 lakhs into 1.1 becomes 6,60,000. 7 lakh into 1.9199 is 839, 300. This is 10 lakh 36,000. This is 11,088,000. Understood? You will do the same with the cost, and then you will reduce the revenue from the cost. And now I'm going to, because we have time limit, solve it through the compiler. Understand? The same has been done in the table format. It takes time because you have to create a table for each of the part. See, 6 lakhs in 1.1, 7 lakh into 1.1 into 1.09, 8 lakh into 1.1 into 1.09 into 1.08. This is how they have calculated the nominal cash flow. The same has been done with the cost as well. Now you can deduct the cost out of revenue here. This is inflation, this is cost, this is net profit, right? Net profit, you remove the taxes as well out of it, 60%, and this is net profit after tax without adjusting, after adjusting the inflation. So this is also nominal cash flow. The only thing that now you have to do is add the tax saving on depreciation in this. How much is the tax saving on depreciation? 1,20,000. You just simply add it. See, this is the last figure, this is the last figure. You add the tax saving on depreciation and your cash flows are ready. You discount it with the nominal. This is nominal cash flow, this is nominal rate, this is present value, this is the present value of cash inflow. Inflow minus outflow, NPV. That's it. It's simple. Okay. So with this, we are going to end our concept of inflation under capital budgeting, where we have learned 3 to 4 different things. Let me just go through it once again. The very first thing is this formula: 1 plus nominal rate is equal to 1 plus real rate into 1 plus inflation rate. Then the second thing that we learned is nominal cash flow should be discounted with the nominal rate, real cash flow should be discounted with the real rate. The third thing, depreciation or amortization or any non-cash transaction is not affected by inflation. So the tax impact of these items should also not get affected by the inflation. Then the fourth thing is how to apply the inflation. If the cash flows are real, that means they do not include any previous year's inflation as well. And if we have to take a particular year's cash flow to that year end, we have to include the inflation of all the years going through that phase. That is most important part. Okay, now let's go to this part. I hope you have understood the concept of inflation. It will again come in your international financial management chapter. At that time, you should be very careful. It is going to add more complexities. This concept will be there again with the other concepts. That's why you will feel that the question is little more difficult. Now is the time to discuss about the simulation sensitivity analysis concept. One of the most important concept of this chapter. Now let me start this sensitivity analysis concept with the fact that calculating the net present value is not enough. What happens when you calculate the net present value? Just understand and listen to me carefully. When you calculate the net present value, you find out if the NPV is positive or zero or negative. Try to imagine. Positive means accept the project, negative means reject the project, and zero can also be we can say that it's invariable, or we can accept or reject the project at that point. Now what happens if the project's NPV is positive? We do accept the project, but do you know the fact that the NPV is calculated with numbers of factors? Let me just go through it. Rough calculation I will show you. You take the selling price of an item 100 rupees, cost of an item 50 rupees, then the contribution is 50. Then you multiply it with the quantity, let's say 1000 quantity you are selling, so the contribution is 5000, then fixed cost is 1000, so you come up with the 4000 of the net profit before tax. Then you remove the tax of 50%, then 2000. This is your profit after tax. If there is some depreciation, you can add that, and then comes the cash flow after tax of 2000. And this is applicable for all the 5 years. So what you do is present value annuity factor of 5 years. So you are going to multiply, let's say the present value annuity factor is 5, and the present value of cash inflow comes to 10,000. Okay, let's take the cash outflow as 8,000, and then the NPV comes to 2,000. What happened? NPV is positive, and we will conclude that the project should be accepted. This is how you have been doing till now. But understand that this should not be the end of your capital budgeting decision. You should take further you should do further analysis of what if situation should be included in that. What if means, what if any of the factor in real life, this is all anticipated, and on the basis of anticipated NPV you have taken a decision to accept the project. What if any of the factor goes against you? What if you are not able to sell those products at 100 rupees and you can only sell those products at, let's say, 70 rupees? Just understand what is going to happen. See, 70 minus 50 goes to 20, quantity is 100, goes to 2000, then fixed cost 1000, and the net profit is 1000, tax is 500, profit after tax is 500 only, then cash flow after tax is 500 into 5 comes to 2500, and the cash flow after cash outflow is 8000. Now you are coming up with the negative NPV. You reached at the negative NPV, that means you should not have accepted the project. Just by changing one factor, if you are not able to sell that particular product at 100 rupees, and if it goes at 70 rupees in the market, you will be at loss by accepting the project. And just imagine, after putting an investment in real life, you cannot step back. It's all loss. So calculating the NPV and saying that the project should be accepted should not be the end of the capital budgeting decision. You should also provide, as a professional chartered accountant, if you have been given this type of work in your office, you should also give them, along with this NPV, you should also give them the project's analysis. We will call it as what if situation. We will call it as factor analysis, that how much each factor can go adverse to change your decision of acceptance of the project. That means you have to find out what is the minimum selling price, or maximum cost, or minimum quantity that you can sell, or the maximum fixed cost. You have to take into consideration all the factors, the possibility of all the factors going against you, that means adverse. And you have to provide that if the selling price falls by, let's say, 30% in this case, or 20%, the NPV will go to 0. That means that is the maximum that you can afford to have changes in the selling price. What if the cost goes to, let's say you are able to sell those products at 100 rupees, but what if the cost goes from 50 to 60 or 70? NPV can turn to negative. This calculation of calculating the change in every factor so that the NPV goes to 0 is called as sensitivity analysis. In a real sense, you are calculating how sensitive each factor is and how much percentage change in each factor can turn your decision or change your decision. Okay, this is sensitivity analysis. So how do you calculate the sensitivity? First, there are two different ways to calculate the sensitivity. You will calculate the change in your base value divided by base value. That means if the selling price goes to 90 from 100 and your NPV turns out to be 0 exactly, that means we can say that if our selling price goes to 90 from 100, that means there is a change or adverse change of 10 rupees in the selling price on 100, our NPV will turn to 0. That means the sensitivity of selling price is 10%. If someone says that the sensitivity of a particular factor is 10%, that means that is the maximum that you can afford to have an adverse impact in that factor, because with that much of the change, with the change of the sensitivity, the NPV goes to 0. Okay. So there are two methods to calculate the sensitivity of every factor. What do you mean by the calculating of sensitivity of every factor? Calculating the percentage change in adverse percentage change, or we can say that calculating the percentage change of adverse impact in every factor so that the NPV goes to 0. So the first method is, the objective is to find out NPV is equal to 0, find out what percentage change in factor will result in NPV is equal to 0. Okay, factor with least percentage change which leads to NPV is equal to 0 is called as the most sensitive factor. Which factor will be most sensitive, which can bring the NPV to 0 with least amount of percentage change? So let's say if the sensitivity of selling price is 10% and the sensitivity of the cost is 12%, we can say that selling price is most sensitive, because with least amount of change, this factor is leading NPV to 0. This still has to change till 12%. This can change till 10% and the NPV goes to 0. So the factor with the least percentage change which leads to NPV 0 is called as most sensitive factor. And how to calculate the sensitivity? Change in the base value divided by base value of a factor each time you are taking up the factor. There is another method to calculate the sensitivity as well, by giving a shock. We call it as a shock method. I will explain that concept later on. But let's first take the question on the first method itself to understand the concept better. So we'll come back to question number 14, 15, 16, though we have skipped, right? (17). See. So let's read this question. From the following details relating to a project, analyze the sensitivity of the project to changes in initial project cost, annual cash inflow, and cost of capital. See, what we have to do is analyze the sensitivity of three different factors: the initial cost of 1,20,000, annual cash inflow of 45,000, and the project's cost of capital of 10%, and the life is 4 years. To which of the three factors the project is most sensitive, and use the annuity factors of our 10% and 11% as given in the question. Now, first of all, whenever you have to calculate the sensitivity, the very first thing that you should do is to calculate the net present value for the data given to you. Okay. So we can clearly say that the annual cash inflow is 45,000. There is no taxes and anything. What you can do is you can take the annuity factor at 10% for 4 years, 3.169, multiply it with the cash flow. So this is 45,000 into 3.169. This is present value of cash inflow. This is outflow, and this is NPV. Now calculating the sensitivity in each of the factor means calculating how much that factor should be so that the NPV comes to 0. This is the first method. The second method is giving a shock method, where we change all the factors by a certain percentage to understand how much the NPV is changing. So first of all, let's solve it by our own method. Then we will go through the method given in the compiler. Both the methods are equally okay to go with. Both the methods are a part of a syllabus. You can follow each one wherever you feel comfortable. I'm just going to explain both the methods with the same question itself. Okay, let's have a look. Question number 17. see. So I will do one thing. NPV is equal to present value of cash inflow minus present value of cash outflow. So cash inflow is nothing but annual cash inflow multiplied by present value annuity factor minus initial cash outflow. So this is 45,000 into 3.169 minus how much is the outflow? 1,20,000. And then we can say that 22,605 is our NPV. So this is the first thing. Now calculating the sensitivity of initial cash outflow. It's very easy. The formula is change in base value divided by the base value. The base value means the original initial cash outflow is 1,20,000, and now the question is how much this 1,20,000, since this is cash outflow, the adverse that it will go is it can increase. If the initial cash outflow increases, the NPV can go to 0. Now you have to tell me by how much amount the cash outflow should increase so that the NPV goes to 0. It's very simple. For the cash outflow, since cash outflow is at 0 time, this is also at 0 time, we can clearly say that if the cash outflow increases by 22,605, the NPV will go to 0. You can put it and you can try once. So 22,605 is the change or increase in cash outflow that will bring NPV to 0. So our sensitivity percentage will be like this. $18.84. This is how much sensitive the cash outflow is. Okay. Another method is let's forget about the another method. We will just complete from the first method's angle. Now sensitivity of in annual cash inflow. Let's say annual cash inflow. Now in this, what you have to do is you have to put NPV is equal to 0 and annual cash flow as X. Put annual cash flow as X, then annuity factor 3.169 minus 1,20,000. This way you will be able to calculate the X. So if you transfer 1,20,000 on the left hand side and divide it by 3.169, you will get the X, that means 37,867. 37,867 is the selling annual cash inflow where NPV will go to 0. Therefore sensitivity of this annual cash inflow will be change in the base value. Means if the annual cash inflow goes down from 45,000 to 37,867, then NPV will go to 0. So how much is that change in terms of percentage? %15.85%. So this is your sensitivity of annual cash inflow. Third is your discount rate. Now calculating a discount rate where NPV is 0 is called as the internal rate of return, IRR, and it has to be calculated based on IRR method or trial and error method, where you will find out at what rate NPV goes to 0. So this is little bit lengthy, but this becomes easier in the second method. Let's find out first through this method. So we'll keep NPV is equal to 0 and we'll keep NPV is equal to 0. Present value of cash inflow means 45,000 into present value annuity factor minus 1,20,000. So we can say that we need the present value annuity factor to be 1,20,000 divided by 45,000, that means 2.667. So we need to find out the rate of return for which the present value annuity factor comes to 2.667 for 4 years. Okay. Now We have 10% is the rate of return, the first rate of return. At 10%, the annuity factor comes to 3.169. Now we should increase the rate to decrease the annuity factor. We should increase the rate to decrease the annuity factor. Let's take 12% and calculate it for 4 year. It comes to 3.037. So it won't be sufficient enough. Let's take 3.037. Let's take 15%. It comes to 2.854. It won't be sufficient either. Sorry, 2.855. But very close to what we want. Let's take 18% or 17% will be sufficient. 1, 2, 3, 4. 2.743. Let's take 19% or straight away take 20%. This is 2.589. Now you can clearly see that this is called as trial and error method, where we have to find out a particular rate whose 4-year annuity factor comes to 2.667, and you can clearly see that this is 2.667 comes in between these two 17 and 20%, right? Now our actual rate of return, where NPV is 0, is in between 17 and 20%. Hence we are going to apply the interpolation concept here. Now what is the interpolation concept? If the rate of return increases by 3%, the annuity factor decreases by 0.154. But we have to decrease the annuity factor only till 2.667. That means the total decrease of 2.743 minus 2.667, 0.067 is only required. Now understand how we apply the interpolation. 17% is to start, and we are increasing the rate. The next rate is 20%, which is higher than 17%. That's why we are increasing it. That's why we are adding, we are putting a plus sign. If the next rate would have been a lower than 17 now, then we would have put a negative sign here. Okay. So we have added. Now it's very simple. 3% divided by this multiplied by this. Now understand the logic. 3% is the increase in the rate required if we want to decrease the present value annuity factor by 0.154, and if we have to decrease only by 0.076, then how much increase in the rate of return required is called as interpolation. So this is 17 plus 1.48%. So all in all 18.48% is your answer. So at 18.48% your NPV becomes 0. Therefore sensitivity in discount rate is, how much the discount rate has to change? It has to go till 18.48 from 10%. Base was 10. That means it has to increase by 84.80% to bring the NPV to 0. So the sensitivity of IRR comes to 84.80%. Now we have all the three sensitivities. Are you getting it? The calculating the sensitivity of discount rate through this method takes time. But understand, first of all the yellow marked percentages are the adverse impact in each factor to bring the NPV to 0. It means that is the maximum adverse impact that we can afford in all those factors, because beyond this change NPV will go to negative and the decision will change to reject the project. And we don't want to reject the project. That means we don't want each of the factors to go beyond, adversely go beyond this. Adversely, not positively. Positively so they can go any percentage, but not beyond this adversely, right? This is the first method. Now let me just give you an example of the second method. Second method is giving a shock. Shock means you change each factor by a certain percentage. Let's say alternative, shock of 10%. Give a shock of 10%. So first, NPV is equal to annual cash inflow into present value annuity factor minus initial cash outflow. Annual cash inflow 45,000, present value 3.169. Now give the shock of 10% to the initial cash outflow, means put adverse impact of 10% on this initial cash outflow. Adverse impact on cash outflow means increase the cash outflow by 10%. That means 10% on 1,20,000, that is 12,000. It means if we increase the cash outflow to 1,32,000, the NPV goes down 45,000 into 3.169 minus 1,32,000 to 10,605. Therefore, how much has the NPV change? Percentage change in NPV. NPV has changed from 22,605. 22,605 was the base. So 22,605 minus 10,605. How much has been the change in NPV? 53.09%. Now understand the two changes that we have considered here. If we adversely put impact of 10% on the cash outflow, NPV goes down or adverse by 53.09%. Therefore, sensitivity is equal to percentage change in factor divided by percentage change in NPV. That means 10 divided by 53.09 comes to 0.1884. That is 18.84%. And if you will see now, this 18.84% matches with the previous calculation. 18.84. That is the sensitivity. So either you calculate it by bringing NPV to 0, or you calculate it by giving a shock. First you decide the shock percentage and then calculate the change in NPV due to that shock, and then put that shock divided by the change in NPV. That's it. Shock percentage divided by the change in NPV. Percentage change in factor divided by percentage change in NPV. This is the second method. It will give you the same answer. Now, let's give the shock of 10% to annual cash inflow. Shock means adverse impact. And let's calculate the NPV again. If we give a shock of 10% to annual cash inflow, it will decrease by 10%. That means 4,500. It will come down to 40,500 into 3.169. We have to keep all the other factors constant and calculate the NPV again. So our NPV comes down to 8344.50. Now calculate percentage change in NPV. So it's 22,605 minus 8344.50 divided by 22,605. That is 63.08%. 09. So this is how the NPV is adversely affecting. Therefore, sensitivity is nothing but the shock in the numerator, that is 10, and the change in NPV in the denominator, that is 63.09. That goes to 0.1585. That is 15.85% is the sensitivity of annual cash inflow. You can check from the previous calculation, 15.85%. And you might find that first two factors were easier in the first method, but little more lengthier in the second method. But the third factor, the discount rate, is easier in the second method. Let's calculate the discount rate sensitivity as well. Now affect put an adverse effect of 10% on the discount rate. That means discount rate is adversely affected if you increase it. If you put more stress on the required rate of return, that no, I don't want to earn only 10%, I want to earn 11% on this project, that means we are putting more stress on this project. So that is where we are going adverse. So if we increase the 10% discount rate to 11%, means by 10% on 10 means 1 percentage of increase, that means 11%. So NPV will be 45,000 into annuity factor at 11%, which is given to you in the question with 3.103 minus 1,20,000. So the new NPV will be 19,635. Change in NPV will be 22,605 minus 19,635 divided by 22,605. 13.14. Therefore, sensitivity will be percentage change in factor, that is 10% of the shock that you have given to discount rate divided by change in NPV. 0.76. I think there is some mistake. How come 0.76? It has to be 84, no? Let me just check once again. With 11%, 3.103. 19,635. %13.14%. That means there is some problem in the previous calculation. Forget it. Let me just correct here as well. First. So it comes to 0.7610. That is 76.10% is your impact. Let me just check once in the answer. 13.14. So 76.10% should be the sensitivity of the discount rate. Let me calculate it once, because it should have been either this should have been 76.10 or this one should have been 84. But as far as I can see, we might have made some mistake here. So 1 divided by 18.48. 1 2 3 4. 2.665. Instead of taking 1,20,000, what I did was I took 1,12,000 in this calculation, and that made everything wrong. So let me just correct it. 2.667 तो okay. One 7,610. 1 2 3 4 into 45,000 minus 1976. So still it's not coming proper. I remember that there will be approximate answers in the discount rate, because the method itself is called as trial and error method. So if we go through this 11 1 2 3 4 3.102. So this is exactly the correct answer. This is not the wrong answer. 1 divided 1.1848. Okay. So I will just summarize here. The calculation of discount rate is more appropriate by the first method. This is the more appropriate answer. If you cross check by taking 18.48% as the discount rate and calculating the NPV, it will come closer to 0, but it won't come closer to 0 by this method, 76.10. Okay, but the answers, all the calculations are almost correct in this. So keep that part, keep that much of the difference. So this is what the change is to which of the three factors the project is most sensitive. Understand which factor is most sensitive. How will you call a factor most sensitive? If a small percentage of change can bring the NPV to zero, or a smallest percentage change can change your decision of accepting this project, then that factor will be called as the most sensitive factor. In this case, the most sensitive factor is, see, the most sensitive factor is the annual cash inflow. There are two different ways in order to, two different views from which we can decide the most sensitive factor. First, smallest change in factor which brings or which changes your decision, or highest change in NPV, a factor which brings highest change in NPV. You can see that the highest change in NPV has been brought by the cash inflow 63.08, or the smallest change in factor which brings NPV to zero is also cash inflow. The answer will remain same. It's just a different side from which you are looking at. So now I will summarize it. The sensitivity analysis. The first method you have been explained already. See, the second method is impact on NPV through percentage change. Take fixed percentage like 10% change in factor to find out the impact on NPV. Factor which leads to highest adverse impact on NPV is called as the most sensitive factor. So how to calculate the sensitivity? Percentage change in factor divided by percentage change in NPV. If you change the factor by 10% adversely, how the NPV is changed? Use that to calculate the sensitivity in each factor. That's it. Now this was the first question only. Now coming over to the second, third, fourth question, I will explain these questions in the compiler's answer. Because it was the first question, we took a lot of time to explain the concept. Let's have a look on question number 18 now. So let's read with this question number 18. XYZ Limited is considering a project for which the following estimates are available. You can clearly see that we have a project in our hand, the cost of which is 10 lakh rupees, and selling price after investment we can sell every product at 60 rupees with a cost of 40 rupees. So we can clearly see that there is a contribution of 20 rupees per unit, and the volume that we are going to sell for the next 3 years are given here. Year 1, 2, 3, 20,000, 30,000 and 30,000. For the very first time the volume is going to change. It's not constant over a period of 3 years. The discount rate is 10%, and you are required to measure the sensitivity of the project in relation to each of the following parameter. So you have to find out 5 different sensitivities: selling price, unit cost, sales volume, initial outlay, project lifetime. The very first thing before calculating the sensitivity is to calculate the net present value based on the data given to you. So this is our calculation of the net present value. This is cash outflow, and understand that this is unit multiplied by the contribution. Nothing else is there. No taxes, no depreciation, nothing else, no fixed cost. This is the discounting factor for the first year. Then quantity for the second year, contribution for the second year, discounting factor. Quantity for the third year, contribution for the third year, discounting factor. This way we have arrived at the NPV of 3,10,293. This is the basic. Now we have to find out the sensitivity of every factor, that what change in that factor can bring the NPV to zero. The very first thing is sales price. Now before doing all this, first of all, in exam you have to find out what exactly the institute is asking you. Whether institute is asking you to follow a particular method. If not, my suggestion is to go with the second method of giving a shock. That becomes easy for you as well. If the discount rate is not given, cost of capital or the discount rate sensitivity is not asked, and we can clearly see that this is not asked in this. So it's better to go with the second method, giving a shock of 10% to each of the factor. Let's see what institute is doing. Here the institute has used the first method. They have calculated the NPV to zero, the first method, alternative method. Now the second method has been done here. If the sale price is decreased by 10%, that means this is a shock method. So let's just go through this method only. if you give a shock of 10% to the selling price, means selling price has to be decreased by 10 rupee. 10% means 6 rupees. So make the selling price to 54 and then the contribution will be 14 rupees per unit. And now calculate the NPV. See, 14 rupees per unit. Rest of the factors will remain same. Calculate the NPV. Now find out what is the percentage change in NPV. The previous NPV was 3,10,000, which has come down to 82,796 in minus. So first it will come down to 0 and then it will again go back 82,796. So this is the change in NPV, base NPV. We can clearly see how much the NPV is changing, 126.68%. So by just decreasing the selling price by 10%, the NPV is decreasing by 126.68%. How to calculate the sensitivity? It's very simple. The shock percentage in the numerator, the change in NPV in the denominator. So 10 divided by 126.68 into 100 goes to 7.89%. This is the sensitivity of the selling price. You can clearly see the same is here, 7.89, 7.9%. That means if the selling price decreases by 7.9%, the NPV will go to 0. That again means the maximum adverse impact on selling price that we can afford is this percentage. Beyond this percentage, we will be rejecting the project. That's it. Now, the second part, cost. Unit cost. Unit cost is your 40 rupees. If you put an adverse impact of 10%, you will increase it by 10%. Because adverse in the cost means increasing it. Make it 44. Earlier was 60. Again, the contribution will remain to, contribution will be 16, right? Right. Contribution will be 16. Now put a contribution of 16 and calculate the NPV again. See, 16. Now our NPV comes down to 48,234. I'm not explaining how to calculate the NPV as it was already covered by us in the beginning. So 48,234. It's positive, na? It's not negative, or is it positive? Let me just clear it up and make the correction in the compiler as well, because sign change is there. Okay. 290,909 plus 396,694 plus 360,631. So 10 lakh. So 48,234, it is positive only. We have to remove the negative sign. NPV is positive. So please remove the negative sign out of it. 310,293. I will do it, just wait a second so that it is not repeated. 48,234. Yes. So 310,293 minus 48,234 divided by 310,293 into 100. Just a second. Yes, 84 point. The answer is correct. It was only the drafting mistake. Cool. See, now we can calculate the sensitivity by simply putting a shock on the numerator and percentage change in NPV in the denominator. So 10 divided by 84.46 into 100, we can clearly see 11.84% is the sensitivity of this 11.85, 11.84 of cost. If the cost increases by 11.84%, the NPV will come down to 0. Now comes the point of sales volume. In the sales volume, we can clearly decrease the sales volume by 10%. So in the first year, it was 20,000, decreasing it by 10% means reducing it by 2,000, 18,000. In the second and third year, it was 30,000. We decreased it by 10%, 27. Resulting NPV is with you. Calculate the change in NPV and then you can put 10 divided by 42.22. 10 divided by 42.22, 23.69% is the change. See, 23.69%. If you go by the first method, you just have to put this much, the NPV in the numerator, but that will not be the right way in all types of questions. In this question, there is no fixed cost. That's why you could put 3,10,293 in the numerator and make the answer very easy. But do not make it a rule. Go with the shock method and you are going to get the same answer. Again, calculating, see, this is going to be the difficult part. Project lifetime. Calculating a lifetime where NPV is 0 is called as discounted payback period. You might have learned about this in CA Inter. Payback period, discounted payback period. So you have to calculate the lifetime where NPV is coming to 0. And this can be calculated by number of methods, but let me just give you the easiest way for it. We will solve it here by interpolation method. So this is going to be the question number 18. First of all, put a table like this: year, cash flow, present value factor at 10%, present value and cumulative present value. Start with 0. 0, 1, 2, 3. Cash flow for the first year is 10 lakhs outflow. 0th year is 10 lakhs outflow. Factor 1, 10 lakh outflow. Cumulative is also 10 lakh. For the first year, the cash flow is, see, 20,000 into 20, 4 lakh. Then 30,000 into 20, 6 lakhs. Then 6 lakhs. And the factor was 10%, right? So 0.909, 0.826, 0.751. So this comes to 363600. Right. 6 lakhs into 0.826, 495600. 450,600. Now just add the respective present value in the cumulative present value. Thus 10 lakh negative minus 363600, that gives us minus 636400 plus 495600, that gives us minus 140,800 plus 450,600, that gives us positive 309800. So this is what we have done. Cumulative present value means calculating the net present value at every stage. Net present value at the end of first year was negative 6364. At the end of second year was this. At the end of third year was this. We need NPV of 0, and we can clearly see that NPV of 0 comes between these two. One negative NPV and one positive NPV. Somewhere between this 2 years, NPV 0 is there. So we are going to interpolate the second and third year with these NPVs. Okay, how to do it? It's very simple. Put second year here, third year here. Now put negative 140,800 here and then 309800. Now understand the logic. If you increase the year by 1, your NPV is increasing by 140,800, 309800. Your NPV is increasing by 450,600, right? But you have to decrease the NPV and go to 0 only. That means you have to increase the NPV by only 14800, so that the negative becomes 0. Now put interpolation in effect. 2 years, you have to move ahead of 2 years. That's why add if you have to go back from 2 years, now you would have put negative sign there. Now write down 1 year of increment, or if we go straight away 1 year, if we operate for 1 year, the NPV increases by 450,600, but we only have to increase the NPV by 140,800. So how much years should be added? Not entirely 1, but how much? So it will be 2 plus 0.31. The answer is 2.31 years. So this is a point where NPV goes to 0. Therefore, sensitivity will be, earlier it was 3 years. If your project's life goes from 3 to 2.31 years, your NPV will decrease. That's perfectly 23%. 23% is the sensitivity of the project's life. Means if the project's life goes down by 23%, the NPV will go to 0. That's the answer. See, institute's answer is little, you might not get comfortable with that. See, 22.97 or 23%. You can follow ours. That's the best and easiest one. Instead of doing all these things, per day production, assuming a year of 360 and all, you don't have to do anything like this. 2 years, 2.31 years. Or we can say that if you have to calculate it in days, you can multiply 360 or 365 with 0.31 to calculate the days. That's around 112 days. Let's see if you see 112 days clearly. So this is how we have to do the question. Question number 19 is same. I am putting it for homework. This time you have the cost of the plant, recurring cost and savings as well. Give adverse impact of 10% in each and keep other factors constant while evaluating any one factor, and then you can calculate the sensitivity. So you can clearly see, first of all, we are calculating the NPV here, running cost savings, and then present value of cash outflow. So this is our NPV. Okay, then alternative solution. See, adversely, if you affect by 10%, you can easily calculate the new NPV, and then you can find out the change in NPV. This change in NPV, if you put 10 divided by this change in NPV, 10 divided by this, 10 divided by this, you will find out the sensitivity. I find the shock method quite easier than the previous one, because the previous one will requires a little bit of stress, you can say, but this method is very easy, giving a shock. Although the answer from all the methods will be same. This is the sensitivity. Okay, this percentage will not match with this percentage, because this percentage is the change in the factor, this percentage is the change in the NPV. If you have to calculate this one from this, then do the calculation. 10 divided by 20.35, 10 divided by 16.04, 10 divided by 46.40, and then you will arrive at this particular thing. Good enough. Question number 20. It's interesting question. Let's have a look on this. So let's have a look on this question. X Limited is considering its new project with the following details. You can see that the initial cost, capital cost is 400 crore. That is initial cash outflow. Annual unit sales is 5 crore. This is quantity. Okay. Selling price is 100. Variable cost is 50. That means 50 is the contribution. Then fixed cost per year is 50 crore. Discount rate is 6%. Okay, if we have to solve it, it is going to be like this. Selling price minus variable cost, 100 minus 50. 50 is the contribution per unit. Then you take the quantity of 5. Then your total contribution comes to 250. Then you deduct fixed cost of 50 crore out of it. Your cash flow after tax becomes 200 crore. Then you take present value annuity factor, and then you calculate the present value of cash inflow. Then you deduct the cash outflow 400 crore out of it, and you will be at NPV. Okay. See, no depreciation is there because depreciation as such is not useful to us. What is useful to us is the tax saving on depreciation, and no taxes has been given to us here. So if there is no tax rate, there is no use of depreciation. Tabulate the NPV of the project, and does it represent the actual outcome? No, sir. This does not represent the actual outcome, because actual outcome depends upon the actual scenario. First of all, let's calculate the NPV. See, this is 50 crore contribution per unit, 5 multiplied by 250 crore total contribution, fixed cost minus, then we have 200 crore annual cash inflow. We can multiply it with the present value annuity factor. Instead of doing this calculation 200, 200, 200, we can just multiply it with the annuity factor of 6%, and the inflow will come to the total of these three. Deduct 400 crore and you have the NPV. Then the answer is, NPV is there. NPV represents the most likely outcome and not the actual outcome, because all the factors are estimated and they are subject to change, and if any one of them changes, NPV will change. So it does not represent the actual outcome. First. Second, examine the impact of 2.5% adverse variance in each of the variable on the project's NPV. See, they have not used the word sensitivity in this part, but what they are asking us to calculate the sensitivity only. They are saying that how much percentage the NPV will change if we change every factor by 2.5% adversely at a time in each of the variable. So we have to change every factor. So let's first examine. Initial capital cost will get adversely affected if we increase it. Annual unit sales has to be decreased in order for the adverse impact. Selling price to be decreased, variable cost has to be increased, fixed cost to be increased, and the discount rate also has to increase. I don't know if they have taken the discount changes in the discount rate, but this is all you have to do. What you have to do is you have to calculate the NPV by changing each factor by 2.5% at a time. So you can just frame a table and have 6 different columns and just change one factor at a time by 2.5%. So if we change it adversely, just understand, if we change the annual capital cost 400 plus 2.5% means we have to take the capital cost 410 and keep all the other things same, calculate NPV then. Annual unit sales 5 crore minus 2.5%, that means you have to take the quantity as 4.875% separately, 8.75. Selling price 97.5 and variable cost add 2.5%, that is 51.25. Fixed cost 51.25 crore, and if the discount rate 6.15%, I don't think so discount rate has been taken. So decide which variable is having maximum effect. The variable which is changing the NPV by maximum percentage is called as the most sensitive factor. Okay, so let's have a look. See, the table is here and they have taken only 5 different things. They have not taken discount rate. You can do it. It's not a thumb rule that you cannot change the discount rate. So first of all, the basic NPV they have calculated in this manner, and you can see that in the very first part they changed initial capital cost. You can say the changed factor is here 410 crore. Rest of the items are same. You can see same, right? And then the new NPV is 124.60. We are going to compare the new NPV with the base NPV of 134.60 and calculate the percentage change. All the percentage changes will be negative. Why? I will tell you. NPV is going to fall in all the cases because we are adversely impacting all the factors. That means we are deliberately decreasing the NPV and finding out how much percentage change is there in the NPV. Okay, the next factor that we changed is the selling price. You can clearly see that selling price has been changed from 100 rupees to 97.50. Keeping all the other thing constant, we have calculated the new NPV which comes to 101.19, and then comparing it with the base NPV, we have calculated the percentage change. We have done this in all the other cases. This is the variable cost that has changed. This is the fixed cost that has changed, and Unit sold. This is the unit sold that has changed. Other things apart from what I have marked have been kept same. You have to change the variable one at a time only. And then we calculated the new NPV in all the cases and compared it with the base NPV and calculated the percentage change in NPV. Now, you can clearly see that the highest percentage change is here. That means selling price is the most sensitive factor. If you want to calculate the sensitivity, you just have to do 2.5%. Understand? 2.5 divided by this percentage change. 7.43, 24.82. You will get the NPV. You will get the sensitivity of those factor. This is not the sensitivity of the factor. Please understand. Sensitivity of the factor is nothing but the change in factor divided by the change in NPV. This is the change in NPV. That's it. So this was the entire answer. It is lengthy, but it's not difficult. So critically analyze the sensitivity analysis. This is the theoretical part. You can read and move on. Consider the life of the project as 3 years. So pretty easy. It was asked in RTP May 2024. Question number 21 and 22 are quite interesting question. Both the questions are different and are difficult and must do it. You must do it. Okay, let's have a question number 21. So have a look. Unnat Limited is considering investing 50 lakhs in a new machine. Okay, that is the investment outflow at time 0. Expected life of machine is 5 years and has no scrap value. Okay, it is expected that 2 lakh units will be produced and sold each year at a selling price of 30 rupees per unit, and the variable cost is 16.50 rupees per unit and a fixed cost of 10 lakh rupees per year. Whenever so many figures are given to you in a paragraph, make a habit of putting it on the paper so that it becomes easy for you to evaluate. So the first thing that I'm going to do, selling price 30, variable cost 16.50. So I can come up with 13.50 as a contribution. 2 lakhs is the unit. So 13.50 into 2, that is 27 lakh is the contribution, total contribution, right? Apart from that, there is a fixed cost of 10 lakhs. So profit before tax is 17 lakhs. Do we have a tax rate in this question? If yes, then we can use the depreciation as well. Otherwise, we will not. Okay, I don't think so. We have any tax rate, but let's move ahead. The cost of capital is 12% and the acceptable level of risk is 20%. I will talk about it in a moment. You are required to measure the sensitivity of the project's NPV value to a change in the following project's variable. Whenever you have to calculate the sensitivity, first remember to calculate the NPV. So this is 17 lakhs. Right. Let's calculate the NPV. See, 27 lakhs minus 10, 17 lakhs multiplied by 3.605, calculated with 12% for 5 years, annuity factor. And then we have this NPV. 50 lakhs is the total outflow. Okay, we have the NPV now, and now we will calculate the sensitivity. There are two ways to calculate the sensitivity. Take X for this and calculate NPV to 0 and find out how much this particular factor is changing. So that will be your sensitivity. Sale price, sales volume, variable cost. So I think you can apply the first method here. What you have to do is you have to repeat it 3 times. You can put X in place of 30 and calculate everything putting NPV to 0. You will get a new selling price. Then keep 30 as it is and put X as variable cost. The second item, variable cost. And in the third part, you can put quantity as X. That's it. So 3 times you have to calculate 3 different values. So here the selling price comes down to 28.43 from 30 rupees. The change is 5.23%. This is called as sensitivity. Variable cost is coming to how much? They have not. Acha, volume. Volume is coming down from 2 lakhs to 176,812. If it comes down from 2 lakh to 176,812, the change in the sales volume is 11.59%, which is bringing NPV to 0, and the change in variable cost is 18.07. If it goes to how much? 13.5. From 13.5 to 16.5 or 16.5. Okay. If it goes to 18.07 from 16.50, then the NPV will be 0. So we have 3 different percentages. This type of question has been, we are okay with it because we have been doing it since last couple of questions. Till now, it has been easier for you. You just have to calculate at what particular value the NPV comes to 0 and find out the change in that value, which becomes the sensitivity. The major reason of taking up this question is the D part. Have a look on this. On further investigation, it is found that there is a significant chance that the expected sales volume of 2 lakh units per year will not be achieved. The sales manager of Unnat Limited suggests that the sales volume could depend on the expected economic states, which could be assigned the following probability. So, we are expecting that the economy can be poor or normal or good, and accordingly the annual units that we are going to sell can be 175, 2 lakhs or 225, and the probability is also given to you 30, 60 or 10. What is the question now? Calculate the expected NPV of the project and give your decision whether the company should accept the project or not. Let me just give you a hint. It's very easy to calculate the expected NPV. I will tell you how. Multiply the quantity. Understand? Multiply the quantity with the probability, you will arrive at one quantity. Put that quantity in this entire equation in place of 2 lakhs because that is the expected value, expected quantity. Have a look on the answer. So the expected quantity that you are expecting is 2,25,000 after multiplying with the probability and totaling it. This is the contribution per unit. Quantity multiplied by contribution minus fixed cost will give you the cash flow per year. This is the annuity factor. This is the cost outflow, and this is NPV. NPV is coming to positive and you will decide that we should accept the project. But there is one sentence in the question which has changed everything you have learned till now. I will tell you. NPV is coming positive and we should have accepted the project, but still we are rejecting the project, and I will tell you why. Understand that our acceptable level of risk is 20%. I told you that I'm going to talk about it in a moment. Acceptable level of risk is 20%. What does that mean? That max to max 20% chances of NPV going to 0 or negative can be affordable. That means 80% chances has to be there that the NPV will be positive. But understand that we have already calculated the sensitivity of the volume. Go through it. And you will find that if the volume goes down to 176,812 units, the NPV will be 0. Means a single unit, now if you reduce the single unit out of this, now NPV will go to 0. So remember this number 176, 1,76,000. And now come to the table and you will see that the first unit is giving us the first probability is of 1,75,000 units. It is very much clear that at this much of the units, NPV will be 0 because 176 is the bare minimum below which NPV will be 0, and this is the below number. So NPV will be negative on this side and the chances of negative NPV is 30%. We cannot afford more than 20% chances of negative NPV. That's what the question is saying, that we can accept only 20% level of risk. That means 80% has to be the chances that the NPV will be positive, but in this table 30 and 70% are the chances. 30% are the chances that the NPV will be negative and 70% are the chances that the NPV will be positive. Tell me, are you still going to accept the project? No, because it is not under your acceptable level of risk. Although the expected NPV is positive, but the level of risk has been crossed here, which you cannot afford. Right? That's it. This is why you should not accept the project. So all the people who are going to say that we should accept the project will get 0 marks in this case if they miss out on this acceptable level of risk. That was the question. Come over to question number 22 now. Now this is an interesting question. The easygoing company limited is considering a new project with initial investment. This question, why I have kept this question for the end is that this is the most difficult out of all the questions that you have seen till now on sensitivity analysis. Plus this is based on the reverse calculation method which the institute generally has started asking basically. So have a look. The easygoing company limited is considering a new project with the initial investment for a product called as survival. The name of the product is survival. It is estimated that the IRR of the project is 16%. Tell me, what is IRR? Where the NPV is 0. So how to calculate the sensitivity in the discount rate? Calculating the IRR. That 16% is already the rate which has been calculated where NPV is 0. But they did not give us the actual cost of capital with which NPV would have been calculated. Having an estimated life of 5 years. Okay. Now, financial manager has studied that project with sensitivity analysis and informed that annual fixed cost sensitivity is 7.8416%, whereas the cost of capital sensitivity is 60%. They did not give you the cost of capital but its sensitivity. They did not give you the fixed cost but its sensitivity. Other information is profit volume ratio 70%, that means variable cost ratio is 30%. Variable cost is 60, annual cash inflow is 57,500, ignore depreciation on initial investment and impact of taxation. If they would have given this now, the question would have been more complicated. Now you have to calculate more things. Initial investment, NPV, annual fixed cost, estimated annual units of sales, break-even units where profit becomes 0. Now let's do some working. Question number 22. See, how do you calculate the sensitivity in cost of capital? IRR minus cost of capital divided by the cost of capital. And if you want a proper reason for this formula, then it's very simple. Change in base value, that means cost of capital, divided by base value, that is cost of capital. This is the basic formula for sensitivity. But in case of cost of capital or the discount rate, change in base means IRR minus cost of capital. Now, this is 0.60 which is given to you, 60%. IRR is 16%, cost of capital is X and X. Now you can calculate the cost of capital. It's very simple. So, X 0.60x, just a second, 0.60x is equal to 16 minus x. I can say that 1.60x is equal to 16 and x is equal to 10%. This is your original cost of capital, right? Now, annual, or we can say variable cost given to you is 60 rupees. Okay. Understand that selling price minus variable cost is equal to contribution. So this contribution is called as profit volume ratio, which is 70%. And if this is 100%, then variable cost ratio will be 30%, which is given to you as 60. So if you divide 60 by 30%, you will get the 100% amount, that is selling price. 60 divided by 30%, that is 200 or 180, 200. Okay. Now, annual cash flow is 57,500. Cost of capital is 10%. Life is 5 years. This is the basic information till now achieved by us using this much of the information. Still a lot of information is pending. Now first I'm going to use the IRR. So at IRR, this is the first answer, NPV is equal to 0, isn't it? So let's calculate the NPV. present value of cash inflow minus present value of cash outflow should be equal to 0. How do we calculate the present value of cash inflow? Annual cash flow multiplied by present value annuity factor at 10%, not 10%. At IRR means 16% for 5 years minus initial investment should be equal to 0. Annual cash flow is 57,500, and if you take 16% as the annuity factor, then 3.274 minus initial investment should be equal to 0. So your initial investment comes down to 188,255. Isn't it good? Now we can calculate the actual NPV by taking the actual cost of capital. NPV is equal to same thing, 57,500 multiplied by the actual cost of capital is 10%. For 5 years the annuity factor will be 3.791 and the initial investment is now known to us, 188,255. Let me just calculate it once again. 3.274, right. 188,255. 57,500, 3.791 minus 188,255. The NPV comes down to 29,728. This is your second answer. See, this is over now. 188,255. NPV is also there, 29,728. 727.50. Okay, the biggest part of this question is to calculate the annual fixed cost and understand that the annual fixed cost sensitivity is given to us, right? Now you have to tell me that how much the fixed cost will change to bring NPV to 0. So again, putting it this way, understand sensitivity of fixed cost is equal to change in fixed cost, which brings NPV to 0, divided by fixed cost. Now in this question we know the sensitivity of fixed cost as 7.8416%, that means 0.078416. We do not know the change in fixed cost and the fixed cost, so we will keep the data like this. Now, what do you mean by change in fixed cost at sensitivity? It means the change which brings NPV to 0. So what we have to do is first find out the change in fixed cost. Have a look. NPV has to be 0. How do we find out the annual cash flow? It's very simple. Selling price minus variable cost into quantity, this is the contribution, minus fixed cost, right? And then we multiply this entire annual cash inflow with the present value annuity factor minus initial investment. So I will get to know how much is the change in the fixed cost required to bring NPV to 0 by just calculating the change in the annual cash inflow, 57,500, because all this entire figure is called as 57,500. I just have to find out this annual cash inflow which brings the NPV to 0. So let's do it first. I will put this as A and then find out, multiplied by the 3.791 as the annuity factor and 188,255, right? NPV 0. So now you can clearly see the annuity required for NPV to be 0 is 188,255 is divided by 3.791, 49,658. 8. Earlier the cash inflow was 57,500. Now understand that if you increase this fixed cost, this annual cash inflow will decrease. And to what extent it has to be it has to decrease is like 49,658 it has to reach. So we can calculate the difference between these two cash flows so that it almost means it becomes the change in the fixed cost or the increase in the fixed cost. So let's find out. Therefore, change in annual cash flow, or this also becomes change in annual fixed cost, is equal to 57,500 minus 49,658, and that is 7,842. This much of the annual cash flow should get reduced, and it is only possible by increasing the fixed cost. So 7,842. Let's keep it 7,842. And let's keep this x. Now we can calculate the original fixed cost. X is equal to 7,842 divided by 0.078416. That's 1 lakh 5 rupees, rounded it off to 1 lakh. This is how you have to apply your brains, from where we have to pick the figures. We wanted actual fixed cost. For that, we wanted change in fixed cost. For that, we had to calculate change in annual cash inflow. For that, we have to use the sensitivity. This is how you should go. And if you can do it, or if you could do it by your own, then you are good at this concept. Okay, next concept is the estimated annual units of sales. It's very simple. You have to calculate the quantity by keeping all the factors. You can keep the existing NPV. You have the selling price and the variable cost as well. You have the fixed cost now as well. So let me find it out. Fourth factor. NPV is 29,728. Selling price 200 minus variable cost 60 multiplied by the quantity minus fixed cost 1 lakh, and then this is going to be annual cash inflow. So 3.791 minus 188,255. You just have to calculate the quantity in this. So 29,728 plus 188,255 divided by 3.719 plus 1 lakh divided by 140. So quantity will be 1133. Let's see if it is correct or not. There will be some rounding of differences. 1125. Let me check once. 260, 140. 50. We can equate this to 57,500 as well. Instead of doing this, we can make it shorter. I just forgot that. But this answer also has to come proper, na? 29,728. Let me see if what is there. 29,727, na? So 29,728 plus 188,255 divided by 3.791 plus 1 lakh divided by 140. Yes, 11. This method is also right. It was just the calculation error. So this is 1125. Or else you can calculate it like this. 57,500 is equal to 140 quantity minus 1 lakh. This will also give the quantity as 1125. Right. Acha, what is the next part? The last part of this question is the break-even units, where your annual cash flow will be equal to 1 lakh. Annual cash flow means your profit will be equal to the fixed cost, so that the annual cash flow will become automatically 0. So it can be easily equated with the fixed cost 1 lakh. See how to do it. Fifth part. They are asking us break even sales. Means quantity at which contribution is equals to fixed cost. The contribution to cover up the fixed cost. That is the break even, where you are not earning profit and not incurring losses. Therefore, fixed cost is equal to 140 is the contribution into quantity. So quantity is equal to 1 lakh is what we have to recover by this much of the contribution. So we have to sell around 714 units to break even. More than this is our profit. This is the break even position for fixed cost, not the initial investment, for fixed cost. Have a look, this 714.285. I hope this question has been easier on you because this was a difficult, we can say the most difficult out of all the sensitivity type of questions. So with this we end our sensitivity analysis question. Coming over to the concept sheet. Just a second. What we have done till now, we have covered all these concepts. And is there anything here? No. So till now we have covered up till this point. I have asked for all these questions to be leave this question, put these 2 questions as homework. We have done these 2 questions in class and we have reached till this point. So 1, 2, 3, 4 and 5 questions are remaining here, and the questions from 23 to 34 are remaining here. So 23 to 34 are around 11 questions, I think so, and 4 5 questions. So I think around 2 hours maximum we should take to cover up. Within 2 hours also we can complete this, but yes. So let's take a break and I will be back with a new concept, and again this is going to be interesting part. We will go with the easier ones. We have covered the sensitivity analysis also. Now what is left is the simulation analysis. There is one question only on this. Scenario analysis we have already done. Joint probability and the decision tree analysis is going to be after the simulation analysis, and then we are going to come over to one of the most important topic of this chapter, which is equated annual cost and replacement analysis. That's it. The last two concepts are pretty easy. So see you after the break. So welcome back after this break, and now is the time to focus on one new concept that is called as simulation analysis. So basically this is a theoretical concept, very less importance of this is there in the syllabus. So we are going to take one question and discuss it, understand it and move away. Let's have a look. In your concept sheet, you can see that there is only one question number 43 on simulation analysis, taken from the institute's study material exactly. But I have made some changes because the institute's question was little weird. I have kept the figures same, but have changed a little bit to make it understandable. 43, right? Let's have a look. So how to do the simulation analysis question, I will tell you. It's all depending upon the random numbers, and I will tell you the procedure for that. Let's have a look on the question. A company in India is evaluating a project costing 1,30,000 using simulation analysis. They are evaluating a project using simulation analysis to account for uncertainties in the project's annual cash flow and the project life. So they are okay with all the other factors but two. What are those two factors? Annual cash flow and the project's life. They are not sure about it. So there are multiple possibilities of both of these factors called as annual cash flow and project life. So we have been given the data for the same. You can clearly see in the table in the very first part, the annual cash flow, the value and the probability of them is given. And the project life can be from 3 years to 10 years, anything is possible, and the probability of that is also given to you. Now you can see that the random numbers are given for 10 simulation runs. Simulation means virtually you are creating an environment for real event. So this type of simulation word is mostly used in the aircraft training, pilot training basically. So when they have to give you the training, they cannot take you to the plane and allow you to fly just for a training purpose. So first they will give you the simulator. Simulator is an environment where you will be put in a room or some kind of environment where you will feel that you are actually flying the plane. So that's called as simulation. Okay, so these are the simulation numbers. I will just tell you more about it later on. And there are 10 runs, 10 times you are going to try. So basically this is going to be random trials. Okay, so there will be two boxes. In these two boxes, 1 to 100 numbers will be there. The chits will be there. Let's say for example the chits are there 1 to 100, and in this also 1 to 100. Now this is the box for annual cash inflow, this is the box for life. What you are going to do every time, 10 times you are going to try, you are going to put your hands in both the bowls and you are going to pick one chit, and there will be number written on it, and that number comes to 53 in cash flow and 97 in project life, and 66 in cash flow, 99 in project life. And this way you are going to try it for 10 times. Calculate the NPV of for each simulation and take 10% as the discount rate. Now the very first thing that you have to do is, first you have to write down this table. Write down the value column, write down the probability column, and next to the probability you have to write down the cumulative probability column. So how it is going to be, I will just show you. Imagine this is the third column, cumulative probability. So this is 0.02. For the first part it is 0.02 only. For the second part you are going to sum it up, 0.02 plus 0.03, 0.05. For the third value you will add 0.15 in the cumulative probability that you have already calculated in the previous part, 0.05. So 0.15 and 0.05 is 0.20, and this way you are going to add it. That is why it is called as cumulative. 0.15, 0.20 plus 15 to 0.35, and then this is 0.65, this is 0.85, and this is 100%, right? 1.00. So this is the cumulative probability, and with the help of this you are going to generate random numbers. So you are going to not random number, we will call it as range of random numbers. How to write down the name range? It's very simple. It will start from 00 to 01. Because 2 is there, you are not going to extend the range till the end. You are going to keep the possibility of we can say that any event in this world is not 100% sure. You have to keep the possibility of not happening of that event. So at any point of time, any event in the world is only 99% sure. We have to keep that 1% away from so that we can keep the risk of that event maintained. So the next range will start from 02. After this 01, the 2 will come, and we will stop it till 04. You should not bring 0.05 or 05 in the range. The last part, the last number will be left out, so that we can say that only 99% probability is there, 1% is risk. We will start it from 05 to 19. So you can see that I'm not taking the last number, I'm keeping that aside. It will start from 20 to 34. How did I start with 20? It depends upon the 19th. After 19th, I will start it from 20. So these are the range that I'm keeping in line. So this will start with 35 till 64, 65 till 84, and 85 till 99. So that the major reason is no event is 100% sure, and that's why 100 cannot be the number. So in the two bowls that I just said, you will not put, understand, you will not put the last number, only 99 chits will be there. Just to make sure that 1% risk is incorporated, you are saying that 1% is still impossible, 1% chance of risk is still there. Any event can be max to max 99% sure. Now this is the range. Okay, you are going to do the same with the project life. You have to calculate, you have to write down the cumulative probability for the project's life and range for the project's life. Now you will have two column for the ranges, and you have to find out these values in that range and take those cash flow and life. Have a look now what we have done. So the very first thing that we did was value, probability, then cumulative probability. You can see 0 2, then 0 5, 3 plus 2 5, 15 plus 5 20, and so on. And then we started with the range. This is the range. This is all for the annual cash inflow. We did the same thing for the life of the project in the in the last 4 columns. Now we are going to pick the random number. Understand, the first random number or the first run is 53 for cash flow, 97 for project's life. So find out these two numbers. 53 comes in between, right? So the cash flow will be 30,000, and 97 is for the project's life, which comes in this range. So our life of the project will be 9 years. So for the first calculation of the net present value, you have to take 30,000 annual cash inflow and 9 years of life. See, 30,000 annual cash flow and 9 years of life. Based on the 9 years, you are going to take the present value annuity factor of 10% and then multiply this present value annuity factor with the annual cash inflow to arrive at the present value of cash inflow. And this is going to be present value of cash outflow. How much is the total investment of the project? It is costing 1,30,000. If you don't have this 1,30,000 written in your question, write it down, because by printing mistake, it was because of the printing mistake, it did not print, it was not printed earlier in the earlier books. So make sure that you are writing it or making the correction. So this is the cash inflow and then this is the NPV. That's it. You are now going to pick the second random numbers. The second time you are going to try, the numbers are 66 and 99. 66. Find out 66. Let's do it with a different color. 66. 66 is in this range. So our cash flow will be 35,000 and 99 is in this range. Our life of the year will be 10. So see, 35,000 life of the project is 10. Now with 10% factor and 10 years of life, calculate the annuity factor, multiply it with the 35,000. This is going to be present value of cash inflow minus outflow. This is NPV. So this way you are going to calculate 10 different NPVs. Okay, understood? Now you have the 10 different NPVs with the 10 different simulations. That's it. This is the end. Question was asking you to calculate NPV of every simulation, every run. Let's say the probability is also given now. If the probabilities are given, what you can do is you can multiply with the probability, joint probability we call it, and then reach out at one expected NPV. So what is the best case NPV in this case? The best case is 85,075, I think, this one, and the worst case is minus 66,600. Yes. So this is all the concept of simulation. I will just show you. See, so these are the steps that you have to remember while solving the questions of simulation. First, calculate the cumulative probability, then generate the range of a random numbers, keeping the last number away from that range, not including that last number in the range. Then find the random numbers in this range. Use the corresponding variables of cash flows, life of the project, and then calculate the NPV based on this. This process is so simple. Now you know how to calculate the NPV. So the entire process was to find out what cash flow we should take and what project's life we should take. That's it. Nothing else. So this is all about the simulation analysis, and we are done with question number 43. Now is the time to discuss about the new concept again, which is decision tree analysis. We are done with the simulation and scenario. Scenario analysis was the one where we had a worst outcome, best outcome, probability of worst outcome, dependent, independent cash flow. That question was on scenario analysis itself. So before moving over to the major part, we have one more concept to cover, that is joint probability and decision tree analysis. Let's have a look at the question. With the question itself, we are going to discuss this thing. So this is going to be the question number 23 for us. See, a firm has an investment proposal requiring an outlay of 80,000. You can invest 80,000 now. The investment proposal is expected to have 2 years of economic life with no salvage value. Okay. In year 1, there is a 40% probability that the cash inflow, you can see here. In year 1, there is a 40% probability that the cash inflow will be 50,000 and 60% probability that the cash flow will be 60,000. So for year 1, there are only 2 cash flows, but the second year cash flows are dependent on the first year cash flows. And you can clearly see that if the first year cash flow is 50,000, the probability of which is 40%, the second year cash flow can be any one of these 3. And the probability of these 3 are also given to you. But in the first year, if the cash flow goes to 60,000, the probability of which is 60%, the second year cash flow will be little different. And the probability of that is also given to you. Okay, cool. The firm uses 10% as the discount rate for this type of investment. You have to construct a decision tree for the proposed investment project and calculate the expected NPV. Drawing the decision tree is very simple, sir. You can clearly see here that first we are going to invest 80,000. Then in the first year, there are 2 possibilities of 50,000 or 60,000 of the cash flow. But depending upon that first year, there will be 3 possibilities coming out from this and 3 possibilities coming out from this. So all in all, we can say that for year 1 and 2, there are 6 different possibilities. 6 different possibilities, and the cash flows can be like this. See, I will write down 1, 2, 3, 4, 5, 6. Year 1, year 2. The cash flow can be 50, 50, 50, 60, 60, 60. And 24, 32, 44. So 24, 32, 44 and 40, 50, 60. 40, 50, 60. So there are 6 different ways. Therefore, there will be 6 different NPVs. What you have to do is simple. You have to take the present value of this. 10% is the rate. For the first year, apply 0.909. For the second year, apply 0.826. Calculate the present value for the first and second year here. Then total it. This is the cash inflows total. Reduce 80,000 of the cash outflow, first year, investment outflow. And then you will be reaching at 6 different NPVs. Now comes the point of joint probability. I will just first show you the diagram, the decision tree. So this is where you are going to invest, and then you will see that in the first year you can have these cash flows 50,000, 60,000, the probability of which is 0.4 and 0.6. But in the second year, the cash flows are dependent of the first year, and the probabilities of that is 20, 30, 50. I will just write it down. 20, 30, 50 and 40, 51. 40, 50 and 0.1. So this is the second year's cash flow. So there are 6 different possibilities. Now, let me ask you one question. What is the probability that the cash flow in the first year will be 50,000? You will say 40%, right? What is the probability that the cash flow in the second year will be 24,000? You will say 20%, right? Now, what is the probability that the cash flow in the first year is 50,000 and the second year is 24,000? You cannot say 40, you cannot say 20, because I am asking the question where I am asking the probability of both the years cash flows. That the first year it has to be 50 and the second year it has to be 24,000. If I ask you the probability of any one year, you can easily answer it by looking at these numbers. But if I ask you the probability of both the years, you will have to first calculate the joint probability. and it all depends upon multiplying the first year probability with the second year probability. 0.4 into 0.2, 0.4 into 0.3, 0.4 into 0.5. Basically, you are dividing the 40% of the probability in three different probabilities. So this will be, you can reach out to these numbers. 0.4 into 0.2, that is 0.08. 0.4 into 0.3, that is 0.12. 0.4 into 0.5, that is 0.20. If you do the total of these three now, it comes to 40%. That means you have divided the first year's probability in three different ways. And now you can say that 8%, see, this is 8% first probability. 8% is the probability that the cash flow in the first year will be 50,000 and the second year will be 24,000. Then 12% is the probability that the cash flow will be 50,000 in the first year and 32,000 in the second year. This is called as joint probability. Now, since you have arrived at the 6 different NPVs, you can easily multiply those NPVs with the joint probability. The total of the probability has to be 1. It cannot be more than 1 or less than 1. Getting it? So, next we are calculating the year 1 cash flows, year 2 cash flows. See, 50,000 into 0.909, 45,450. Then 24 into 0.826, 19,824. This is the cash inflow. This is the outflow. This is the probability. NPV, negative NPV. And in this way, we are going to calculate 6 different NPVs for 6 different possibilities. So you can clearly see that 45,450 has been taken over for 3 times and 954,540 has been taken for 3 times again. So 3 and 3, 6. Okay. This is done. Now you have 6 different NPVs. What is the question asking you again? So they asked us to construct a decision tree for the proposed investment project and calculate the expected NPV. We did it. Expected NPV. See, how to calculate the expected NPV? By multiplying it with the joint probability. So you use these 6 NPVs that you have calculated with the joint probability to arrive at the expected NPV. This is the answer for the first part. Next, what net present value will the project yield if worst outcome is realized and the probability of occurrence of this? See, the worst outcome is this one, the first one, and the probability is 8% on this. Probability means the joint probability. Simple. Worst outcomes means the worst NPV. In the next part, they are asking the best outcome and the probability of it. So we can clearly say that the best outcome is this and the probability is 6%. Very simple. Then, what will the project be accepted? Yes, because the project's NPV is positive. So this and the probability accepted because it has a positive NPV. Simple. Change these numbers. It has to be 1, 2, 3, 4, not 4, 5, 6, 7, 8. So this was all about the decision tree. I hope you understood the concept of joint probability. Joint probability is nothing but when we calculate or when we have to calculate the probability of both the years. So if there are 3 years, we are going to multiply it 3 times and there will be n number of possibilities. Okay. So let's take a break and we will switch over to new concept of equated annual cost. You are going to enjoy this. I'm going to discuss this in detail with you. So welcome back after this break, and now we are going to discuss and move over to the last topic of the capital budgeting. The first topic is equated annual cost, and let's have a look at it. Equated annual cost is nothing but, please understand, you have learned this concept but in a different manner. This concept was already discussed by us in the first lecture of time value of money. If you remember, we had a discussion on present value of annuity. In that, there was one concept called as annuity. What is annuity? A cash flow, a similar cash flow which occurs for more than 2 times, like more than 1 time. For 2 years, 3 years, 4 years or 5 years, the cash flow is same. That is called as annuity. And that is the same thing, equated annual cost. Now, I will explain the same thing in a different manner once again. Let's have a look over the concept using some practical application of it. So let's say that I'm investing in a project and I'm going to have some cash inflows after the investment. Those cash inflows are for 5 years. The first inflow is 50. Second year I'm going to receive 100. Third year it's 140, 170 and 48. While calculating the net present value, what exactly we do is we take the present value factor. Let's say the present value factor is calculated using 10% discount rate. Accordingly, our present value factor will be 0.909, 0.826, 0.751, 683 and 621. We are going to multiply the present value factor with the cash inflow and arrive at or reach at these present values. So these are the 5 present values of the 5-year cash flows that we are going to receive. And if we do the total of it, we are going to call it as present value of cash inflow, that is 379. Now hold yourself and let's assume that the investment is 300. Okay, inflow is 379, investment is 300. You can easily calculate the NPV. Now this concept is not about the NPV. My question now to you is, this is 379. Now take another example where you invest in a project and you receive 100 rupees equally for all the 5 years. So what is the difference in the first example and the second example that I just gave you? The major difference is the cash flows are different in the first example but are same in the second example. But you will notice something. You can also calculate the present value of this particular thing by using the present value of annuity function. Annuity multiplied by present value annuity factor. What is the present value annuity factor? It is going to be 3.791, which means the total of all these 5. So if you multiply 100 with 3.791, the answer will be 379. See, the same answer. Now can I conclude something? I can conclude that if I'm receiving this cash flow or this cash flow, the answer is same, which is 379 in terms of present value. So can I conclude one more thing? That I can have an equally annual cost for the variable cost that has been given to me in the question. If the question is giving me different cash flows for all the 5 years, I can calculate the equated annual cash flow to replace these different cash flows. And how to do that? It's very simple. You calculate the present value of those different cash flows, which comes to 379. Then you divide it with the present value annuity factor of 5 years and you will reach at the annuity. That annuity itself is called as the equated annual cost. In the previous lecture, you learned about this concept of calculating present value of annuity is equal to annuity into present value annuity factor. This annuity itself is called as equated annual cost. So what will be the formula for equated annual cost or annuity? It's very simple. Present value of annuity divided by present value annuity factor, which means 379 divided by 3.791. Am I right? Okay. So all in all, what I want to say or conclude is that we can have similar cash flows for all the year and still reach at the same conclusion. We can calculate the equated annual cost. Why it is called as equated? Because the cash flows are same. Annual means the cash flows are annual. If it is inflow, we will call it as equated annual benefit. And if it is outflow, we will call it as equated annual cost. That's it. Simple. And why we are learning this concept, I will explain this when we will take one example. But all in all, have you understood the concept? I will summarize the concept in a simple manner by saying that if the cash flows are different for all the years, we can calculate the equated annual cost by simply calculating the present value of those different cash flows and dividing it with the annuity factor to arrive at the equated annual cost. And in fact, this is the same formula to calculate EMI on your loan. If your loan amount is 379 rupees and you have to pay 10% interest for 5 years, then the principal plus interest included EMI comes to 100 rupees per year. So when you pay 100 rupees per year, it includes the principal repayment and interest of 10%. That's the same formula for the calculation of EMI. So same formula for the calculation of EMI, same formula for the calculation of annuity, same formula for the calculation of equated annual cost. Now let's have a look on the question first. And you will understand with the help of this question that why the concept of equated annual cost is required. I will start with a simple example you have in front of us. Let's have a look. Company X is forced to choose between two machines A and B. So there are two alternatives with the company that they can select machine A or machine B. The two machines are designed differently but have identical capacity. The designing of both the machines are different, but they produce the same number of units. The capacity is same and does exactly the same job. Machine A costs 150 lakhs, 1,50,000 and it will last for 3 years and it will cost 40,000 rupees per year to run. Let's have a look. This is question number 24. So this is machine A. It will cost you 150 lakhs, 1,50,000 and how much to run? 40,000 to run every year. Now understand what I'm doing. This timeline will explain everything. And there is another machine called as machine B. It is of economy model and it will cost only 1 lakh but will run for 2 years. And the annual cost of running the machine is 60,000. Okay, these are real cash flows. See, real here doesn't mean that inflation has to be included because there is no information regarding the inflation. So that's why we are going to ignore that real word. Cost of capital is 10%, which machine to buy. See, we can discount these cash flows with the 10% discount rate. Let's say you are doing it. These are already on present value, 1,50,000 and 1 lakh. You can calculate the present value of this and the present value of this. Let's say that, let's do it. I think it's better to calculate it. So first of all, this is machine A, B. Initial cost, I will write down 1,50,000. All are cash outflows only, so that's why I'm writing it in positive. These are already on present value, so I will take running cost directly. 40,000 per annum and 60,000 per annum. These are annuities, right? And I will take present value annuity factor for 3 years of 10%. 2.487 and 1.736. Multiply and take the present value of the running cost so that all the cash flows are at 0 time. 40,000 into 2.487 comes to 99,480 comes to 104,160. Okay, so let's name these things. This is A and this is B. Now we can say total present value of cost. Just add 1,50,000 and 99,480. So this is the present value of machine A including all the cost, and this is 204,160. Now you tell me, both the machines are now comparable. Is it comparable? No, first of all. But these are the present values. Both the machine are having the present value. We have calculated the present value of total cost machine A and machine B. 249 and 204. Which machine you should buy? Any rational person will say that machine B is feasible because it is costing us less. But you are forgetting one thing. First of all, these two cash flows are not comparable. Even though both are having the same time, that is time 0, but this cash flow, this figure includes 3 years cash flows, and this figure includes only 2 years cash flows. Because 1 year is less in machine B, obviously the cost will be less. How you can compare these two? You cannot compare because the life of these cash flows are different. The life also has to be same in order to make them comparable, and this is when the equated annual cost comes into picture. Understand that you are running a business and you are not going to quit or shut down your business after 3 years or 2 years. What will happen if you choose this machine? What will happen after 3 years is you are going to repeat this machine with the same cash flows and same cost. This is general assumption. What will happen if you choose machine B? That you are going to repeat this machine B with the same cash flow, same cost, same life. So this will go on for lifelong, like 20 years, 30 years or 60 years, till the time you are running the business. So don't stop yourself till 3 years or 2 years. Just imagine what is going to happen for long term. It is going to repeat. That is going to be the assumption. In order to make these two cash flows comparable, we have to first of all make the base, means the life of both the options, same. And this is when we calculate the equated annual cost. Equated annual cost is very simple. Total present value divided by the present value annuity factor, you will get the equated annual cost. In the similar manner, when you multiply the annuity with annuity factor, you will get the total present value of the annuity. We are just reversing the calculation. Now at this point you are going to write down like this and then calculate the annual cost of running the machine for long period comes to 1,00314 and 204,160 divided by 117,604. Now understand, what is this? This is annual cost of running each machine. Which option will you choose? Option 1. Machine A should be selected because the cost is less in that. It's not benefit, it's cost. Equated annual cost is lesser in machine A. If you would not have calculated this now, you would have taken decision to choose machine B, and that would have been wrong because it includes only 2 years cash flows. This includes 3 years cash flows. Simple. So writing machine A's cash flows like this, or simply 1,00314 is one and the same thing. So all these cash flows, including the investment, are included in these annual cost. Understood? What you just did is like you calculated the present value of all this. So you brought all the cash flows to 0 time, and after dividing it with the present value annuity factor, you brought back to the year end all the cash flows. Now you can say that you might have a question that 40,000 out of the total was already on that point. We could have done one more thing, sir, that we could have just calculated the EAC of this figure and added 40,000 to it. Trust me, that is going to be the right answer. It is going to give you 1,003,4,314 only, and that will save your time. See, ultimately our purpose is to calculate the annual cost. Annual means year ending cost. If 40,000 is already at year ending, why to first take the present value of those and then again shift it to the year ending? It's going to result in the same thing. If you discount a cash flow by 10% and again take it forward by 10%, it will result into the same thing. So if you understood the concept of equated annual cost, you could have done it alternatively, and the alternative way is to calculate the annual cost of just 1,50,000, means break it down into 3 years and shift it till the year end. and add it to 40,000, you will get 1,00314. Okay, so this is how we have to go. We can do the same thing in this as well. We can say that 117604 is the annual cost of running machine B, and it doesn't last only for 2 years. After 2 years also we are going to repeat the same machine, so the cost will remain same. The timing will also differ, but the cost, that 117604, will remain same. Now you decide annually you are going to run the machine, and which machine is preferable. Machine A is going to be helpful to you in this case. So this is the answer, 1,00338, 1,00314. That's because of the rounding of difference. So machine A is preferable. Understood the concept of equated annual cost? In a simple manner, it is useful when the life of the two options that you have are not same. You cannot take the decision based on the present value only. You have to calculate the equated cost so that you can make those cash flows comparable. Okay, let's have a look on question number 25 now. It's easy. Again, ABC Chemical is evaluating two alternative systems for waste disposal, System A and System B, which have lives of 6 years and 4 years respectively. So when you read the question and you understand that the life is different, you automatically should get into this, like get this thing into your knowledge, that even if you calculate the present value of all the years, cash flows of all the years, and you arrive at two figures, both of them will not be comparable, because one will have 6 years in its cash flows and one will have 4 years in its cash flows. That's when you have to convert the total into annual cost. 6 years cash flows is there, you divide it with the present value annuity factor of 6 years. 4 years cash flow should be divided with the present value annuity factor of 4 years. Then you will come up with two different figures that will be called as annual cost. 1 year cost of running both the system A, System B. So have a look. Initial investment is given to you, annual operating cost is given to you, salvage value is given to you. Okay. If the hurdle rate is 15%, which system should ABC Chemicals choose? The present value factor is 15% and the details are given to you here. Okay. Now you should understand that what exactly we have to do. If we take 6 years here and we calculate all the present values, after present value we are going to calculate the present value, then we are going to divide it with the present value annuity factor, then we will reach at equated annual cost. That means we are shifting back all the cash flows to year end. So one thing that you can do is avoid this cash flow in your calculation and add it at the end, because these operating costs are already at year end. So you can just calculate the present value of these two only and convert them into annual cost cash flow and add the annual operating cost in it. So I'm going to do it. In this question, what they did, I will tell you. This is the initial outflow. This is already at 0 time. What they did is they calculated the present value of annual operating cost as well. For 6 years, every year 15 lakh is going to be the cost. They multiplied it with the 6-year annual annuity factor, and this is the present value. So this is initial cash flow. This is operating cash flow. This is terminal cash flow, means salvage values, present value, 10 lakh multiplied by 0.4323. So this is going to be your present value of total cost. But this is of 6 years. You are going to do the same thing in System B to arrive at 82,82,100, but this is of 4 years. You cannot compare both. You could have ended your answer here itself if the life of both the system would have been same, like 5 years, 6 years, 4 years. Because the life is not same, you are going to extend your calculation to calculate the equated annual cost, and that is simple. Divide it with the present value annuity factor of respective years to arrive at the equated annual cost. First of all, so you can clearly see that Annual cost of running system A is lesser than system B. And that's why we should go with system A. And we are not going to end our business after 6 years or 4 years. The assumption will be after 6 or 4 years, we are going to repeat the same system with the same cash flows, with the same outflow. Get it? So the annual cost remains same. Now, I was telling you a different way to calculate the same annual cost, and that is only calculating the present value of initial cash flow and salvage value to save upon the time. I will just show you how. This 50 lakh is already at present value, and you take 432 300, the terminal value or the salvage value's present value. You calculate the total of it. So that comes to 45 67 700. Okay, because one is outflow and another one is inflow. Now you calculate the annuity, present value of annuity of this. Two figures only. It comes to 12,06949. And add that annual running cost as it is, that means 15 lakhs. The total is 27,06949. See, it's same. What you are doing is you are just bringing all the cash flows to 0 point and then taking all those cash flows to year end. And if some cash flows are already at year end, why to disturb them? That's the only logic. Okay, now let's have a look on question number 20. 26 though I will just leave it for homework because it's similar to 24 and 25. There are two machines. Oh, this is little different. Let's take it. This has inflows in it as well. Acha. Let's go back to the concept sheet. I think we are having the next concept lined up. So 23, 24, 25 was done. Now from 26 onwards, you can see we are starting with the replacement analysis question. Two important concepts that are left is replacement analysis and optimum replacement cycle. Optimum replacement cycle is little easier than the replacement analysis. After that, okay, done. So let's have a look on the replacement analysis question. Replacement analysis is very simple. The question is going to be how and when to replace a particular machine. If you purchase a machine, let's say I'm purchasing a mobile phone, this is my machine, this is my asset because I record videos, I record audios, because I have a studio. So mobile or a camera is nothing but an asset to me in this case. So if I buy the phone and see what happens is that it asks for some running cost. Running cost means as the phone gets older, the cost gets increasing. Okay, and by every year it's not feasible for us to afford the annual cost. In the beginning it may not cost you much, but after 4-5 years that phone will cost you a lot. Sometimes it will break, the warranty will get over, repairing will cost a lot. The repairing mostly starts after 2 years, like 2 to 3 years. The repairing cost is generally higher than the first and second year. First and second year you will not have much of the cost. So the option here, the question here is when to replace. When is the perfect time to replace the phone? So it depends upon the present value of total cash flows. You calculate the present value of cash flows and understand that at which point the cash outflow is least. Inflow is more, outflow is least. The point at which the benefit is more or the cost is less is the optimum time where you should replace the machine. If replacing the machine is beneficial, replace it, otherwise not. And how to find out whether it is beneficial or not? It's very simple, calculating the present value of the cash flows. Now, have a look on this question to start with. we will understand it better. Question number 26. So it has some issues in the question, in the answer, I think, but let's find out. Company Y is operating an elderly machine that is expected to produce a net cash inflow of 40,000 in the coming year and 40,000 the next year. So this is an elderly machine. So we have an old machine which can give us an inflow of 40,000. If we run it for 1 year only, we will get 40,000. If we run it for another 1 year, we will receive 40,000. Current salvage value is 80,000 and the next year's value will be 70,000. See, you can sell out this machine and receive 80,000 rupees as a salvage value. But if you don't sell it now, you can run it for 1 year, have this 40,000 using that machine and sell it afterwards. So you will get 1,10,000. First year's operating revenue 40,000 and the year end salvage value 70,000. Okay. But if you do not sell it at the end of first year also, you can sell it at the end of second year. Anyhow, you will have to sell it after second year. After second year, it is not going to give you anything. But the salvage value is going to be 0. So you have 3 options. Replace it now and have 80,000. Replace it after 1 year. Sell it after 1 year. Have 40,000 for the first year revenue and 70,000 as the revenue salvage value. And sell it after second year. That is 40,000 only. 40. 80,000 you will receive if you run the machine for 2 years. See, 3 options. First option, second option, third option. And you can clearly see that in the third option, you are receiving 40 and 40, 80,000 after a year and 2. Third option is can totally get away from our calculation, because that 80,000 though I can receive it by selling the machine today itself. If you calculate the present value of these two, it will not be 80,000, right? The present value will be lesser than 80,000. So anyhow, the third option is eliminated. Now comes the decision between first and second option only, to sell it today or to sell it after 1 year. We can calculate the present value of this 1,10,000. And if that present value, 1,10,000's present value is more than 80,000, then we should sell this machine after 1 year, not today. So it all depends upon such cash flows. Okay. But this is not the end of the question. Whenever you are going to sell the machine, you will have to buy another machine. And the replacement will cost you something. The machine can be replaced now with a new machine which costs 1,50,000, but is much more efficient and will provide cash inflow of 80,000 a year for 3 years. See, understand. Whenever you buy this machine, this new machine, it will cost you 1,50,000. And afterwards, it will give you 80,000 rupees a year. Now, this is going to be the twist in the question. So, it will run for 3 years. And understand the fact, if you sell the old machine today, you will have to buy the new machine today itself. So, these are going to be the cash flows. But understand, if you sell the old machine after 1 year, you will buy the new machine after 1 year and the cash flows will shift 1 more year to the next year. It's like this. Simple. So first we are going to calculate the equated annual benefit or cost of the new machine, because new machine is what we are going to repeat again and again. So it's better to calculate the equated annual benefit of the new machine. So first of all, what we are going to do, equated annual benefit or EAC, whatever it will be, of new machine. Since we know that the 80,000 is already at year end, why to disturb that? You can just convert this 1,50,000 into equated annual cost and adjust in the 80,000 benefit. So machine cost is 1,50,000. PVAF at what percentage? 15% or what? Let me see, 10% for 3 years. 2.487. That comes to 6314. This is outflow, and annual cash inflows are 80,000. So that means every year the benefit is 686, 19,686, equated annual benefit of the new machine. So no matter now, whenever you buy the new machine, the benefit of every year will be 19,686, which will include the machine's cost and 80,000 rupees. So you can replace all these four cash flows with this annual cash inflow of the new machine 19,686. Now you will have two options. A, replace now. What will happen if you replace the old machine now? You will receive 80,000 of the old machine, and then at the end of first year and second year and third year you are going to run new machine. The EAB of it is 19,686. All are cash inflows. Second option to you is replace after 1 year. Now the cash flows will look like this. You will receive 40,000 by running old machine for the first year, 70,000 by selling old machine at the end of first year, and you will buy new machine at that time. Then the cash flows will start after it, after first year, 19,686, 19,686, 19,686. Understand that you are not going to end here as well. After this point you are going to again buy the new machine and have same cash flow of 19,686, and it will keep going on and on and on. So you can reduce your calculation till the point the cash flows are not same, are not equal. You can reduce your calculation till this point, because after this point you can clearly see that the cash inflows in both the options are same: 19,686, 19,686, 19,686, 19,686. After that also 19,686, 19,686, and so on. It will keep going on for years and years to run. So why to see, when you calculate the present value of this and present value of this, the same amount will be added to the total. This is unnecessary calculation and it's not required at all. So stop yourself till the point the cash flows are different and are not same every year. If the cash flows are similar every year, you should not consider it in your calculation, because that's a waste of time. That is not going to change your decision. So now decide which option is beneficial: replacing now or replacing year after year 1. So we are going to calculate the present value of both the options for 2 years. I am keeping it simple now. Replace now. So cash flows will be year, cash flows, present value factor, present value, 0th point and first year. At 0 point we are going to receive 80,000, factor will be 1, total will be 80,000. And then 19,686, factor will be 0.909 at 10%, and the total is 17,895. The total is 97,895. If you replace after 1 year, the cash flows will be at the end of first year only. There is no cash flow at 0th point. So 1, 1,10,000, 0.909. It's going to be 99,000 or 1 lakh. So that's rounded off to 1 lakh. Now, these are the two present values. Understand, these are the two present values which has the same life 1 year. In this also, total 1 year's cash flows are included. In this also, 1 year's cash flows are included. So the life is same. Cash flows are at present value. Can we take the decision? Yes. Go with replacement after 1 year. Simple. So, in this question, what they have done is replacement after 1 year. They have calculated it in a different manner, but we have done it in a better manner. I have done so much of the calculation just to explain the things to you, how to proceed in the exam. It's very simple. When the life is different and when two machines are included, one we have to sell and the another we have to purchase, calculate. The very first step is to calculate the equated annual benefit or cost of the new machine. First step, equated annual cost of the new machine. I will just write down these things so that you remember it. Steps in replacement analysis. First, calculate equated annual benefit or equated annual cost of new machine. Second, restrict your cash flows till the year cash flows are different in any one option, or till the year cash flows are not same in all the options. When you find that any cash flow in any particular year, from a particular year, cash flows are same in all the option and they are remaining, like they are going to be same every year, all those cash flows or years has to be eliminated from the calculation. Restrict your cash flows till the year cash flows are different in any one option, or cash flows are not same in all the option, because adding present value of same cash flows of all options to present value total will not change decision. Then calculate present value of cash flows for the restricted years, or for means till the restricted years, we can say. This will ensure same life in all options. And conclusion, choose the option. Instead of saying choose, we will say select the option with least equated annual cost, least present value of total cost, or highest present value of total benefit, or we can say the highest NPV. Simple. So this is how you have to do it. We will do one more question to prove this. Question number 27 is in front of you. Have a look. So let's read the question first. Question number 27 is there in front of you. A and company is contemplating whether to replace an existing machine or to spend money on overhauling it. So we can replace the existing machine that we are using now itself, or we can spend some money and use it for coming years. A and company currently pays no taxes. Replacement machine means the new machine is going to cost you 90,000 rupees now and requires maintenance for 10,000 rupees at the end of every year for 8 years. And at the end of 8th year, you can sell that machine for 20,000 rupees. The existing machine, now coming back to the old machine, requires increasing amount of maintenance each year because that machine is getting older now. Every next year, it is going to cost you more. And the salvage value also will go down. So, the detail for the old machine is given to you. Present time, you can sell that old machine, no salvage value right now, but you can sell it at 40,000 rupees. And you can clearly see that with every passing year, the salvage value is decreasing and the maintenance cost is increasing. The max that we can use this machine is for 4 years. So we have 5 options to sell that machine. Sell it now, use it for 1 year, second option, third option, fourth option, and fifth option. In these 5 options, we have to decide which is going to be the best time to replace the old machine. Okay, the opportunity cost of capital for A and company is 15%. That is going to be your discounting rate. When should the company replace the machine? And these are the details given to you. The very first thing that we should calculate is, no matter when we replace the machine, the moment we replace the machine, the next year is going to be the cost of new machine. So first calculate the equated annual cost of new machine, the running cost of machine for every year, new machine for every year. No matter from which point we are going to replace it with the new machine, we should first know how much we are going to spend every year on an average on the new machine. So what we are going to do, we will calculate the equated annual cost of new machine first. And it's very simple. See, year, cash flows, present value factor at 15% and present value 0, 1 to 8 and 8. If you want to exclude the annual cost, you can do that also and reduce your calculation. Right now I am considering it. 90,000 is going to be your machine cost, 10,000 annual cost, and you can sell that machine for 20,000 after 8th year. So I am giving a positive sign to cash outflow and negative to inflow, because negative cash flow inflows are less. So with 15% at 0 point, we have 1 as a factor, and for 8 years the annuity factor is going to be 4.4873, already given in the question, use that. And for 8th year it's going to be 0.3269. Okay, so let's find out the present value. This is 90,000, this is 44,873, and this is going to be 6538. Perfect, negative. Now the total cost is, the present value is 128,335. What we are going to do, we are going to again divide it by present value annuity factor 4.4873 and convert all the cash flows in annual cash flows. So this is going to be 28,600. So this is the cost of new machine. Okay, now we have 5 different options. Replacement time, you can see we can replace it now. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Okay, I have to incorporate a lot of things. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 and 12 and 13. Let's say 13. See, if you replace the old machine now, you will receive 40,000. Am I right? for the old machine, but new machine's cost will start from this point, and we have calculated the annual cost of it. So 28,600 is going to be the cost of new machine. I'm just going to write down in short, in thousands I will write down. So 40,000 is what we are going to receive, and after that we are going to incur the cost of 28.6 every year for 8 years. So let me write down the years as well. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. So we will stop it here. Stop there only. 28.6, 28.6, 28.6, 28.6, 28.6. Okay, but do you think we should stop at 8 years only? 1, 2, 3, 4, 5, 6, 7, 8. Okay. 1, 2, 3, 1, 2, 3, 4, 5, 6, 7, 8, and 9. 9 is not required. 1, 2, 3, 4, 5, 6, 7. Acha, I made a mistake. I should have started from 0, not 1. 0, 1, 2, 3, 4, 5, 5, 6, 7, 8, 9, 10, 11, and 12, and 13. So this is going to be 28.6. So the new machine will run for 8 years and it is going to cost us 28,600 annually. This is equated annual cost. So considering 1,28,335 at 0 point for the new machine, or considering 28,600 annually, is one and the same thing in terms of time value of money. So this is our first option. But if we run the machine for 1 year and then sell it, what is going to happen? It's going to cost us 10,000 rupees. Okay, and the salvage value is only 25,000. So can I write down 15,000 negative? This is negative. 40,000 is a salvage. Cash inflow is written in negative. So 10,000 outflow, 25,000 inflow. I have written 15,000 negative. But the mistake that I did is this 15,000 is going to be received at the end of first year, because we are running the machine at the end till the end for the first year. Now what will happen? We will purchase the new machine at the end of 1 year, and from that point onwards, annually the cost will be 28,600. Am I right? So let's write it down. This same cost will incur from this point and will extend to 1 more year. Now this is going to be the scene now. If we run the machine for 2 years, 3 years, and 4 years. So what is going to happen? For the first year, the machine cost will be 10,000, and in the second year, we are going to sell that machine. The cost will be 20,000, and the salvage value is 15,000. So net outflow is there, 5,000 rupees. So 5,000 is going to be the cost for old machine, and then you are going to start incurring the cost for new machine annually. So I'm just copying and pasting it here. So you can clearly see that from that point onwards, it will run till 8 more years. So it will go till 10 years. Okay. Now, if we run the machine for 3 years, the cost is going to be 10,000 for first year, 20,000 for second year, and 30,000 for third year. But we will receive the salvage value of 10,000 also. So net is 20. So 10, 20, 20 we can write 10, 20, 20. And then we'll start incurring the cost for new machine from fourth year. Obviously, whenever you will buy the new machine, it will run for 8 years from that point onwards. So the 28,600 of the cost will start from that point onwards. Right? Now 10, 20, 30, and 40 is the cost. If you run the machine for 4 years, 10, 20, 30, 40 is the cost, and there is no salvage value. Okay. And see 28,600 from here. So this is how your cash flows will look like. But now understand one point. You are not going to shut your business after 8 years, 9 years, 10 years, 11 years, or 12 years. Understand? You are not going to shut your business. What you are going to do is you are going to replace the new machine with the same machine, same cash flow, and hence the same annual cost. So what will happen with the second machine that you are going to bring? It will also cost you 28.6 from that point onwards, and this procedure will keep going on for years to come. So you now understand that after a certain point, annual cost is 28,600 only. Now we have to decide when to replace the old machine. We will replace the old machine where the cost is less. For second thing that we should do is restrict our calculation when the cash flows are same in all the years. Just before the cash flows are same in all the years. Now understand, you will find that the cash flows are different till this point, at least in one option. But after 4 years, look out at all the options and you will see that the cash flows are same, 28,600. So it doesn't make any sense to bring those years in our calculation because that is not going to change our decision. The same amount of present value in all the option will be added because the cash flows are same. The discounting factor will be same for fifth year as well. The present value of fifth year's cash flow will be same, which will be added to all the option, and that is not going to change our decision. So why to waste time? Okay, now you can see that all the options has the same life, which is 4 years. Take all the cash flows in these 4 years, take all the options, calculate the present value of it, and then decide which option has the least cost. You have to discount it by 15%, all these 4 cash flows, 5 cash flows in all the options. That's what is done in this answer. Have a look. I will just start with the alternative. So you can see if you replace the machine immediately, what will happen? If you replace the machine immediately, you will receive 40,000 and you will have to incur 28,600 for 4 years. So I can calculate the present value of 28,600 with the annuity concept. See, 40,000 received and 28,600 for 4 years. So annuity factor. In total, 4 years are there. If we run the machine for 1 year, we will receive 10,000. We will pay 10,000, receive 25,000 for selling it. And after that, second, third, and fourth year, we will have this cash flow and annuity factor. So now this particular present value is representing the present value of cash flows for 4 years only, till 4 years only, because it doesn't make sense calculating the present value after that. And whichever option will have the least outflow, that option should be chosen. So we can clearly see that the first option itself has the least cash outflow, hence it is better to replace the machine immediately. We could compare these values because the life in each option was same, 4 years, 0 to 4 years. All the option had present value of the cash flows. So two things should match: the timing of the comparison and the total life in all the option. It's matching now, and that's why we can take the decision. Simple. So we should replace the machine immediately. Understood? So this is how you should solve the question. So look at question number 28. It's easy. We will discuss it. Question number 28 considers that we already have a machine. We can use it as it is and have some cash flows of 5 lakh, 540, 580, 620 and 660. Okay? So there is no cost involved in it, no salvage value as well. Simply 5 cash flows. This is nothing but the profit after taxes. Okay? And the tax rate is also given to you, but these are already profit after tax, so you don't have to consider tax on this. You can use the present value factor of 15% straight away and calculate the present value of these cash flows. It will come to something around 19.20 lakhs. Something around, I'm not sure. Okay. But what you can do instead of this is, you can upgrade the existing machine by spending 10 lakh rupees on it. This is going to be the capital cost. So once you put an outflow of 10 lakh, your annual cash flow will increase. You can clearly see that you are using the same machine, but earlier it was 5 lakh and now it is 5 lakh 50,000. And in this manner, you can see the cash flows has been increased. But the increment of the cash flow is not that significant. You can see that the increment is 50,000 only here, 0.50 lakhs, or let me write down. Here the increment is 50,000, here the increment is 50,000, Here the increment is 30,000, and in this case it is also 30,000, and in this case it is 40,000. So are you really sure that you are going to spend 10 lakh rupees on this machine with no salvage value and have just this much of the extra cash flows? 50, 50, 1 lakh, 1 lakh 60, and then 2 lakhs. You are only getting 2 lakhs rupees of the extra cash flow, that too not today, in the coming year. If we calculate the present value of that 2 lakhs now, it will not even be 1 lakh, 1 lakh or 1.5 lakhs. So it's altogether, you can clearly say that this option is not preferable, because it makes no sense to invest 10 lakh rupees to just have additional 2 lakh rupees. I can save up on 10 lakhs and have this cash flows instead. So till now, upgraded machine, the alternative upgraded machine is not to be selected. But this is not how you are going to answer in exam. In exam, what you have to do is you have to show the present value of all the cash flows. So what you are going to do, it's very simple. This is profit after tax. That means the depreciation has already been deducted from it. What is the depreciation? 10 lakh rupees you have spent for 5 years. So 2 lakh rupees will be the depreciation that has already been deducted while calculating the profit after tax. The only thing that is left now is to add back that 2 lakh rupees and then calculate the present value of the cash flows. So you just have to add back 2 lakh rupees in each. It will be 7 lakh 50,000, 7 lakh 90,000, 8 lakh 10,000, 8 lakh 50 and 9 lakh, and then calculate the present value. Still the answer will be like this cash flows is lesser than this one. Then you will reject the option of upgrading the machine. But if you see, you can replace the existing machine with a new machine, and the new machine is going to cost you 20 lakhs and 50,000 for installation. So how much is going to be the depreciation for it? 20.50 divided by 5 means 4 lakh 10,000 is going to be the depreciation, which is already deducted while calculating this profit. What you have to do is you have to add back depreciation. You have to add back the depreciation of 4 lakh 10,000 in each of it. This will give you cash flow after tax, and then you calculate the present value. Still, I'm telling you, it is not going to justify, because the increment is not justifying the 20 lakhs 50,000 that you are spending right now. So if you compare from the old existing machine, 5 to 6 lakhs means 1 lakh rupees of the increment. Then 540 to 640 means again 1 lakh. This is 1 lakh 10,000. This is 1 lakh 20,000 of the increment, and this is 660 and 8 lakh. That means not even 2 lakhs. It is 1 lakh 40,000. In total, the incremental cash flows are 1 plus 1 plus 1.1 plus 1.2 plus 1.4, 5.7 lakhs. Do you really think that you should spend 20 lakhs 50,000 today to have 5.7 lakhs of extra cash flows? No, not at all. And the present value of that 5.7 lakhs will even be lesser. So this option will also get rejected. The result is very clear from the question that you are going to select old existing machine, but you have to show the calculation. You also have to show that if you sell the machine, old machine, there will be some capital gain tax. So on 40% of this 20,000 will be the capital gain. Book value is 0. So sell value is 50,000, book value is 0, capital gain is 50,000, 40% is capital gain, 20,000 is tax, and the balance will be 30,000 that you will consider. So this is how you have to solve it. See, 10 lakh by 5, 2 lakh of the depreciation. If you upgrade it, if you buy the new machine, 410. What they have done in this question is they have used the incremental approach. You can see incremental cash flow after tax. Simple. So these are the incremental cash flows after tax, and you can see that you have this much of the cash flows. You spent 10 lakh rupees to have this much of the incremental cash flows. You can say 10 lakhs and 10 to 12 or something lakhs will be there. So if you will calculate the present value, it will even be lesser. In the second part, you can see that if you go for the new machine, you will compare the cash flows with existing machine and the cash flows with the new machine, and you will see the incremental cash flows there. And then you calculate the present value of these cash flows, incremental cash flows, present value factor, present value factor, present value. So you can see that cash flow after tax, incremental cash flow after tax is this much inflows, outflow of 10 lakh and 20 lakhs 20,000. Why 20 lakhs 20,000? 20 lakhs 50,000 of the acquisition cost minus the salvage value of the old existing cost machine that you sold. 30,000, 50 minus 20 capital gain. And in both the option, the NPV is negative, means upgrading the machine is giving you loss, buying a new machine is also giving you loss. So it's better to continue the existing machine as it is giving you more profit. So this was the question. Now question number 28 is exactly like the question that we have solved, but in this question number 29 onwards, we are going to learn a new concept that is called as optimum replacement cycle. Means here there is no old machine and new machine, there is only one machine from 29 onwards. These three questions were on replacement analysis, and question number 29 and 30 is on optimum replacement cycle. Have a look on question number 29. We will understand and solve this. See, question number 29. A machine used on a production line must be replaced at least every 4 years. You can buy it today, replace it after 1 year, or every 1 year. It's not just for the first year that we are talking about. It's the cycle that we are talking about, that whether we should buy today and replace every year. At the end of the year, you will sell it, buy it again. On the second year, you will sell it, buy it again, and do it. So what should be the replacement cycle? 1 year or 2 year? Each 2 year you are going to replace, or 3 year or 4 year. The max that you can use this machine is for 4 years. And the details are given to you. Purchase price, maintenance every year, repair, scrap value, future replacement. Even if this statement would not have been there, we would have assumed the same. Future replacement will be with identical machine with the same cost. Revenue is unaffected by the age of the machine. So don't consider or you can ignore the revenue part, just consider on the cost part. Ignore inflation, taxes, and determine the optimum replacement cycle. Present value factor of 15% is given to you. So if you replace the machine every year, what is going to happen? Every year your cost will be like this. Outflow of 60,000, outflow of 16,000, and then inflow of 32,000. And this is going to repeat for the next year as well, next year as well, next year as well, and next year as well. And it will keep on repeating. Then if you take the replacement cycle of 2 years, then first at 0 point you will pay 60,000 to buy the machine. First year you will pay 16,000 for maintenance. The second year you will pay 18,000, 4,000, and then scrap value is 24,000. And in this manner, if you run the machine for 3 years and then replace it, you will pay 60,000, then 16,000 first year, then 22,000 in the second year, then 28,000 in the third year, and scrap value of 16,000. So these are going to be the cash flow. So what you should do is the very first thing, calculate the present value of total cash flows involved in all the possible option. You have 4 options: replacement cycle of 1 year, 2 year, 3 year, and 4 year. Okay, so we will just take it here. Let's take the replacement cycle of 1 year. Okay, what will happen? At 0 point you will buy the machine. At the end of first year you will sell the machine. You will pay 16,000 for repairs and you will sell the machine at 32,000. The net cash flows are 60,000 and 16,000 for 1 year replacement cycle. You are going to take this 60,000 and 60,000 and 16,000 of the net cash flow, calculate the present value of it, and this is going to be the present value of the 1 year replacement cycle. But if you replace the machine every 2 year, what will happen? Today you will pay 60, then 16,000 maintenance, 22,000 again maintenance for second year, and 24,000 residual value means scrap value. So these three are going to be the cash flow. These three are going to be the cash flow, and the present value of that is this. You do the same for 3 years replacement cycle and 4 years replacement cycle. If you run the machine for 4 years, the cash flows will be you pay 60,000, then 16 for first year, 22 for second year, 28 for third year, and net 28,000 for fourth year. And the present value is that. Now, can you compare all these four options? No, because 46,086 has only 1 year of cash flows in it. It has 2 years, it has 3 years, and it has 4 years. Because the number of years are more in the last option, the cash flow is more. That's why these options, although they are on present value, you cannot compare it. So what is the next, what is the solution to this? Very simple, sir. Since it's not going to be the 4 years cycle only, or the term of 4 year only, what we can do is calculate the equated annual cost in each of the option. Means for every option you are going to calculate the cost of running the machine every year. That's it. So what will happen in this case? It will be the annual cost, and it will be the time, or we can say the base, that is the life in each option will be 1 year. That's it. And you can take the decision because the base is same now. So what you are going to do, you are going to divide all those cash flows with the present value annuity factor for 1 year, this is for 2 year, this is for 3 year, and this is for 4 years. If the cash flows include 4 years of life, the annuity factor should also include 4 years of life. That's it. And then you can arrive at equated annual cost. Under each option, every year you will be spending this much: 52,997, 44,536, 43,114, and 43,772. Now you can decide, because the life is 1 year in each option. Timing is also same, the year end, and accordingly this option seems better. If you replace the machine every 3 years, annual cost will be lowest, and that's how you have to do it. In the replacement cycle decision, I will show you. If the question is of replacement cycle, what you have to do is simple. First, calculate present value of total cash flow in each option. Second, very simple. Since each option has different life, they are not comparable. Third, calculate equated annual cost of each option. Now the life is 1 year in each option, and hence comparable. Option with least equated annual cost or highest equated annual benefit. In case there are some question where benefit is given, you should consider highest benefit. Should be selected. Simple. Is it difficult? No. It is easier than the replacement decisions that you have been taking. This is also replacement. That one also was replacement. But in the previous question, we had two different machines. We had to sell old machine and buy new one. That's why we were deciding when to sell the old machine. What is the right time? But in this case, there is only new machine which can be replaced every year, 2 year, 3 year, 4 year, and so on. We had to decide what should be the cycle every 3 years, because in that case the annual cost will be lowest. So question number 29 was like that. Question number 30 is exactly like question number 29, where this question is on the air conditioner, I think, where you will be buying not air conditioner, it is on the motorcycle. Each mechanic travels approximately this much, this much, this much. Okay. The purchase price of the latest model bike is 55,000. It is about the two-wheeler. So you will purchase it at 55,000. After 1 year, 2 year and 3 year, the resale value is given to you. The cost at which you can sell the machine. But running and maintenance cost for these 3 years are also given to you. Exactly the same. In this question also we had the same thing. Purchase price, running and maintenance cost, and then scrap value. But it is presented in a different manner. That question was for 4 years. This question is for 3 years. Using the opportunity cost of capital of 10%, you are required to determine the optimum replacement period of the bike. You consider 1 year replacement. In 1 year replacement, what will be the cash flows? Understand, 55,000 you will pay. Then you will pay for road taxes and insurance 3,000 and 30,000 petrol. So that is 33,000. And you will sell the machine at 35,000. This is only for first year. These are the cash flows are for first year. But if you take the replacement cycle of 2 years, 55,000, 33,000, the first year cost of running the bike, and second year cost is 38,000, and then you will sell it at 21,000. That's it. In the 3 year replacement cycle, again 55,000, 33 running maintenance, 38 running maintenance, and 46 running maintenance, and then you will sell it at 9,000. You calculate the present value of these cash flows now, but they will not be comparable because the life is different. You just divide them by the annuity factor and calculate the equated annual cost. How easy it is. Whichever option give you the least annual cost or highest annual benefit should be selected. See, these are the total. They are not comparable. That's why present value annuity factor, and this is going to be the annual cost. Now you decide which option is better. The second option is better. That means you should replace the bike every 2 year. Every 2 year. It's not worth carrying the bike for the third year. We may mentally think that we should use the bike as much as possible, but understand the logic of cash flows. You should not use it beyond 2 years because it is going to cost you more than give you the benefits. Understood? So this is how you have to consider. Again, there is one more question on optimum replacement cycle. See, question number 46 and 47 is there. Let's have a look on those questions. If they're not that difficult, we will leave it. Let me see. (46) and 47, right? 46 and 47. See, 47 though is very easy. Again, similar. Taxi, instead of bike, it is a taxi for 4 lakh, costing 3 years life. Operating cost, resale value, and you have to decide the optimum replacement cycle. Again, the same thing. So 47 is homework. Do it. 46 is something that we should consider now. It has small things that has to be considered. Have a look. So let's have a look on this question. Question number 46 is this. A company named Robbie's Cube decided to replace the existing computer system of their organization. Okay. Original cost of the old system, you can see it is given to us, was 25,000 and it was installed 5 years ago. Okay, current market value of the old system is 5,000 rupees. It means if you sell that system today in the market, it will give you 5,000 rupees of the cash inflow. Depreciation of the old system was charged with a life of 10 years with an estimated salvage value as nil. So now first we are going to do some calculation for the existing system. This is going to be question number, I think it's 46. Now understand this timeline. We purchased this system for 25,000 rupees with an estimated life of 10 years. No salvage value. That means we started charging depreciation of 2,500 per year. Now 5 years has already been there. We are using this system, computer system. That means 2,500 into 5. That means 12,500 is the amount of machine we have already depreciated in our books. So the book value right now is 12,500. Half of which has already been written off as depreciation. The balance is remaining in the books. If you will see, if today, this is 5 years back and this is 5 years more left for this. Today, if we sell this machine, we can sell it at 5,000 rupees. That means there will be a capital loss of 7,500. Okay, there is no capital gain, but there is a loss in this question. Now, moving ahead, you can read that depreciation of the new system, if we replace the machine today, we will sell it, or existing machine, and we will bring the new machine into picture. New system will be charged with a life of 5 years. Present cost of the new system is 50,000 rupees. So you will buy the new system for 50,000 rupees. You will depreciate it with for 5 years, but it will have a salvage value of 1,000 rupees. Let me do some calculation for new system as well. So this is new system that you are going to buy at this point and sell it at this point after 5 years. Okay, so calculation for depreciation of a new system will be like this. See, total cost of the machine minus salvage value divided by life. So 49,000 divided by 5. Where is my calculator? Have a look. So every year the new machine will have a depreciation of 9,800. Old machine had a depreciation, old system had a depreciation of 2,500. Instead of that, new system will have a depreciation of 9,800. Now understand, estimated cost saving. They're not giving us the details of the revenue, total revenue with the new system, but they are saying that because we are replacing the old system with the new system, the incremental cash inflow will be cost saving 5,000 rupees. So you can consider it like this, that cost under the old system was 15,000, but the cost under the new system is only 10,000. So we can clearly see that there is a 5,000 rupees of saving every year because we have replaced the old system with the new one. Increase in sales with the new system is assumed at 10% per year. You can clearly see increase in the sales of a new system is assumed at 10% based on the original total sales of 1 lakh. Originally, we were having sales under the old system of 1 lakh rupees, which will increase by 10% under the new system. So the benefit here is 10,000 rupees. The benefit of cost saving is 5,000 rupees. The benefit of increased sales is 10,000 rupees. So these cash flows, 5,000 and 10,000, is not under the new system or the old system. It is the cash flows. It is nothing but the incremental cash flows. So we are going to solve this question on the basis of incremental approach, that if we replace the machine, old system with the new system, what is going to be the incremental cash outflow and inflow. Then we are going to net it off and then going to calculate the present value factor, and then we'll find out the NPV. If the net present value We will call it as incremental NPV is positive, we will replace the machine, otherwise no, not. Okay, so company follows the straight line method of depreciation and the cost of capital is 10%, tax rate is 30%, that's it. What should be done now? Okay, now the cash flows. So we are going to divide all the cash flows in three different parts: initial, operating, and terminal. Initial cash flow, you can clearly see that I will just write down here. I will make a table: year, cash flows, present value factor or 10% and present value. So at 0 point, first of all, you will sell the old machine. Old machine will give you 5,000 rupees of cash inflow plus tax saving on capital loss. How much is the tax saving on capital loss? Capital loss is 7,500. On that you will have some 30% of the tax saving, that is 2250, and that is tax saving. That means we are going to consider it as inflow. 2250. I'm not writing in detail so that we can cover it up. And new machine will cost you 50,000, right? Let me just check one second. Okay, so these are the cash flows at 0 point. In total you have 5,000 plus 2250 minus 50,000, so that's around 42,750 of outflow. 42,750. Now from year 1 to 5, there will be 2 to 3 different things. First of all, cost saving. What I can do here is, let me just keep a space for particulars. Okay, so this was salvage value, this is tax saving, this is new machines cost. Now cost saving is 5,000, then incremental sales is 10,000. Okay, there is one more thing. Tax saving on additional depreciation that we are charging now. See, we are solving this question from the incremental approach. So we have to consider the fact that if we would have used the old machine, we would have charged 2,500 rupees of depreciation every year for the next 5 years. But now, since we have replaced it with the new machine, we are charging 9,800. So we have to take the difference between these two as the incremental depreciation. But that is of no use to us. What is going to matter is the tax saving on the incremental depreciation. So we are going to write it like this: 30% on difference between old and new machines depreciation. It will look like this. So 9,800 minus 2,500 into 30% is 2,190 every year. Okay, apart from that, if we are saving some cost and the sales are also increasing, we will have to pay tax on it. So let's consider the tax also on this part. I will just keep a space here. So total savings are 15,000. Tax we will pay at 30% on this. That is 4,500, and on net we will have a cash flow of 10,500. This is going to be cash flows after tax. And if we add this tax saving on depreciation, we will have 2,190, 12,690 of cash flow every year. Every year, and it includes everything: the cost saving, incremental sales, tax on the incremental sales and cost saving, and then tax saving on depreciation. And we have 10% as the discount rate. So for 5 years the present value factor will be 3.791. That's around 48,108. Okay, and terminal cash flow. At the end of fifth year, we had a salvage value of old system 0, salvage value of new system 1000. The incremental salvage value is 1000. Let's write it down and end the question. It's 1000, which will be multiplied with the fifth year factor, that will come to 621. And now you can calculate the present value, NPV. 48108 plus 621 minus 42750. 48108 plus 621 minus 42750 comes to 5979. So this is how you have to solve it using incremental approach, and you can clearly see that we have a positive NPV. That means the incremental NPV is positive. That means shifting from old system to new system is giving us a positive result, and that's why we should go with the replacement of old system. Have a look on this answer. So there are a few things that you should notice. First, 2250 tax saving on old system. This is the cash flow at the beginning, which includes 2250 of the tax saving, salvage value of the old system, and new machines cash outflow. Then 12690, it includes everything on operational part, and then 1000 into salvage value of the new machine. So in total you can see the NPV comes to 5973. Ours was 5979. 6 rupees you can leave it because of the rounding of differences, and we should take the decision as NPV is positive. We should accept the proposal to replace the machine. That's it. This is the end of the replacement questions, I think so. Let me check. Yeah, so question number 46 and 47, I'm marking. 46 we just completed, and 47 is your homework. For 29, 30 is also complete. Now we are going to solve some leftover questions. I think only 3 to 4 questions are left. In this also simulation analysis was done. You can take this as homework. It is easy. So I will solve this question number 45, and 4 more questions are there. Let's have a look on these questions. See, question number 31. Interesting question. It is based on the project IRR and equity IRR. Let me tell you what is IRR. IRR is the internal rate of return. This is question number 30. Which one is that? 31. Okay, interesting question. First, you should understand the concept so that it becomes easy for you. What is IRR? IRR is the rate of discount with which you calculate the present value factor, at which NPV comes to 0. What it means is that present value of cash inflow minus present value of cash outflow is NPV, and it should come to 0. That means present value of cash inflow should be equal to present value of cash outflow. What exactly it means is that IRR gives you the rate you are earning on this project, the exact rate that you are earning on your investment. So mostly we are going to solve this question. Present value of cash inflow is like annuity, the annual cash inflow multiplied by the present value annuity factor, and that will be equal to present value of cash outflow. Okay, so we would be given outflow, we can calculate the annuity with the given data, and then with the help of these two figures only, we will have to calculate the discount rate at which, if we discount the annuity, it will be equal to the cash outflow. So how we are going to solve these questions is that we will calculate the present value annuity factor, and that will be like present value of cash outflow divided by present annuity each year that we are receiving. This will give us the present value annuity factor, let's say 3.791, and then we have to find out 2 rates. We are going to apply trial and error method. 2 rates, the annuity factor of which for the given year, let's say 5 years, should be below and above this 3.791, and then we can interpolate those two rates to find out what is that exact rate at which the annuity factor comes to 3.791, because that is the rate where the annuity factor will be 3.791, and at that rate the present value of cash inflow will be equal to outflow. That means the NPV will be equal to 0, so that we can call that rate as IRR. It has to follow all the rules. Okay, have a look on this question. XYZ Limited is an infrastructure company. I will just give you a short version of this entire question. We are not going to read it fully. See, basically there is one company who wants to invest in building the road construction basically. So they will build the road, operate it for some years, and then hand it over to government after 15 years. I will give you. The road's total distance will be 35 kilometer that they are going to build, and it will cost you 200 crore rupees. So how this company is going to finance this 200 crore rupees? From where they are going to bring this 200 crore rupees? There are two options given to you. First is equity, the second one is debt. Equity, you are investing only for 50 crore and you are taking a debt of 150 crore. So equity 50, debt of 150, that means loan. But that debt comes with the interest rate, which is 15% per annum. See, okay. Now, after the project is complete, it will be opened to traffic and a toll will be collected by this company. Government is authorizing them that you build the road, you operate it for 15 years, take the toll taxes from the people, and then after 15 years, you give it to us at zero cost. And for those 15 years, you have to maintain the road as well. 15 years. Company is also required to maintain the road during this 50 year, and you will be handing it over after 15 years to highway authorities at zero value. Now understand, revenue will be 50 crores per annum and the toll tax collection expenses will be 5% of the project. If you calculate 5% of the project cost, that comes to 10 crore. Okay, so for 50 crore is your annual revenue, 10 crore is your cost, so 40 crore is the net annual cash inflow on this project. 50 minus 10, 40. This 40 crore is the profit of equity and debt holders, right? But government can also take taxes in this. The good part about this question is that they have asked you to ignore taxation. That means depreciation will also be ignored on the total project cost, because there is no use of depreciation if there is no taxation. So ignore taxation, ignore depreciation. This is the net cash flow, 40 crore rupees, which has to be distributed between the debt holders and equity holders, right? And you are going to operate this business for 15 years. Good. Now, the company is considering to write off the total cost of the project in 15 years on a straight line basis. This statement is of no use because there is no taxation. For corporate income tax, you can charge depreciation at 10% on WDV basis. This statement also has no use in our answer because there is no taxation. The financial institutions are agreed for the repayment of the loan in 15 equal annual installment. 15 equal annual installment means equated annual cost. So the loan amount is 150 crore and you have to take the present value annuity factor at 15% for 15 years. Because the rate of interest that they want is 15%. The time is 15 years. So you can calculate their EMI. You can calculate their EMI with this formula of equated annual cost. Now, consisting of both principal and interest, calculate the project IRR and equity IRR, ignore corporate taxation, and explain the difference between these two. See, project IRR means the rate of return for equity and debt both. That means on 200 crore rupees of the investment. But equity IRR means the return for equity shareholders only. That means only 50 crore rupees of the investment. So think from the angle of the equity that we have invested 50 crores. What exactly is what we are taking away from this company? So it's going to be easy now because I have explained a lot. Now understand the revenue part first. Revenue every year will be 50 crore. Cost will be 10 crore. The net amount is 40 crore less. Out of this 40 crore that you will receive, you will have to pay EMI. equated annual installment. So not EMI, it's not monthly installment, it's equated annual installment. So we will normally say it, call it as installment. And how do we call installment? It will be calculated with the help of equated annual cost concept. Loan amount is 150 crore. Present value annuity factor at 15% for 15 years. So 150 divided by 1 divided by 1.15. Sorry. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. So that comes to 5.847. So 25.65 lakhs will be your EMI. Every year you will be paying them 25.65 lakhs for the next 15 years. This will include the principal and interest as well. At the end of the 15th year, the balance outstanding will be zero. So 25.65 you are going to pay to them every year, and the balance will be for equities earning. 14.35. So you understand one fact, that before paying them installment, the profit pertains to both the investor, that means equity plus debt. But after paying the installment to debt holders, the balance will only be of equity shareholders. That's it. This is what you have to calculate now. So understand the investment project cost. Equity and debt holders invested around 200 crore rupees in total, and they are earning 40 crore in total. That's it. But equity shareholder invested 50 crore in total, and they are getting 14.35 every year. Now you just have to calculate one thing: the rate at which, if you discount 40 crore for 15 years, it should be equal to 200. That will be called as project IRR, because project IRR means the income for both. But if you have to calculate the equity IRR, you have to find out the rate at which, if you discount 14.35 for the next 15 years, it should be equal to 50 crore. That's it. So first of all, project IRR should be equal to annuity into present value annuity factor. X is what we have to find out for 15 years, is equal to cost of the project. So annuity is 40 crores into present value annuity factor is equal to 200. So we have to find out present value annuity factor as 5. What is the rate where the present value annuity factor for 15 years will be 5? So you have to do all the trial and error thing here. Let's take a rate. Present value annuity factor. Let's take a rate of, see, you can clearly see that at 15% for 15 years, the rate was somewhere near 5.847, right? So you should clearly understand that if you increase the rate, let's say 10% is the rate, the annuity factor, the first year present value factor is 0.909. But if you increase the rate by 1%, the present value factor will reduce by, it will get reduced. Okay. So it is very evident from this fact that if we want to reduce the annuity factor, we will have to increase the rate. And in this case, we want 5 as the annuity factor. So we have to reduce the annuity factor from this. That means we have to increase the rate. Let's increase the rate to 16 or 17%. Let's take 17% and calculate the annuity factor. So it comes to 5.324. It's still higher. Let's take another rate. We have to bring down this annuity factor. That means we have to increase the rate. Let's increase it to 19% now. Because again, taking 18% may result into a higher annuity factor. So this comes to 4.876. Now it is very clear to us that our annuity factor, the desired annuity factor of 5, lies somewhere between these two. That means our IRR lies somewhere between these two rates. So use the knowledge of interpolation. We have to bring it to 5 only. So if you increase the rate by 2%, the annuity factor gets reduced by 0.448, but we have to reduce it to 5 only, right? So we have to reduce the annuity factor by 0.324 only. So understand, if you increase the rate by 2%, your annuity factor gets reduced by this much. You don't have to reduce it to this much because you have to reach till this point only. So you want to reduce the annuity factor by 0.324 only. That means how much percentage should be increased over and above 17. So this is what we call as interpolation. We will start with 17 and we will give a plus sign here because we are increasing the number 17 and then 19. If it would have been lesser than 17, I would have put negative sign here. Now it's very simple, 2 divided by this multiplied by this. So 2% is the rate that we have to increase if we want to decrease the annuity factor by 0.448. But if we want to decrease it by 0.324 only, then how much rate should be increased? Solve it. So it comes to 18.45%. This is your project IRR. What does that mean? It means that both of them combined are earning 18.45% on this project. And I will give you one simple additional information on this. Even though both of them combined are earning 18.45%, it is very apparent that we are not giving debt holders more than 15% as the rate of interest. Hence, the extra earning of 3.45% is being earned on the entire project is being earned, or the benefit is taken over by the equity shareholders on 200 crores. So if you calculate 200 into 3.45%, it comes to somewhere like 6.9 lakhs. I will talk about it later. So stop yourself till the project IRR. Are you happy with this? In the similar manner, you have to calculate the equity IRR by considering that annually only equity shareholder are earning 14.35 and their investment is 50 crore. 14.35 crore, 50 crore, right? So how you are going to crores or what? Lakhs. Just let me know. Acha, it is crores. So let me just correct one thing. It should also be crores. Now let's solve it for equity IRR. How to calculate equity IRR? It's very simple, sir. Think only from their angle. Annuity into present value annuity factor is equal to cash outflow. So annuity for them is how much? You can see that they are only taking 14.35 crore every year with them, and cost is 50 crore. So 14.35 crore, we don't know the rate, that's why we don't know the annuity factor, and the investment by equity shareholder is only 50. So the present value annuity factor that is required is 3.484. That means we need a rate of return which gives us the annuity factor of 3.484 for 15 years. Now you can clearly go up and see that when we took the 19% rate, we had the annuity factor of 4.87. We have to reduce it to 3.484. So we have to reduce that annuity factor significantly. That means we have to increase the rate of interest from 19% to significant level. So let's take the rate and annuity factor here. So I can clearly say we can take around 26%. Let's take the 26% rate. So that gives you 3.726. Still, we are above what we want. 3.48. We want to reduce this annuity factor. We will increase the rate. And now you can increase the rate to, let's say, 29%. The answer is 28%, by the way. But it comes to 373. Now you can clearly understand that this particular annuity factor lies between these two annuity factor. That means your rate lies between these two rates. You can go ahead and do the interpolation and you will come somewhere near to 28%. I am not doing the interpolation now, but I will show you the answer. See, if we start solving this question according to the compiler, you can see that 18.43% is the project IRR that we have already solved. Then 40 crore is the project cash flow. Then see 28.17%. If you interpolate the rate of 26 and 29, you will get some answer which is closer to this. They took 25 and 30%. That's why the gap, higher the gap between the two rates that you have assumed, you can say that more the answer will be little away from the correct answer. Means it will not be that appropriate. Lesser the difference between, minimum is the difference between the two rates, the more appropriate your answer will be. Okay, so 28.17% is the equity IRR. This is what they are earning. Let's see some working. This was the loan installment calculation using EAC method. This is equity cash flow. That's it. So there are two answers to you. Project IRR 18.4%, equity IRR 28%. And you can clearly see that this is attributed to the fact that even though XYZ Limited is earning 18.4% on the loan from financial institution, but they are paying only 15%. Company is earning 18.4% on that 150 crore as well, but they are paying only 15% to the debt holder. That means 3.4% extra goes to the equity investor on 150 crore. So 3.4% on 150 crore gives you some amount that is 10 point something that I had calculated. I will show you. 3.45 on not 200 on 150. That extra amount that we are calculating. So this goes to the equity holder. That is, this is the extra earning 5.175 crore to equity holders. So how much is the percentage? We will calculate the percentage of extra earning to the equity holders based on the 50 crores of investment. So this is based on the 50 crores of investment. So this is how much they are earning extra. And this is 28 minus 18.45 or something. Somewhere near to that, approximately. Okay, so this was a question number 31. We had good discussion on that. Let's take question number 32. Interesting question. Have a look. See, this is an interesting question. X Limited is an existing profit-making company. Underline this word, existing profit-making company. And it is planning to introduce a new product in the market. It has a life of 8 years. Initial equipment will cost you 120 lakhs. So there is nothing new about this question, but it's little complicated. 8 years of life. And it is divided in 4 parts. First year, second year, then third, fourth and fifth year, 6th, 7th and 8th year. First year, second year, third, fourth and fifth year, 6th, 7th and 8th year. It is divided like this. Initially, you will spend 120 lakhs to bring the machine. Equipment cost will be 120 lakhs and additional equipment cost in 10 lakhs will be needed at the beginning of the third year. The beginning of the third year means ending of the second year. This is where people will make mistake. Because it was written third year, you will take it at third year ending. And you will show the 10 lakhs rupees of outflow at that time and all the answer. You will get 0 on the entire answer because the beginning itself is wrong. So beginning of the third year means ending of the second year. Okay. Now, at the end of 8th year, the original equipment will have a resale value equivalent to the cost of removal. That means whatever we are going to earn by selling the original equipment, it will have to be expensed out because we have to remove that cost. So the scrap value, net scrap value is 0. But the additional equipment can be sold for 1 lakh rupees. So we will have some cash inflow of salvage value of additional equipment, that 10 lakh rupees. Good. Now, working capital is 15 lakhs that will be needed. What do you mean by working capital? Working capital will be needed at the beginning, but working capital is not an expense. Working capital is just a cash flow required to start the machine. Whenever you stop the machine, you can bring that cash flow back to your pocket. So if we are starting this project, we are going to put money in that, which is 15 lakhs. Once the project is over, we will release that working capital and that 15 lakhs will be taken back. So whenever the working capital is given to you, do not treat it as a capital investment, do not treat it as an expense. Treat it as an inflow which will be released at the end. That's it. Then the 100% capacity is 4 lakh and the units per annum, but the production and sales volume are expected like this. You can see that in the first year we are going to produce only 2 lakh units. Sorry, 80,000 units. 4 lakh into 20%, then 1 lakh 20,000 units, then 3 lakhs units, 4 lakh into 75%, and then 2 lakh units. So this is our production and sales every year. 80,000 for the first year, 1 lakh 20,000 for the second year, 3 lakhs for the third year, 3 lakhs for the fourth year, 3 lakhs for the fifth year. This is how you should interpret. And 2 lakhs for the 6th year, 2 lakhs for the 7th year, 2 lakhs for the 8th year. Okay. Now, then selling price is 100 rupees, profit volume ratio is 60%. Let's write it here. Selling price is 100 rupees. Cost will be 40. That's why contribution will be 60 rupees per unit. So this is your contribution per unit. You will multiply it with the quantity, and the quantity is different for all the years. You will come to total contribution after multiplying it with the quantity. Then understand, fixed operating cost of 16 lakhs per annum will be required, and apart from that you will have some additional expenditure like this. 30 lakh for the first year, and this is each year. 15 lakh for the second year, understand. 10 lakhs for each of the third, fourth and fifth year. 10, 10, 10. Then 4, 4, 4. This is how you have to write. Company is subject to 50% tax and straight line method of depreciation permissible for the tax purposes also. Taking 12% as the appropriate after tax cost of capital should the project be accepted. See, we are going to calculate the NPV, and if it comes to positive, we will accept the project, otherwise not. How the format should be? It's very simple, sir. First, you calculate the present value of the operating cash flows, and you can write it like this: year 1, 2, 3 to 6, 3 to 5 and 6 to 8. You write down the contribution per unit. So that's same, 60 for all. Then you write down the quantity. I will just write it in lakhs. So it will be 0.8, 1.2, 3 lakhs and 2 lakhs. Then you will multiply. This is the total contribution. This is going to be the fixed cost. This is going to be the advertisement cost. Then this is going to be the depreciation. Now understand what will be the depreciation. For the first 2 years, the depreciation will only be charged on 120 lakhs. 120 divided by 8. 120 divided by 8 means 15 lakhs rupees. 15. But from the third year onwards, there is an additional equipment of 10 lakh rupees. But it had a salvage value of 1 lakh. So the depreciation on the new equipment will be 10 lakhs minus 1 lakh of salvage value divided by remaining years. That means 6. So 9 by 6 means 1.5. So old equipment has 15 lakhs of depreciation, new has 1.5 lakhs of depreciation. From the third year, you are going to charge 16.5 lakhs of the depreciation every year. So the depreciation will look like this: 15, 15, 16.5, 16.5. The fixed cost is 16 lakhs. So you will write 16, 16, 16, 16. And the advertisement is different, 30, 15, 10 and 4. 30, 15, 10 and 4. Now what will happen after considering all the cash flows? You will reach at profit before tax, then comes the tax, then comes the profit after tax, but this is not a cash flow. You add back the depreciation in it and then you arrive at the cash flow after tax. It is not necessary to write down this row, but if you are not able to understand, you can just write it. Then the cash flow after tax, then you have present value factor, then the present value and the total of the present value. That's it. This is the total of the present value. How simple it is. And then you can also take the present value of 4 figures. I will show you. These two, present value of these two and present value of these two. A, B, and then this is C. Total it. You will get the NPV. That's what is done in this question. See. So these are the number of unit. This is the total contribution at 60. You can see fixed cost, advertisement, depreciation, profit after tax, and the profit after tax, add back depreciation, and this is cash inflow. And then you will have these cash flows written over here. First year 2 lakh, 28 lakh, 85, 28, 85 and 58 for the rest. Understand that what they have done in the next table is they have taken 85 lakh 25,000 3 times. Okay. 85 lakh 20,000 3 times and 58 lakh 25,000 3 times. Instead of writing it every time, you can just take the annual total of these factors and take it as annuity. So while following this particular table, you will have to calculate the annuity factor of 3 years, 4, 5, 6. Add those present value factor. Then annuity factor here also 6, 7, 8. This is 3, 4, 5, 6, 7, 8. Present value factor, the total of the present value factor, and then multiply, because these cash flows are not just for 1 year. It is every year for the next 3 years, and this is also every year for the next 3 years. So multiply it with the annuity factor and not just present value factor, otherwise you will not get anything. Then working capital is released at the end, 15 lakhs. Salvage value of the old machine, 1 lakh. Outflow is 1 lakh 35,000. How 135 lakhs? Because 120 lakh is the investment and 15 lakh rupees of the investment of the working capital. Additional investment will be required, that is at the end of second year, and then you can see the NPV is positive. Accept the project. It is easy. It's not that difficult. In the similar manner, you are going to do this. Nothing's new in this. 33. Let me check if we have something in 34. Okay, we can solve the 34. It is based on the equated annual cost. 34 is on equated annual cost. Let me check. $34 is also NPV. So probably the second last question. Have a look. This is also easy, not that difficult. So a manufacturing unit is there and it is in the production of automobile part, and it is considering that we should buy either of the two plant A or B. You can clearly see that the cost of the two plants is 20 lakhs and 38 lakhs. Installation charges 4 lakh, 2 lakhs. So the total capital will be 24 lakhs and this is 40 lakhs. Then the life of both the plants are different, 20 years and 15 years. Scrap value after the full life, means after 20 and 15 years, will be 4 lakh and 4 lakh. Both the scrap values are same, but the timing is different. Then output per unit by each plant is 200 and 400. You can clearly see that the plant B is little expensive, but the output is double that of plant A. And the annual cost of the two plants are as follows. Every plant is going to have some annual cost. Running hours same, but wages 1 lakh 40,000. Then indirect material, repairs, I will just write down. This is 1 lakh, wages 1 lakh 40,000. Indirect material, repair, power, fixed cost. You can just total these to arrive at a figure that what is the annual cost of each plant every year. So this is 9,60,000. So this is 10,60,000, right? So these are the annual cost. Will it be advantageous to buy plant A or B? Substantiate your answer with the help of comparative unit cost of the plant. You have to calculate per unit how much it is costing. Okay, assume interest on capital at 10%. Make other relevant assumption. So how do you calculate? It's very simple. You calculate the present value of all the cash flows. So we have the present value of total cost of plant A and B, but we cannot compare it because it has a life of 20 years, it has a life of 15 years. What we are going to do, we are going to calculate the equated annual cost, that annually how much is the cost. And if we are calculating the equated annual cost, we can keep this annual cost already calculated separate aside, and we can add this 960 and 1060 at the end, right? So first you should take only the initial cash flow and the salvage value, take the present value of it, calculate EAC and add 960 and 1060 in that. So you will arrive at the equated annual cost. But that is not sufficient. They are asking you to calculate the unit cost. That means if the cost is annual, calculate the annual production also of both the plant, and then you can divide it to calculate the unit cost. Let's have a look. So machine A, machine B, or you can say plant A, plant B, the outlay is 24 and 40 lakhs capital investment. That is already at time 0. Hence multiplying it with 1 to calculate the present value. Then take the salvage value. 4 lakh at the end of 20th year and 4 lakh at the end of 15th year. 20th year and 15th year for respective machines or plant. So this is the present value, and then you do the total of these two. Let's do the total. 24 lakh minus 59,440. So you have to deduct it. You have to reduce. See, less word is already given here, but still. Then the cost comes to 23,40,560. And in other case, 40 lakhs minus 95,760. So that's around, I will write down here, 39,04,240. What is this? This is the present value of initial cash flows and terminal cash flows. Sir, why didn't you take the annual cash flows? Because already it is at annual and we are also moving towards the equated annual cost only. So we took this value, initial, terminal, we took the present value, calculated the present value. Now the total is there, divided by the annuity factor. Now you might get surprised that what kind of annuity factor is written over here. But let me tell you, this annuity factor is nothing but the inverse or the reverse of what we have been calculating till now. So if you go and calculate PVAF at 10% for 20 years, whatever it will come, if you reverse it, that means if you put 1 by that value, you will have 0.1175. So that is nothing but the reverse. What I'm going to do, 0.1175 divide by equal to. So the annuity factor comes to 8.5108. And in the other case, divided by equal to 7.6046. So if you use 8.5108 or you use 0.1175, it is one and the same thing. The only difference is if you are using 8.5108, you are going to put it in the denominator, 23,40,560 divided by this, or if you are using 0.1175, you can multiply it straight away with this figure. So it's just a matter of reverse putting it in the denominator or in the numerator. If you are putting in the denominator, divide it or it multiply. So with the help of this, we will calculate the annual cost, 275 and 5,13,000. This annual cost includes only the investment part and the salvage value. This will be added to the annual cost here. See, this is 275 and 513 that you have just calculated, and then you took all the other figures. This is also annual. These were also annual, already annual. So you can do the total of it. So 9,60,000 divided by 275 comes to 12,35,016. See, 12,35,016. Getting it? So this is your equated annual cost. But you could have decided on the basis of equated annual cost. But remember that both the plants are not giving you the same production. So even after calculating the equated annual cost, these two figures are not comparable because the number of units produced after incurring this cost annually is different. If it would have been same now, we would have concluded at this point itself. So what is the number of units that we are producing? Machine A is producing 200 units per minute. Every hour there is a 60 minute. So the total production every hour will be 60 into 200. And in a year we are working for 2500 hours. So total 300 lakhs of units have been produced and sold. But in machine B it's double because the capacity is double. Instead of 200 we are producing 400. So there we are producing 600 lakhs of units with a cost of 17 lakhs annually. And here we are producing only 300 lakhs with a cost of 12 lakhs. So what we can do is we can calculate per unit cost. 12 lakh 35,016 divided by 300 lakhs, you will get per unit cost of 0.041167. Here 0.02860. You can clearly see that the unit cost is lesser in this case. Although the total cost may seem higher, but the annual production is double that of this. Cost is not doubling. It is not going from 12 lakhs to 24 lakhs. It is only rising by 1.5 times, but the production is increasing by double. So that's why per unit cost in machine B is lesser. That's it. This is the end of this question. We should refer plant B because of the per unit cost is lesser. So this is how you use the equated annual cost concept. Okay, so we are done with this question. Question number 35 onwards, the questions are very simple. I have just taken it from the illustrations of institute's material. That's why I told you in the beginning that from 35 to 38 you have to do it, or you can skip it as well. 39, 40 was homework, 41, 42 was done in the class, I think, or either of the one has been done in the class. I think both of them were done in the class, and the inflation here was 14, 15, 16 was given as homework. After that, see, inflation was done, and then simulation analysis, scenario analysis was completed. We only have one question left, which is 45. 46 and 47 is also over. Let's do the decision tree analysis question, which is 45. It's pretty easy. We will finish it up. See, 35. Sorry, 45. It's almost the end of the chapter now. Have a look. L&R Limited wishes to develop a new virus cleaner software. Okay, let them develop. The cost of the pilot project would be 2,40,000. Okay, we will invest that. Presently, the chances of product being successfully launched on a commercial scale are rated at 50%. What does that mean? You have to invest 2,40,000 to find out whether we are successful or not. We may fail even after investing 2,40,000. So this is how it will look like. You put 2,50,000 of your money and you will come up with a result. The result will be either of the two. You may succeed or you may fail. And the chances of success is 50%. That means chances of failure is also 50%. Not to mention separately. And now the question is giving you that what will you do if you are successful, if you get success. So, in case it does succeed, we can invest a sum of rupees 20 lakhs to market the product, and this effort will generate a perpetual income. The concept of perpetuity. That is annual net after tax cash flow of 4 lakhs. See. Now, if you are successful in this project, you have to further invest 20 lakhs. This is cash outflow. And this is cash inflow. How much is going to be the cash inflow? Cash inflow will be 4 lakhs per annum. But that is perpetuity. What is the present value of perpetual cash flow? The formula is annual cash flow divided by the rate of interest, which is 10% in this question, given to us in this question. So if we want to calculate the present value of the inflows that we are going to receive every year perpetually, it is going to be this formula, annual amount divided by the rate. 4 by 0.10, that means 40 lakhs. So your NPV comes to 20 lakhs. 40 of inflow, 20 of outflow, 20 is the NPV, right? But at this point, I will show you. At this point, two things will happen. Either you will decide to invest further, or you will decide not to invest. You may decide. There is no binding. If you decide not to invest, you will have no cash outflow, no further cash inflow, and the NPV will be zero here because there is no cash outflow inflow. The only loss to you is this 2,40,000, 2,50,000. Now you tell me, if you become successful in launching this project, which one is preferable? Obviously the one where we are having a net present value, higher net present value. So yes, it's for sure that we are going to go with this decision. There is no probability of these two things. It's just the decision that we have to take, this or that. Either of the two, we will take the decision. It's in our hand. It's not in the hand of the nature, or it's not out of our control. If something is out of our control, then there will be a probability. That means there is a risk. But in this case, there is no risk. It's up to us to decide whether we want 20 of the NPV or 0 of the NPV. Obviously, we would go for the first option. So this option is totally out of picture. But if you fail, there are two things that will happen. If it fails, you can still invest 12 lakhs and perpetually you can have 1 lakh rupees, 10% of the get. So if you fail, there will be two things. You can invest further of 12 lakhs and have 1 lakh rupees of perpetual income. The inflow, the present value of that will be 10 lakhs and the NPV will be 2 lakhs negative. See, if the project fails, you can further invest 12 lakh rupees and have a present value of cash inflow of 10 lakh rupees. That means the NPV is negative. Why would you do that? The other option with you is to not to invest, not to have any cash inflow and not to have any NPV. So which option is better in this? Obviously the second option is better in this, not to invest if you fail in this project. Not to invest further. So anyhow, 100% sure that you will go with this option. So this option is out of picture. So it's for sure that these are the two things that will happen. If we are successful, we are going to further invest it. If we fail, we are not going to invest. We have to find out the expected NPV now. And it's very simple. There are two things that will happen, success or fail. Success, the chances of success is 50, the chances of failure is 50. What will happen if you become successful? You will invest further. But if you fail, you will decide not to invest. Do not invest. Because you are investing, you will have some NPV, that is 20 lakhs. I will just write down the answer. Cash outflow of 20 lakhs and inflow of 40 lakhs. 4 by 10, 0.10. And the NPV will be 20, right? But if you fail, you will not invest, there will be no inflow, there will be no NPV. Multiply the NPV with the probability, because if the chances of successful is 50%, the chances of having 20 NPV is also 50%. So NPV into probability 10, 0, 10. So expected NPV is 10 lakhs. Present value of cash inflow. Now it has become the inflow because we are now comparing it with the initial investment. And it's not 250, it's I think 240. So you deduct the outflow of 240 investment, the net NPV, expected NPV, comes to 7.60. Since the expected NPV now, after considering all types of cash flows, is positive, we should accept the project. This is the end of the question. Have a look on the answer. That is what the institute has done. See, 20 into 50 NPV, 0 into 0.50, so 10 lakhs. Out of this 10 lakhs, if you deduct 2,40,000, there will be 7.6 lakhs rupees of the gain. So the preferred choice is therefore investing a sum of rupees 2,40,000 and undertaking the test. You take the test. If it is successful, you will be having a good NPV. See, even if after launching the project and investing 2,40,000, if we are not earning more than 2.40 na, then it's no sense investing 240 as well. Like if this figure would have been, let's say, 2 lakh only, still we would have decided not to invest, even if this is positive, because in order to have this positive 2 lakh rupees, we have to invest 2,40,000 rupees, and that doesn't make any sense. So this is the end of the question, and this is the end of the entire chapter of capital budgeting. I hope you have liked it. See, unfortunately, we may not be able to cover up all the chapters in the exam oriented batch. That's a bad news, and I will tell you why. Because the regular batch is also going on, and it is about to complete, and uh, like creating by announcing the capital budgeting chapter, exam oriented batch for English and Hindi free of cost on YouTube, I made my schedule hectic. I thought I have a time, and I can easily complete it. But first, when I started, this is the first chapter, and I realized that it's not about the time anymore. It's about the health, the mental health. Teaching for 6 hours, taking short breaks in between, still you feel exhausted. So there is some energy level which is there in everyone when they are too young and when they have started their career. But I think my energy level or my interest to sit continuously for 8 to 10 hours is no more there. So that's a bad news. I also feel bad, but the doctor also has advised not to make this much of the hectic schedule, and that's why I may not be continuing with the exam oriented batch. Still, I will announce this on Telegram channel, and I'm very sorry for that. I am going to keep recording the classes, but that will only be for 1 to 2 to 3 hours. And I know that if I go for 3 hours of recording, the first preference will be to those people who have already bought the lectures, and otherwise they will start asking me for the refunds if I don't complete the regular batch on time. And then I will not be left with any time to record the batch. That's the sad part. But slowly, I will be recording the classes. Maybe for the next attempt or the attempt after that, people will be help. Like it will help to the people. I will come up with the classes, the revision batch on YouTube for sure. But there is no timeline. There is no schedule. I will do it as per my convenience and as per the as per how the body is reacting. Since I started the capital budgeting chapter and I had promised, so I completed it anyhow. But that's the only thing that I wanted to convey at the end of this chapter. So those people who are preparing for May 25 attempt, I suggest them to go and watch the classes, English classes of fast track batch. 90%, 95% is the same. It's only the new question that is not there. You can practice it. Concepts, all the concepts are included. And the only chapter that was not there in the fast track English batch was capital budgeting, and that's why I took it first. So that now your course is totally complete. So make sure you do that, and it's all you can ask me doubts. I will be there to solve the doubts. It's only the sitting in front of the camera and recording and speaking so much is not allowing to my health. Otherwise, solving the doubts, and I have the time also. Solving the doubts is all okay. I will do it, and I will surely try to help you. I will come up with more things in the coming time, but there is no schedule to it. There is no announcement to it. Literally very sorry for that, but I hope you can understand health is wealth after all. If I am okay, my family will be okay and everything will be okay. So there was some stress going on with my wife and with my child, looking at me after all this recording sessions on hectic schedule, and I told them that don't worry, I will be calming myself down after this particular chapter, and I will be going slowly because I love it. I do it, and I announced it. I hope you will be understanding it, and uh, wishing you all the best for the exams. Wish me also for my upcoming endeavors. Obviously, I will not be staying free at home and staying at home. I will be doing something or the other, but something which may not require so much of exertion. That's it. So this is what I wanted to tell you. All the best with the advanced capital budgeting chapter. If you have reached till the end of this chapter, please mention that in the comment section and tell me how this chapter was, if you have liked it or not. Bye bye.